revenue growth, double-digit median EBITDA and PAT growth for the 603 companies that have come out last week. And that just sums up maybe what this earnings season has been, a positive surprise because of margins. So as much as we talk about how geopolitics and macros are out there, this quarter earnings thus far have actually surprised the street, and no wonder that the street is rejoicing.
Yeah. And not just manufacturing companies and chemical companies, in certain cases, banking companies have also positively surprised on margins. So that's
I reckon this week will be as important, if not more, because 700 companies to report this week. So that's when you will have, hopefully it won't balance on the negative,
Hopefully,
and
yes.
you'll continue that upward move. All right, let's talk about global cues. The real action actually started after US markets shut on Friday, but nevertheless, Friday was a winning day of trade as tensions have eased, and indices were all majorly in the green, Dow about 300 points up, S&P 500 and NASDAQ up as well. But the real story can be seen as in the US futures, if we can pull that up, because US futures took a tumble as Moody's has downgraded the American economy to AA1 rating from AAA. The Dow futures dropped nearly 300 points as a reason. Now, the reason why Moody's has done this, of course, because concerns of expanding debt in the United States. It's obviously led to a political reaction as well from the White House rubbishing it, etc. But having said that, Moody's has just followed its peers. Fitch also had a downgrade in 2023. Bond yields dropped as well on poor consumer sentiment data. The 10-year is at 4.45%. Expect bond yields to also be impacted by that Moody's downgrade. The consumer sentiment index, if I talk about one key data point to watch from the US economy perspective, declined to 50.8 in May from 52.2 in April, the second lowest reading ever after June 2022. Crude prices, meanwhile, stayed steady as Brent remained around the $65 mark. Let's take a look at how Asia's open has been fairly mixed. Japan GDP numbers have not been too enthusing, but you've seen Nikkei, Hang Seng and Shanghai all down in the red. So is India, but mildly so, and that's to be expected after the roaring week that we've had. A flat to negative opening indicated for the Nifty this morning. But let's get on our first speaker, Jonathan Barrett, with us, Chief Investment Officer at ETO Markets. Jonathan, great to have you on. I just want to talk a bit about the FI figures we've seen from the Indian perspective, and let me get straight to the India story first before we get your view on what Moody's has said on the United States. Just the flows coming back. I mean, in this month so far, you've had close to 29,000 crores coming in from foreign investors. Do you see that India trade sustain?
Yes, I do. I actually think we're seeing a reweighting, and I think one of the interesting pictures at the moment is sort of people saying that the market sort of with the tariffs have readjusted, but now economies which do a lot of trade are seeing more opportunities, and I think these opportunities for more free trade elsewhere in the world is starting to take shape. So I think countries like India, sort of are bound to get this influx of more capital because people see, well, hang on, we can do more trade cheaper if we look around our region, and if I look for other partners which are diverting interest from the States into their other economies. And you can see that quite adequately when you look at some of the DAX, for instance, in Europe. That's going to record highs. Why is that? There's a lot of reasons behind it. And I think one of those is a diversion of trade to new economies. And I think India will definitely benefit from that.
Okay. Jonathan, let's talk about the development. Moody's coming in very late when you talk about the other rating agencies that did this in certain cases years back. So how big of a development is it in your opinion? Is it simply a statement of fact that was already known? And do you think that this flow of capital that has started moving away from the United States, do you think that accelerates?
Yes, I do. I actually think it do. Now, we also remember that we're seeing ratings agencies change, but to get Moody's to change is quite a big thing because they're the last ones. So what's the tipping point that enabled them to say, okay, well, we're going to move? And I think what we are seeing is a lot of, I think it's about $6.5 trillion worth of debt rolling over. Now, one of the reasons Moody's said that they would actually reduce it was because of the size of the interest repayments. And with 6.5 trillion now being rolled over starting in June, the market's going to be concerned on the ability, given where we are with the deficits, in the US. The GDP, it's 134% of GDP, which is huge. Given where we are, what's the cost of that rollover be to the economy in terms of interest repayments? Because they're all going to roll over into higher rates. That to me is a concern, and why Moody's changed their mind, their tune, and lowered the rating.
How much of an impact do you see this making, Jonathan? Because even though it's a downgrade from AAA, there's no real concern in that sense to the US economy, isn't it?
Well, I don't think there's a lot of concern. I think it's just putting everything together. So investors are sort of starting this trickle away from the US. They're starting to think, Moody's have moved on that. Look at University of Michigan's consumer numbers once again, and confidence numbers, they're all starting to deteriorate. Yes, we've seen some positive numbers in terms of reportings, but remember, that's a lagging indicator. We've got to look at what the companies are thinking in the next 3 to 6 months. So there's created a little bit of a picture here, which is negative, towards the US and to other economies. And I think this is just the start of this picture. Unless things change, this is a picture which I think will see people invest in other economies over the US.
Give us a sense of what you think is going to play out with the dollar then, because it's still hovering, I'm talking about the dollar index, around that 100 mark. And does it weaken from this point? And the recent move just a little bit higher from sub 100 levels to above 100 levels, is that a brief respite?
I think you'll find the US dollar over time will continue to weaken. I mean, the central bank has to, because we have this debt situation and we're sort of moving, and it's not going away for up until 2035, it's still going to be there. So I think whilst we've got this issue, I think the US dollar should remain under weak. Now, it makes sense to have a weaker US dollar because that'll stimulate homeborn exports, and that's what we know Trump actually wants. So I actually see that the US dollar, without having a policy in place to see the dollar weaker, it'll weaken by itself, and that should aid the US in terms of its exports. But that will take time. Mind you, on the flip side of this, a weaker dollar, persistent inflation has only got to be good for gold.
Oh yeah, okay. Any thoughts on where gold is headed? Any levels that you have in mind, as difficult as it is to predict?
Well, I mean, let's put it this way. We are seeing this natural flow where people are seeing, with all this uncertainty, gold should start to pick up again. 3,500, I think, is certainly on the cards. We've got to obviously get through this current level of resistance, but I continue to see gold. You have to have some of that in your portfolio.
Right. John, thanks so much for joining us this morning. Pleasure speaking with you as always.
Thanks very much. Have a good day.
Yeah. All right, let's talk about Indian equities. And Tamanna briefly mentioned this. The flows were absolutely stellar. Buying across the board by institutions on Friday. And both domestic institutions and foreign institutions were net buyers, to the extent of 8,800 crore rupees by foreign institutions just on Friday, and 5,000, nearly 200 crore by domestic institutions. Benchmark indices ended marginally in the red on Friday, and the broader markets outperformed yet again. In fact, 4 out of 5 sessions, the broader markets beat the benchmark. Let's talk about the weekly gains. The Nifty 50 gaining as much as 4.2%, largely on account of 2 of those trading sessions, the second one being on Thursday. And you had the mid-cap index gaining about 5.1%, the small-cap index about 6.8%. So a year's gains can be made in a week, and this might just be one of those weeks. Nifty 50 hit a 6-month high. BEL, Bajaj Auto were the top weekly gainers, and it also held above the 25,000 mark, just about, and holding on there. That will be a key level to watch out for at the start today as well. The small cap index records its best week in 5 years. The mid cap index as well, recording its best week since March. The defense sector was in focus yet again, and get this, it gained nearly 20% last week. The realty index was another big gainer. It gained about 11%, and it's risen now for the 3rd straight week. The VIX, which is a measure of volatility, has cooled off further over the course of the week from levels of 21 at the start of the week to about 16.5 towards the end of the week. On Friday, it cooled off about 2% or thereabouts. And that's, it's a good sign for the bulls. But there's also, at least the way that what I saw on the screen, Neeraj, is that the RSI around 62, 63 or thereabouts for the Nifty 50, which is not egregiously high.
Yeah, I mean, you're pessimistic if you think it's the yearly gains in
No,
this
I'm
week.
saying, I'm saying gains can be made in a week, right?
That's a very strong one for sure. And you're right, Alex. I mean, very strong technical levels because the weekly candles for both the Nifty and the Nifty Bank are very, very good. In fact, Dr. C.K. Narayan's column mentions this piece as well, that the momentum is back and people may be believing that there is a bit of a FOMO in the minds of people. The other piece is, as we said, the earnings. And you mentioned FIIs, guys.
Yeah.
Since the start of, or since mid-April, right, April 15th to be precise, FIs in the cash market have invested 70,000 crores. It's just the cash market. So we back with the bang when it comes to FI run rate for sure, and that really, really helps. Now, you mentioned a bunch of sectors, Alex did, and metals and PSUs clearly have momentum on their side with positive macros, right? On the metals side, I mean, everything that augurs well for China probably augurs well for the metals basket per se, and defense effectively laying to bear the kind of moves that PSUs have made. I mean, the PSU index uptick would largely be because of what a Garden Reach Shipbuilders or a Cochin Shipyard or some of these others have done. So phenomenal moves, but essentially metals and PSUs have macros on their side. So bear that in mind. And the fly in the ointment, hotels. Watch out for hotel sector in Q1. Occupancies now for 2 weeks are low. I was having breakfast at a Premier Hotel in Mumbai, and the chain spoke about how occupancies are low at their hotel, across hotels, not just in the MMR region, but across, because 2 weeks in a trot now, occupancies are low. So therefore, we might be staring at a slightly wobbly Q1 for the hotel stocks. So don't expect, I mean, there's a bit of a bounce that has happened in the hotel names post the conflict getting over, but maybe, just maybe, Q1 may not turn out to be that great. So bear that in mind. And just, guys, I spoke briefly about last week's earnings, but this Goldman note on earnings, I don't know if you've spoken about it, the two of you, but I thought it was stunning what they've analyzed, right? Both Goldman and Morgan have come out with their notes. Goldman saying that 103 MSCI India companies, which have reported earnings, average positive EPS surprise of about 6 to 7% across the board. 58% of the companies have reported beat, which is the highest in 16 quarters. This is something, right? A telling statistic. The beat is aided by better than expected margins, and energy, healthcare, consumer retails. They have laid it out, are the ones which have done the best. Rhythm's note also more or less similar in terms of beat, and it is essentially the margin performance.
Some base effect here would come in specific companies in terms of Q4 of last year as well.
Actually, Tamanna, okay, I'm not 100% sure of that. Maybe you're right, but I would suspect that the base effect is now to come in Q1 and Q2, because we know that last year Q1 and Q2 were very, very weak. So actually the base effect YOY might actually help even more in Q1 and Q2. But this is very, very good. We remember in COVID times, companies tightened their belts, outperformed on margins.
Yeah.
We're seeing the same thing right now.
Yeah. So that's good. I love it how Neeraj casually slips in these fancy places he goes to.
Yeah,
fancy
for breakfast. I was
where
curious. My ears perked up.
Where none of us are invited.
Somebody invited. It was very easy coffee. So yeah.
No. But absolutely, I think results is going to be the big ones. In fact, focus will remain on domestic events as geopolitical tensions are now fading. And look at what's happened in the last few days. Of course, we know the regional conflict on pause right now between India and Pakistan. But even Ukraine and Russia agreeing to exchange 1,000 prisoners of war. Syria, suddenly, in the good books of the United States, they're beginning to talk to Iran of all things. So it's suddenly a sea change in the last week or so on geopolitical factors, which means that the focus will now shift to what's happening domestically. 700 companies will be reporting earnings this week, including Nifty companies. So while earnings have been good so far, I would say let's hold out for another week or so before we have the final call on what this quarter look like. Having said that, BEL, PFC, ITC, IndusInd Bank, the list is actually very long, but a lot of large companies will be reporting this week. Particularly keen to see what happens in the IndusInd Bank call and what the numbers finally stack up on, where are those big holes in their balance sheets, a story we've been tracking closely on NDTV Profit. I think FII flows is a big factor. FIIs have bought close to 24,000 crores just in the last week. Two main board IPOs also opened this week, Burana Weaves and Bellrise Industries. I think there are about 2 or 3 SME IPOs as well. So primary market perking up is always a good sign. As far as the Nifty is concerned, the next resistance level will be at 25,200. On the downside, 24,800 could offer immediate support. Experts seeing any dip as a buying opportunity in a bullish short-term trend because the overall trend does remain bullish. The Nifty Bank Index closed at 55,354, up about 3.5% for the week last week. So the breakout zone now is above 55,500 and the next resistance at 56,100, support at 54,800. So watch out for those levels as well. In fact, more on that with Puneet on what's happening on the F&O side.
Well, thank you for that. Good morning. We've seen, very strong last week. This week as well, we are expecting an implied open of just about 10 to 12 point narrow band range. But for the day, we are expecting the index to trade in very closely in that range between 25,000 and 25,150, at least on the upside. On the downside, though, we'll be maintaining 24,850 as one of the key levels to watch out for, as one of the key supports for this particular market. On the Nifty Bank, though, we've seen stellar recovery. 55,500 has been crossed now. We mentioned, last week, the 55,000 is one of the key levels to watch out for substantial upside going forward as well. Currently, we have a cushion of 500 points, but that will be another level on the Nifty Bank. When you look at the open interest for both the calls as well as the puts, we've seen an increased interest of calls now on 26,000 as well, and an increased interest at 25,500 for the calls, and that's largely because of the outperformance of the index last week. On the other side as well, we maintain 25,000 as the key level for the increased interest in open interest calls. On the put side, that has also been another level created now. Overall, 24,500 is something that we've been speaking about. 24,700 is one of the other levels on the puts, but largely the momentum remains bullish, at least on the calls as well as puts on the open interest side. In terms of key stocks, we've seen, stocks such as Titagarh, Solar Industries, Adani Total, as well as Concor have kind of essentially a long build-up in these stocks, and that's been sustained over the last week. While we've seen in terms of open interest losers, we have seen some short coverings in Apollo Tyres. Hindustan JSPL was one now, and another one was Crompton, and a lot of this is backed by fundamental results as well for all these companies. So overall, we are expecting to trade in a narrow band range, the put-call ratio also in favor of calls, but overall expecting a decent set in terms of trading today.
Got it. Thanks so much, Puneet, for getting us those details. Earnings continues to be in focus. A lot of those stocks that Puneet just pointed out reacting to earnings, and you saw the implications for the derivatives trade as well. But let's talk about the big headline from overseas and from the US, and that has to do with Moody's downgrading US credit rating to AA1, citing increasing government debt. The decision stemming from concerns over fiscal irresponsibility and a failed tax bill, which led to an immediate rise in the Treasury bond yields. Harsh is joining in to tell you about what led to this decision a little late in the day. Harsh?
Well, yes. Good morning, Alex. Thanks for that. Let me start off with the larger downgrade. The downgrade itself from a AAA to a AA1. The outlook has actually been upgraded due to the downgrade in the rating. The outlook now at stable from negative earlier at AAA. Now, it continues that the US downgrades versus some of the other rating agencies have already downgraded the US, beg your pardon. Moody's is the last one. In terms of, it's been nearly a century since Moody's has held this AAA rating, and therefore this downgrade assumes significance. Let me start off on why the downgrade. The federal debt has risen sharply over the last decade or so. US government has failed to reverse the large annual deficits that they've created. Moody's expects larger deficits going forward as well. Rise in entitlement spending is one of the causes. Government revenue is expected to remain broadly flat is one of the other reasons why deficits will continue to go up. And due to that, interest burden will also continue to go up. US fiscal performance is likely to deteriorate versus other sovereigns. Now, this is key because they've mentioned this a couple of times, Moody's, in their report. They've also said that there's limited room for flexibility in the budget, both in terms of spending as well as in terms of tax receipts. So unless tax rates go up substantially, looks unlikely anything to change. Let me look at numbers, right? Mandatory spending is currently at around 73%, expected to go to 78% of the entire US budget by 2035. That's large. The second piece is it includes interest payments, of course. The Tax Cuts and Jobs Act of 2017 is likely to add another $4 trillion to the federal fiscal deficit. Fiscal deficits are set to widen to 9% from 6.5% in 2024. The federal interest payments is likely to be at 30% of revenue versus 18% in 2024 versus 9% in 2021. So interest payments growth is going to be extremely strong. And federal debt burden is set to jump to 134% of GDP by 2035. The stable outlook is because, of course, US continues to have a very, very strong currency, the dollar. That continues to support the US debt. It also has a track record for innovation that supports productivity and GDP growth. It continues to be the dominant currency, and the debt of the US continues to have very, very favorable investor outlook in that sense. And therefore, the outlook has been, in that sense, kept quite stable.
So outlook is stable, but there is a downgrade, and of course there's a reaction coming in. Thank you for that, Harsh. All right, let's get to the stocks on our radar this morning. There's so much to unpack. On my wish list, or watch list actually, I'm starting with Divi's Lab, thumbs up. A great set of numbers. Revenue up 12% at 2,585 crores versus 2,303 crores. Year-on-year consolidated numbers, of course. EBITDA up 21% at 886 crores versus 731 crores. Margins at 34.3% versus 31.7%. I believe our research team has pulled out that figure. This is the best in 11 quarters in terms of the margins. So a solid set of numbers there. Net profit up 23% at 662 crores versus 538 crores. They'll, of course, pay a final dividend of 30 rupees per share, and they've appointed Venkatese Perumalu as the CFO. Now, when we go through the brokerages, you'll see one concern popping up perhaps on valuations, and fairly so. But here's what Morgan Stanley is saying. They've maintained an overweight with a target price of 7,185 rupees for Divi's. They say the gross margin expansion has driven the beat. Stable raw material prices and product mix has driven expansion. Company has reiterated its double-digit revenue guidance. Management sees high revenue opportunity ahead and plans to incur capex of 1,400 crores in FY26. They say this strengthens our confidence in future growth. Jefferies, on the other hand, has maintained a hold and actually cut the target price to 6,200 from 6,280, which is where the current market price is. It says Q4 numbers in line with estimates, largely balanced growth across segments. Divi's currently has several projects at different stages of development, does not target the generic semaglutide opportunity as it intends to focus on working with innovators. That's one differentiated approach, at least as far as Divi's is concerned. They've maintained a hold on near-term patent challenges and high valuation. So those are the two reasons why Jefferies is giving it a hold rating and has reduced the target price. But nevertheless, on basis of core numbers, a thumbs up on Divi's. As is the case for Zen Technologies, and we'll be speaking with the management today as well. Thumbs up on it. Revenue at 325 crores versus 141 crores. EBITDA at 138 crores versus 50.4 crores. A huge jump there. Look at the margins. It's a beautiful number at 42.5% versus 35.7%. Net profit at 101 crores versus 35 crores. So how do they perform? As per their guidance, they've surpassed the FY25 revenue guidance of 900 crores by 8%. They've met their EBITDA margin target of 35% and PAT margin of 25%. Their order book has stood at 692 odd crores as of March 2025. And they've received new orders worth 168.5 crores in Q4. You should pull up that last chart of Zentek, that weekly chart. It's an interesting pattern because that stock has been on a 5% upper circuit week on week, a day on day, all of last week. Of course, because of the interest in defense stocks overall, but the numbers are also bearing out the interest we've seen in the company. Delivery is the third stock on my list, thumbs up. Revenue up 5.6% at 2,191 crores, EBITDA at 119 crores versus 45.8 crores. Margins have also come up well from 2.2% to 5.4%, so jump up there. Net profit at 72.6 crores versus a loss of 68.5 crores. Here's what Morgan Stanley says. They say they've maintained an equal weight with a target price of 320, which is where the stock is right now. Q4 was an EBITDA beat despite miss on revenue. Express parcel volumes and yields are lower than estimates. The PTL business revenue was a beat versus estimates, and other business performance was a miss versus estimates. So they have a bit of a mixed view on delivery, but overall the numbers look good.
All right. Now, I must confess that the first stock on my list, there was a little bit of a conversation, a little bit of a debate in the newsroom about how to target this or how to tag this. And Credit Access Grameen, according to our researcher Harsh, is a thumbs up. And that's because of the saying, the night is darkest before the dawn, and the numbers do reflect that, because the numbers are not great, but it's better QOQ, and it appears like some of the pain that this company has been through might actually be getting over. But take a look at the numbers first and take a decision for yourself. The total income is down about 3.5% or thereabouts. The PAT number is down as much as 88% and coming at 47 crore rupees. Caution is evident in the lending practice. Asset quality remains a key concern in the quarter gone by as well. The portfolio at risk ex-Karnataka, however, has seen a marked improvement. There was an aggressive write-off that was seen in the fourth quarter. As much as 518 crore rupees worth of loans were written off. In fact, that accelerated write-off was on loan accounts with 180 plus days past due, which is where loans have not been repaid for 180 days plus. The gross non-performing assets post that write-off stood at 4.76%. By the way, the net interest margin has also contracted, stood at 12.7% compared with 13.1%. But the management says that the delinquency trend is set to normalize by the end of the first quarter FY26, this quarter. And things will improve further in the second half of the current financial year. So that is the operating thing to focus on. Of course, the return ratios have dramatically changed on a year-on-year basis. They've managed to return positively in the quarter gone by. These numbers were negative in the third quarter, which is another point in its favor. The ROA is 0.7%. That compares with 5.7% in the fourth quarter of the previous financial year. ROE coming at 2.7% as well. And the GNPA has widened quite considerably to 4.76%. All told, expect that the outlook for the company is looking a little better, considering that a large part of the delinquencies come from Karnataka, and the problem area is Karnataka, and that has to do with regulations that have changed in that geography. Watch out for this stock in trade today. India Glycols. There are a number of specialty chemical companies over the course of the quarter gone by that have posted better than expected numbers, and this company has also done so. 6.8% improvement in revenue, but the EBITDA margins have actually improved very dramatically, coming at 16.9%. This is really something of a trend for some of these companies. The net profit as a result of which has come in 52% higher at 64 crore rupees, and that certainly is seen as a positive. There are a few corporate announcements also with regard to this company, a spin-off of certain businesses, but really the numbers are going to be in focus at the start of trade today. Lastly, Data Patterns was certainly a thumbs up based on the numbers. The revenue increased as much as 61% in the quarter gone by. The margin coming in at 37.7%. Yes, it is dramatically lower than the previous quarter, but it is within the range that the company has guided for. The net profit is up as much as 60.5% or thereabouts at 114 crore rupees. It has beaten its FY25 revenue guidance of 20 to 25%. It has met its FY25 margin guidance of 35 to 40% as well. It has secured 355 crore rupees of orders in FY25, which is down about 50% or 48% or thereabouts, but its order book stood at 1,083 crore rupees at the end of March. And certainly another defense stock that is raced ahead in the week gone by. I wonder whether it will continue to do so today.
Yeah, certainly something to keep an eye out for. I have a couple of stocks on my list, Alex. One of them is Banco Products. Revenues, it's a small company, so bear that in mind, but revenues were up 21% at 875 crores. Margins expanded 800 basis points. Talk about margin expansion story this quarter, 24% versus 16%, as a result of which profit after tax was up 125% at 154 crores. It is up about nearly 5x on a quarter-on-quarter basis, the profit after tax. And the stock trades at a trailing 12 months PE of 19 times. I mean, I don't know what about the future, but the trailing 12 months are looking very solid. And as a result of which, I wouldn't be surprised if Banco has a bit of a positive reaction today. Watch out for Gujarat Alkalis. Revenues were up 7.4%, so nothing dramatic there. But EBITDA, 114 crores versus 28 crores, as a result of which margins 10.6 versus 2.8% on that base to expand margins the way they have, quite stunning really. Net profit as a result of which at 8.8 crores versus a loss of 46.2 crores. Mind you, the net profit was aided by another income also of 24 crores. So that aided the net profit, but don't take your eyes off the margin performance that Gujarat Alkalis has given. So stunning performance out there. So keep an eye out for both of these small caps as well.
Do you think that the corner has been turned by chemical companies?
I mean, it's so difficult. Like for the longest time we've been talking, as you also pointing out, Alex, that Sheraya. Let's see if this time around it's for real. The commentary doesn't quite say that, except for companies which have the CDMO angle to them, like Ami Organics or Naveen Fluorine. So let's see. Yasho was slightly positive. So those 2 or 3 names have given some positive commentary, but mass commentary not necessarily. We spoke to Aarti, right, the other day. Okay, so let's see.
So the margin expansion, whether it sustains and heads into the first quarter of this financial year is the question.
The only thing that you ought to keep in mind, I think, that whether the companies will be able to beat estimates in quarter 1 and quarter 2, because everybody will know that I think the quarterly performance per se should be okay, because we had a really tough time in H1 last year. So why things will look good? Yeah, the base is low.
Low base. All right. Let's talk about automotive company Hyundai, and brokerages are mixed on the company. In fact, Puneet joining in to tell you why that is. Puneet, earnings in focus here?
Well, definitely, Alex, and we've seen the earnings come in slightly beat in terms of the EBITDA number, while the rest were largely in line. And there are just a couple of points before I get to the brokerages. One, they've reduced their discounts in this particular quarter compared to last quarter, as well as the commodity cost was also slightly in favor for the company. That's what they said. Because of higher mix of SUVs, that's helped margin. So that was one, and that's something that's consistently mentioned in the brokerage reports as well. The other thing is 26 new products is what they've said over the next 5 years. 8 of those will be seen in the next 2 years. So I think that will be giving good guidance. And the third is they're opening a new plant, which they acquired from General Motors in the next couple of quarters. So that should aid any kind of utilization concerns. It's currently at 93% for the current plants. So those are the 3 key points that have been mentioned. The key in each of these reports, the key not in terms of the brokerage reports, what I've mentioned is like Macquarie has said 2100 is the target price, and they've maintained that positive view on them. They've said that premium positioning of Hyundai is a key positive. But then I think the concerns come on valuation and growth, because they've said that the company will do industry growth in the next year. And that is just penciled it at just 2 to 3%, and export growth will be 7 to 8% for the company. But largely, it could be another year where the growth is not present at that time. BofA, they've actually maintained the underperform rating, slightly hiked the target price to 1850, and they've said that the growth and market share recovery is still some time away, and that is something to watch out for. And given the lack of near-term catalysts, they are reiterating their underperform rating. And finally, in terms of JP Morgan, they've cut their target price to 2,060 rupees per share from 2140 earlier, and they've said that the volume pain could continue in H1 of FY26. So it's very interesting where the companies position in same valuation versus Mahindra as well as Maruti, but growth concerns may be something to watch out for going forward for the company.
Thanks so much, Puneet, for laying that out for us. By the way, Hyundai is still trading below its issue price of 1960. Watch out for that in trade today, and let's see if Macquarie's positivity leads to some more positivity for this stock in trade. But we've got more stocks to talk about, and trading strategies, of course. At this juncture, we're continuing to expect a very narrow, very tiny downtick for the benchmark. Do stay tuned. We've got more lined up for you on the other side of this very quick break.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Open. Kush Bora, founder kushbora.com in the studios. Aditya Shah with us as well, founder Hercules Advisors. Welcome to both of you. Very good morning. Kush, I hope you've had a great weekend. Tell us what it looks like for this week.
Well, it was about to be. I was about to play a couple of matches, but then, looks like it's not just the liquidity pouring in.
Right.
It's also the, sooner than expected rains, but I'm not complaining.
You were going to play. I thought IPL started this weekend again. So you could have watched instead.
Oh, no. I prefer to play more than watch, for sure. Yeah, while I can, right? No, but as I said, liquidity and rains both pouring in, I don't think anyone's complaining, right? So, from rain gods to gods of wealth or goddess, if you prefer. I think Nifty's had a fantastic run in the last week. We've all seen that. In all likelihood, that is going to continue, especially if you see the kind of flows that, we've had over the last week or so. On most parameters, be it RSI or be it PCR, Nifty is not overheated, not even remotely close to that. However, on one small parameter, which is the Bollinger Bands, Nifty is on the upper end of the Bollinger Band. It's not such a bad sign because that also indicates range expansion. What we saw on Friday was a bit of consolidation, a bit of short straddle playing out at the 25,000 mark, and there's a possibility that even if you open a little lower, this might just turn out to be a buying opportunity. So if anyone has a position, you should continue to hold. If you don't, with a stop loss around the 24,700 mark, you can still make a long position. Of course, if you get anywhere closer to that range, the better it is. But on the upside, you're looking at resistances at 25,300, 25,500. So on the whole, the markets look on a good footing. All the action has shifted to mid and small cap space, so I think that's likely to continue. The other quick word on Bank Nifty. is that while my bias is positive for Bank Nifty, the one interesting thing that's happening is that the range or the resistance is shifting lower. Initially, it was 56,000, where Bank Nifty met resistance couple of times, could not cross. Last couple of days, that has shifted lower to 55,500. It's not deterring the overall view that I have. It's just that the near-term view shifts to Nifty long rather than Bank Nifty. Now, as and when we cross 55,500, the bias will turn positive from a momentum perspective as well, from a very near-term perspective as well on the Bank Nifty. But as I said, on the whole, on good footing, any dips should be taken as a buying opportunity on the Nifty and the Bank Nifty.
Okay, let's also talk about your stock picks today. Do you have all buy ideas today?
I do, and I've had that for a while now. Among the financial names, it's HDFC, AMC. It's Monday, so why not look at the weekly setups for some of these stocks? Very good run, on HDFC. The last 5-6 weeks have been, a series of higher high, higher low formations. Some volatility here and then expected, in the onset of last week. But other than that, good volumes closing in for the week, that ended Friday. You're looking at an upside of nearly 4,900, 5,025 as the next two targets, 4,600 being a very strong support zone. So that acts as your stop loss. The other one is EPL. Here too, we've seen very big gains in the last 2 weeks. Despite that, the momentum indicators are still just picking up. So 245, 255 are your targets. 225 is where you place that stop loss. Just a quick word on, one stock. Apar Industries. Now, a lot of stocks, as you would expect in a market like this, would have hit targets, so I'm not, enlisting all of them. But one stock that deserves special mention is Apar Industries. The reason being, on 12th, Monday, we discussed this stock as a long trade for a second target of 6,400. That's right, 6,400. The stock is 8,200 plus. So if anyone's still holding this position, you might want to, book some profits and enjoy, a good start to the week. So yeah.
Actually, and that's a pertinent point to highlight as well, because some of the stocks have had a really, really strong move. And Aditya Shah, come in very quickly on some of these buckets which have done so well, right? Good morning to you. What do you do with, Apar is a case in point, but a Garden Reach Shipbuilders, right? Or a Zentech or some of the others which have had a stupendous move. Do you take money off the table in some of these domestic defense / other related names, or do you ride the wave?
Defense is the new IT of 2020 and the new chemicals of 2021 is what I think. Everybody's rushing to buy chemicals. Of course, defense, the entire defense sector is a theme for the next 10 to 15 years. Government will invest heavily in the defense sector per se, but it is not necessary that if the companies make money, the stocks will make money per se. Many of these stocks are trading at sky high valuations now. You've seen ever since the skirmishes that we had, these stocks have moved dramatically up. So from my perspective, I would like to profit book here. I would like to be very cautious on the entire defense pack. Consensus buy is never a good investment in the stock markets per se. These stocks will continue to do well from a business perspective. But if you buy these stocks at a multiple of 40, 50, 60 times price to earnings, you will find that these stocks inevitably go time correction, as Asian Paints is doing over the last 2 to 3 years, when Asian Paints was also a consensus buy in 2020, 2021. And now you look at 3-year return, they are not even FD returns, they are negative returns first. So very, very cautious on the entire defense pack.
Cautious on defense, that's the word coming in from Aditya Shah. Just want to quickly talk about one company as well, which might see one stock which might see an impact. This is Protean eGov, and expect a negative impact today on this stock. A statement put out by the company says it's no longer in contention for Government of India's PAN 2.0 project. It has been eliminated from the RFP race. The government had plans, remember, to overhaul the entire PAN/TAN services under PAN 2.0 with a 1,440 crore budget. This was something that the company was in contention of. Despite earlier confidence, Protean is now completely out of the running. So here's what Equaris is saying. They're saying this is a material negative as PAN services contribute 50% of the company's revenue. FY26 impact may be muted. Expect a 75 to 100% collapse in this revenue stream over the next 2 to 3 years. 35% decline in FY27 overall revenue. The segment has historically generated free cash that funded new initiatives as now under threat. additional headwinds, including an impending NPS pricing revision in FY27 and stagnant ONDC retail volumes. Downgrade to sell from ad, they've cut the target price to 900 rupees from 1730. So expect some pain there. Another company which might see pain is the one that we're going to talk about next. It's an NDTV Profit exclusive and it's a big one. The government is reviewing Interglobe Aviation's tie-up with Turkish Airlines is what we learn, and may not allow them to renew the lease pact. Sesha joining us with more details. Yes, Sesha.
Absolutely, the government is reviewing, aviation ties between India and Turkey following Ankara's support for Pakistan during Operation Sindoor. Now, what we have learned is that while the entire review exercise is still underway, sources have indicated that, the Indigo's leasing agreement with Turkish Airlines has been identified as one of the concerns, and it is thus being scrutinized. It is learned that the current lease, which is set to expire on May 31st, is unlikely to be extended. Now, again, this comes as the government has been actively cutting diplomatic and commercial ties with Turkey following the military standoff last Thursday. Remember, the government revoked security clearance of Turkish firm Celebi, which used to operate ground operations in 9 airports across the country. There are, some reports which also suggest that Air India has, sought government intervention to halt Indigo's leasing pact with Turkish Airlines over security concerns. Although Air India has defended, this and said that they have not really engaged in any talks on the competitors' business. Indigo, on its part, they have also defended its partnership, saying that the tie-up, which also includes a code share agreement with the Turkish carrier, rather provides multiple benefits to Indian carriers, boosts aviation growth, and also supports employment. Currently, Indigo operates direct flights to Istanbul using 2 leased aircraft capable of fitting over 500 passengers. Now, the government is likely to hold dialogue with Indigo before taking any definitive action, given that various stakeholders are involved and competitive interests at play. Indigo has not yet responded to NDTV Profit queries on this matter. However, the management is likely to address these issues, after its results, which is on May 21st.
All right, a very important story to track, and with the rise of India as an economic power, you will increasingly see Indians voting with their pocket and deciding to change the businesses that they choose to be associated with, the products and services that they consume. So companies and even countries are going to have to be very careful about the decisions that they make. I want to come to you, Kush, on a couple of these names, and we did speak to Aditya about a few of these defense companies, and he says that anything with a consensus buy is something that you look at, perhaps.
Sorry, before we do that, Alex, can I just
Yes,
take a view from Aditya on Indigo itself?
Yeah.
Because this will be important, right,
Yeah,
from
it's
that
an important
perspective.
story to take forward.
Aditya, I'm just wondering, what do you think of this particular event and the ramifications that it may have for the Indigo share price? This or some of the others, but yeah, predominantly this.
Well, Neeraj, what Indigo was trying to do is when it wanted to fly to Europe and the US, it was using Turkey and Ankara as a base, flying people there, and from there on, Turkish Airlines used to take them forward. I don't believe that government will allow Indigo to continue this. Government will ask Indigo to terminate its partnership with Turkish Airlines, which inevitably means that the international market strategy for Indigo will need to get realigned with somebody else. And that means that is a negative for Indigo per se. Indigo, mind you, Indigo trades at about 2.1 lakh crores market cap, and this is a very, very negative news for Indigo. And this was bound to happen once Turkey supported Pakistan. This was bound to really happen. As we already know, the ground handling services at Delhi airport has effectively been terminated by the government. So this is negative for Indigo. Now Indigo will have to realign itself with a new partner, and the entire strategy will have to get reworked.
What do you reckon is there a revenue hit, if at all, for Indigo? Negative, yes, sentimentally, but on their balance sheet?
Obviously, there will be a negative. The 777s that they have leased out will go out. The entire partnership with Turkish Airlines will have to get terminated over a longer period of time because the government cannot allow the largest player in the country to feed passengers to a company which is working against the interests of India per se. So the growth aspect of Indigo will start to take a hit, and that's where the valuation will also take a hit for Indigo per se.
This juncture, though, Aditya, considering that this is international routes and a large part of the revenues do come from India, how much of an implication is it for Interglobe Aviation? And in your study of the sector, how quickly or how over how much period can such an alliance be struck again if they have to move beyond Turkish Airlines?
So for Indigo, the next leg of growth would come from the international market. As people start to travel from India, not go to Dubai or Abu Dhabi, and start to travel India from India directly. That was the next piece of puzzle that Indigo was trying to solve. Now, from this perspective, about 8 to 15% growth over the next 1 or 2 years would have come from the international travel that Indigo was planning to really do. That is first point. So growth is going to take a hit, not the domestic growth, but the international growth per se. First point. Second point is how fast can Indigo recalibrate itself? It will take about 1 or 2 or 3 years for them to recalibrate themselves. They will need to find a partner to fly themselves out. Mind you, the problem with Indigo is Indigo does not own a 777 like an Air India does, so it cannot directly fly to the US or to European countries like Britain. So that's where the problem really is, and it's not very easy to acquire long range aircrafts per se. So this is a negative in the shorter term. But given the quality of Indigo, I'm sure that they will find another partner to take over the operations. But in a shorter term, negative for the company.
That shift will be difficult. And look at what's happened over the weekend. The largest ground handling company, which services 9 airports, including Delhi and Mumbai, has been booted out overnight. So these are very, very clear, decisions that the government is making right now, and companies are making as well. Indigo on the charts, Kush?
Not so bad, especially if you consider the fact that, from Jan up until now, the stock is actually 40% up considering everything that's happened in the market. Even on a weekly setup, if you see the last 2, maybe about 4 weeks, the 5550, 5600 level was anyway proving to be a resistance. So I think that's just playing up. I think if I get a dip closer to the 5400 mark, perhaps even 5250 basis on the kind of impact that, this news might have, I think it will be a buying opportunity. And on the upside, you'll once again be, looking at 5600 as the first target once that is taken out, 5850 as well. So with this kind of strong move that you've seen over the last, 4 to 5 months, some consolidation was anyway par for the course, and any dip, I'll take it as a buying opportunity.
Okay, yeah, we're going to talk about some of the stocks that we haven't quite discussed. So I'm going to go to Aditya on Protean as well once. But before I do that, just want to mark Adani Enterprises. It's something that we haven't discussed thus far on the show. But over the weekend, Adani Enterprises has gotten into a defense tie-up. And to my mind, this is meaningful because I think there are a few cues that are coming out for this particular business over the course of the next 1 or 2 or 3 months. So Adani Defense and Aerospace has partnered with Spartan to manufacture indigenous sonar buoys, which is to boost the anti-submarine warfare capabilities. Their UAVs were used in the conflict as well. The Navi Mumbai airport about to come in, again a part of Adani Airport Holdings, a part of Adani Enterprises. So I think there are a clutch of triggers that are working for Adani Ent. I wonder if this is a business to reckon with in the near term, Aditya. Any thoughts on this one? And couple that up, of course, with the thought on Protean Eager, which has been left out of the contract as Tamanna highlighted earlier.
So no comments on Adani Group stocks per se, but let's talk about Protean e-governance. It's a great business. It is basically handling the back end of many government services that are playing out. This, I believe, would be a negative that they are no longer in contention for PAN 2.0 project. The stock valuation was really very aggressive. With this project slipping out of company's hand, I believe the stock price could really correct, and that could be a good opportunity to enter into the stock. So negative for the stock in the short term per se, but given the business model of the company, revenues will keep flowing in, It is just like a BSC or an NSC where revenues will keep continuing to flow, and any stock valuation towards 1200 would be a good opportunity to enter into this.
Okay. Okay, thanks Aditya for that. Now on to other stocks, and Keynes is in focus because I think brokerages have a fairly divergent view on the numbers that have come out. Puneet Johnson to talk about that. Puneet.
Well, thank you for that. So definitely, 74% growth in EBITDA in Q4, and that was expected for the company to meet its guidance. Mind you, the revenue guidance has still not been met, but the stocks reacted very positively on Friday once the numbers came in as well. In terms of brokerages, a couple of them, just want to highlight those. Morgan Stanley has, maintained, they've actually downgraded the stock to an equal weight from an overweight earlier. They've cut their target price to 6,155. From 6,600 almost earlier. They're mentioning that this is largely because of valuations concerns itself. The business fundamentally has been very strong. They mentioned that the stock has outperformed the last 3 months. It's up 58% from its lows of about 3,900, which it hit in on February 18th. So since then, a very strong move. They've also mentioned that the current valuations factor in a 39% CAGR on EBITDA over the next 5 years. So essentially pricing in the future outperformance as well. They've also said that the cash flow of the new business will be one of the key things to watch out for, which is PCBAs as well as the OSAT, which is the semiconductor business. On Jefferies, they've actually went on and hiked the target price by 1,000 rupees to 7,660 rupees. Two key points they're making: strong execution, highest quarterly EBITDA. They've also said that they're expecting multiple levels of growth from the new business as well as the existing ones for Keynes. And they've said that the OSAT as well as the PCB production will start by Q4 of this year itself. Meaningful impact will be, of course, seen in FY27. But overall, the stock is currently more expensive than Dixon Technologies as well. 97 times price to earnings for FY27. So baking in a lot of positives already from the new verticals. But overall, a stock that's done well for its investors as well as, in terms of outperformance in Q4 as well. But watch out for this one going forward as well.
All right, so watch out for Keynes Tech in trade today. Kush, coming to you on what I was asking you earlier, which is on defense companies. The entire pack is up about 20% or thereabouts in the week gone by. And there are a few names that have gained more than that. Would you take money off the table if you managed to get in week before last?
You have to be either extremely lucky or brilliant. Okay, sometimes it's a mix, right? I mean, to make money in these markets. But if you did, you would only take 50% out of it. At least I would. The reason is that, as I've discussed in the past, that the rally that came about from 2020 to about 2024, it was humongous, right? And at any point in time, if you got out of these stocks, you would have had a big regret. You wouldn't want to do that. In fact, I was doing some reading over the weekend and how the expenditure numbers which are targeted for 3-4 years from now might actually be hit sooner. So all of those might also start playing out. If you look at it from a purely technical angle, yes, some of these stocks are approaching overheated territories. But despite that, even if there's a profit booking, you wouldn't want to be completely out of these stocks. So as I've suggested in the last week as well, is that you book 50% at the current juncture, as in when you get about 10% dip basis the price that you've sold, you re-enter these stocks. In short, you don't let go of defense names in your portfolio. I still continue to like BEL and BDL. Something like a Zentech and IdeaForge overheated. But again, as I said, if you get a dip, those are the stocks that you want to keep on your radar to re-enter.
Got it. All right. So keep those stocks on your radar. BEL, of course, in focus on account of earnings as well. And a couple more stocks also having posted their earnings. And we're speaking to the management. That's lined up in just a bit. But we're slipping a very quick break. On the other side, you'll see the pre-open rates heading to the pre-open session. And do stay tuned for all of that.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research. shines a light on the biggest stock market movers.
Headlines you start your day with.
Welcome back. Just a minute or so for the pre-open rates to hit, and it's looking like an interesting one. We're going to get you a few more stocks that should be on your radar this morning. But before that, a quick look at the implied open, about 26 points down. So a bit of a weak start today. But nevertheless, Aditya, I want to come to you on whether you would want to create positions ahead of some key numbers that are going to come in, and BEL in particular comes to mind. Apart from that, have you looked at the Divi's numbers? Do you think Divi's is something that is exciting you?
So Divi's numbers were really very good. The Kakinada facility expansion is going really well, and the custom synthesis business is going to do exceptionally well. So as I've said before, form is temporary and class is permanent. Divi's Lab is an all-weather compounding stock that should be inside your portfolio. Any correction in Divi's Labs is an excellent opportunity to buy. So thumbs up to the Divi's Labs numbers.
Okay. And what about BEL ahead of its results? I know your overview that, yes, defense maybe come off it a little bit. Already valuations have run up, but Bharat Electronics specifically?
No view as such, but I would not tend to make positions on the run-up to results. The stock is already up, I think, about 20 to 30% over the last 1 month itself. A lot of positives are already priced into the stock per se. So won't tend to create a position in a hurry in BEL or any defense stock.
First minute or so for BEL looking good, but of course these are just pre-open rates, they will settle. But a few other stocks that you should have on your radar before the start of trade today. Mahima joining us with that list. Why is IGI, Premier Energies and Wendt on your list, Mahima?
Right, so I'll start with Premier Energies. Of course, one reaction could be on the back of earnings, and the second one being they've informed about forming 2 new JVs. The first one is JV with Nuasol Energy, where the JV is for business of foundry as well as extrusion of aluminium frames for solar photovoltaic modules. Now, in this, Premier Energies will hold around 80% in the overall JV, and this will be focusing on the Indian market specifically. It will manufacture aluminium frames for solar PV modules for domestic as well as captive use. The second JV is being formed with Taiwan-based Sino-American Silicon Products. This is to manufacture and sell solar silicon wafers. In this, PL will be holding around 74% of total equity. So Premier Energies will be in focus on the back of earnings and plus these 2 updates. IGI will be in focus because 10% of diamond factories in Surat have declared holiday of over 15 days in summer vacation. Now, this is the first time that this is happening. Generally, these factories are closed during Diwali time, but major units involved in polishing rough diamonds are planning to remain shut till June 6th. The Diamond Job Workers Association has also announced a vacation of 10 to 15 odd days, and this association, like I mentioned earlier, used to declare holidays only during Diwali seasons. Now, due to ongoing slowdown also in the past 2 years that the overall diamond industry has seen, vacations are now being observed in summer vacation as well, and so IGI could see lower volumes in terms of its Q2 numbers because they follow the calendar year in terms of certification volumes. Lastly, Wendt is in focus because Param Capital, that is owned by Mukul Agrawal, has bought 25,000 odd shares at 8479 a piece, and Siddharth Iyer has bought 10,000 odd shares at 8510 10 a piece. In terms of its overall subscription for offer for sale, was subscribed for around 2.54 times on base and 2.04 times with green shoe option. So these are the 3 stocks definitely to watch out for in trade today.
All right, what else to watch out for? I just want to pull up data patterns. We're going to be hearing from the management in just a bit, but 60% upside on revenue. The margins did see a bit of a fall, about 0.5% up right now in pre-open. Pull up Kalpataru projects, a good set of numbers, and that's showing, as you can see, in the pre-open rates. Zentech, we'll be speaking to them at 9:30 today. Another 5% on that stock. I mean, it's just consistently been showing that kind of a move. Borosil Renew not doing too badly. KRBL, another set of numbers that came in. Premier Energies as well, which was in our watch list because of numbers doing fine. BEL, of course, is ahead of numbers, but I'm talking about KRBL, and which has done fairly well, and Premier Energies also seeing a decent move over there ahead of numbers. Aditya, I'm just wondering, any of these real estate plays you would look at in a positive note, because they've kind of sat out, haven't they? Through the recent rally, which has been about metals, it's been about defense, and maybe a smattering of autos as well.
In the real estate space, particularly I like Godrej Properties. Their expansion into Bangalore and Delhi is now playing out. The company has raised a QIP where they paid off a lot of debt per se. So from my perspective, I would be focused on Godrej Properties per se. As interest rates continue to keep coming down over the period of this year and next year, it will be beneficial to the real estate sector. The second or the third pick could remain Oberoi Realty and Prestige Estates. Those 2 companies are also tending to do pretty well in their fields in Bombay and Bangalore per se. But overall positive view on the real estate sector. As the interest rates continue to keep coming down, it will be positive and demand will continue to drive in these sectors. You will have to bet on stronger plays per se, or not on the weaker plays.
Okay, time for a big brokerage call this morning, and Harsh Saita joining us. Harsh, I'm not surprised you have a defense stock on your radar, because once again, the first minute or so, 4-5 minutes of pre-open is showing us that defense is going to continue to be flavor, and hence your pick as well.
14% is what the Nifty Defense did last week. Just want to quickly mark that out. But yes, absolutely, Tamanna. So hence defense flavor, at least of the last fortnight or so. Let me talk about HAL a little bit, because Jefferies has sharply increased the target price on a HAL. The target price now stands at 6,475, giving a very healthy 33% upside even from these levels. Strong revenue visibility. Let me start off with the top line. Order book at 1.9 lakh crore, 6 times FY25 revenue, 2.5 lakh crore in terms of pipeline over the next 3 to 4 years, the bid pipeline, and therefore you'll likely see that order book remaining robust. High margin incomes currently supporting the numbers. Service income as well as aircraft deliveries should continue to support margins going forward as well. This could drive a double-digit revenue growth for the next 3 to 5 years is what Jefferies is penciling in. EBITDA was 4% above expectations for Q4 alone. But when you're looking at overall EBITDA guidance, you're expecting the sustainable margin number to be between 30 to 31% as per management guidance. Cost optimization continues to be in focus. Positive operating leverage likely to continue to kick through as per Jefferies, and FY25 margins, which rose around 300 odd basis points, lies in that 31% kind of bracket. So positive with regard to margin commentary. The 8 to 10% FY26 top line growth guidance looks conservative as per Jefferies. The recent India-Pakistan tensions, as well as everything that's happening in terms of geopolitics, the shift that Europe is going to be spending on defense, all of those should aid HAL. In fact, the growth, the absolute global growth in defense was at 9.5%, which is the highest since the Cold War. All of those aiding HAL. They've hiked the multiple on HAL and hence the target price from 30 times to 40 times. They've also increased the EPS by 3% for FY26 and FY27.
Okay, so Kush, I know that you specifically said that you expect there to be a little bit of consolidation in the banking space, but I'm wondering from the PSU pack whether you see any opportunities, because the bank index as a whole was up only about 3.2% at a time when the market as a whole was doing well. But some of those PSU banks stood out.
Well, Alex, that was more of a short covering rally. If you see, a lot of PSU names hadn't really participated. So other than, an SBI or maybe even a Canara Bank, most of these names don't really make the cut. And even though I have been positive on the banking names, for the last month and a half, maybe a little longer as well, PSU banks never really made that kind of a cut. It was largely the heavyweights, which is HDFC, ICICI, and in the PSU names, you've got SBI. So these are the stocks that I'd still prefer to stick to. But if someone does have a preference towards the PSU names, then yes, Canara Bank has given a good breakout. At least on the weekly setup, if you see, there's been a very good up move. Bit of a resistance near the 110 mark. There is call congestion also, technical resistance also coming in. But once it takes that level out, I think you're seeing a good up move to 114, 117 levels also, with a support coming in at 104. So Canara Bank is something that you want to keep on your radar from the PSU pack.
Okay. Let's also talk about delivery. In case we haven't marked it out yet, the pre-open session coming to a close, the stock is up as much as 5% or thereabouts. Aditya, I'm wondering if you've looked at the numbers. We pointed that out earlier on in the day as well. Looked good. Would you buy into this count at this juncture?
Alex, I would avoid this counter, even though the results have been great. The profitability path for delivery is long, and I believe that investors need to be really very patient on this one. So rather than looking at this startup per se, I would look at likes of Zomato, Swiggy, or to that extent even Nykaa as well. I would tend to avoid delivery at this stage.
Just to understand that, relatively, actually, delivery numbers look better, just optically, than some of the others that you've described, Aditya. In fact, a rarity in platform companies to show at least, some strength on the balance sheet.
So, if you look at Zomato's number, even though the food delivery business was really not doing that great with respect to growth, I believe that over the period of next 2 to 3 years, it is a duopoly, both Swiggy and Zomato will continue to do exceptionally well. A lot of competition is there within the delivery space. So I believe that even though the results have been good this quarter, over a period of next 3-4 years, the competition will make sure that the growth is not as good as you will see within the food delivery space. So food deliveries, I'm very positive on the food delivery space, less so on the likes of delivery bus.
Yeah, it's interesting because, very low moat for an Eternal. I mean, they're in a spending race with Swiggy. Delivery on the other side doesn't have too many listed peers as competition at that scale. I don't know. What do you make of delivery? Too little data to look at on the charts?
No, I mean, from a near-term perspective, I think we've got enough and more. At the moment, if I had a position in delivery, I would actually look to book profits partially. The reason being that it's now coming up at resistances, which are close to the 338 and the 200-day moving average of 343. So I think there'll be some supply zone that will come in because we've seen the stock tank from about 400 levels. Mid-December up until very recently. It's only about a month and a half that the stock has started to move up. So some supply pressures are imminent. So around the 340 mark, it'll be a good idea to book profits, if not fully, at least partially. Any fresh positions above the 343, 345 zone can be considered.
Okay. Aditya, quick view on some of the chemical names that we've seen numbers for so far. And we've broadly seen a few, or rather quite a few instances of margin expansion. Are you bullish based on what you've seen so far?
Large chemical companies have reported really very good set of numbers. You take an SRF, you take a Navin Chlorine, you take a Vinati Organics. All of these companies have reported a very good set of numbers. To take an instance, SRF's chemical business was up 30% with a solid margin that the company has posted. So in my opinion, what is happening really is stronger companies are posting a recovery really very fast, while the smaller companies will take time to recover. I believe that the bottoming out of the sector has really happened over the last 6 to 12 months. And as I had already said that by the end of this year or early next year, you will see blanket-wise growth coming into this sector. So I'm positive on this sector. You should stick to larger companies such as a Navin Chlorine or a Deepak Nitrite where the businesses have a strong moat and they will continue to do exceptionally well, even though the margins are really very tapered down.
Expect a bit of pain on IT today. You're seeing that from the pre-open session, and where Infosys has ended, Persistent Systems has ended. Again, another winner last week was IT. Credit Access, Grameen, after that howler of set of numbers, is looking like it's in for pain. Yes, they might be the darkest night before the dawn, but when you're in the darkest night, then it is bleak. There's really no other way around it. Vodafone seeing some more pain. Remember, their petition will be in the Supreme Court today. Bharti Airtel has also joined in to ask for AGR relief. Aditya, you have some interesting views there on Vodafone.
So for Vodafone, apart from the AGR, the problem really is that the debt that the company has taken, the subscriber loss is not able to service the debt that the company has really taken. Even though the government waives off, or the Supreme Court by chance waives off the AGR dues, the problem really is that the company is continuously over the last 24 to 36 months losing subscribers. The company is unable to invest in the 5G space, and on top of it, operational losses are coming about for the company. So really, the long-term solution to Vodafone Idea is what Tata did to Tata Docomo. It took away the liability and then sold down the business or closed down the business. Similarly, within the Vodafone business, the only solution to Vodafone Idea is that Birlas have to take on the liability, which is a massive liability of 2.36 lakh crores, and then try to sell off Vodafone Idea or close it down per se. But net, even if this relief comes in, I don't think that Vodafone has the power to survive. It is just like kicking the can down the road. And now, 12 months or 24 months after, again, the same problem that Vodafone Idea does not have any liquidity to survive per se. So difficult one. And I believe investors should stay out of it.
I agree. It's a sinkhole. It's a sinkhole, and it's what only thing that's going to keep it up is the government's will to not have a duopoly. All right. First, calls hitting on the Monday morning, which is looking like a consolidation phase. Don't be dismayed by seeing this. This is good because you've seen such a mighty run up all of last week. A little bit of froth needs to be taken off the table. This is not even froth. This is a very quiet kind of a start. Nifty IT is where you're seeing the pain point, and this is something we talked about, where you're going to see pain in Nifty IT. I mean, there's no stopping Nifty India Defense as a sectoral index completely roaring ahead of numbers from Bharat Electronics. Expect some excitement there as well. Maybe that's part of it. Zentech has come out with fabulous numbers. Cochin Shipyard was good last week. HAL has seen an upgrade. So, which is why perhaps let's pull up the components of the Nifty Defense just to see if any of those are actually doing as well as we're talking about before we get to the heat map. All right, data patterns. Stellar set of numbers. 60% up on revenues. 8% up. You're going to hear from the management right here on NDTV Profit. Cochin Shipyard 7.5% up. I mean, this is insane, the kind of up move that you're seeing in defense stocks. Third week running, I think. Yeah, about 2.5 weeks at least, at the very least, running. Zentech again on a 5% circuit. Garden Reach, Astromicro, everything really doing very well over there. Let's pull up the Nifty heat map before Alex comes in to give you what's happening in the broader market. So just pull up the Nifty heat map there. Ahead of numbers, Bharat Electronic looking really good. JSW Steel, the metal space showing some signs of action even today. So JSW Steel, NTPC, all of them looking fine. Autos not really roaring, but doing okay. Bajaj Auto, Tata Motors continuing from last week as a theme as well. Everything else kind of middling. On the losing side, you're seeing a break being taken by IT. Remember, what was boosting IT stocks was the fact that US and China had made amends on the trade deal, but this downgrade to the American economy by Moody's might be giving it a bit of jitter. So TCS, Infosys, HCL Tech among your top losers over there. IndusInd Bank ahead of numbers, and too many problems, too many, it's like a can of worms right now. So too many things coming out every single day. So IndusInd Bank, wait for more pain, some notes on it out as well today. So that's largely the picture, not half bad. BEL continues to shine, Alex, and that theme is showing no signs of giving way.
Oh, you said it. The defense pack as a whole, once again, the star of the show. so far. But there could be other stocks from the broader markets and reacting to earnings that you should watch out for. And certainly there are. So let's pull up some of them. Divi's Laboratories, we spoke about this. Best margins in 11 quarters. What is the street looking at? And certainly it's a stock to watch at the start today. 2.5% or thereabouts gains. India Glycol not reacting to strong numbers. Down about 1% or so, but it might just change tone and tenor later on in the session. Already off the low point of the day, down about 0.6% or so, but it is a little choppy. Gujarat Alkalis, on the other hand, Neeraj pointed this out, the margin picture expanding quite substantially, nearly 800 basis points or thereabouts, and other income, of course, helping with the bottom line, but certainly something that is reacting positively in trade on account of operational improvements. What else is standing out? Let's look at Kalpataru Projects, because there's a 37% growth in the PAT number. It's up about 2% thereabouts. Zentech reacting to strong top line and margin growth from the defense pack. Everything that you hit with a dart in the dark is moving up in the defense pack right now. But do approach that with caution. Remember, Kush has talked about taking 50% of your gains off the table, if at all. Premier Energies, several updates here. Capacity expansion, strong order pipeline. The stock is up about 1.5%, maybe 2% or thereabouts. It also signed 2 joint ventures. This is with Nuvisol Energy and with Taiwan-based Sino-American Silicon Products. The stock is reacting positive to those developments. KC International, there is an order win here and it is gaining quite considerably on the back of that. The order win is to the extent of 1,113 crore rupees or thereabouts. The stock is up 4%. Tube Investment also reacting positively to a contract win to supply train sets for a project with a business potential of about 1,000 crore rupees. Another stock that you should watch on the upside, gaining about 3% or thereabouts at this point. Back to earnings data patterns, strong set of numbers. We pointed this out and it's gaining as much as 7%. Delivery, look at that. It's gaining even more from the pre-open session where it was about 5% higher, now about 7.5% on the back of strong set of numbers. KRBL also reacting to a strong margin expansion. It is up as much as 6% at this point. Eris Life Sciences, just winding down the list. Investec has initiated a buy with a target price of 1,880. That's an upside potential about 29%, now more so because the stock is down about 2.5% or thereabouts. And finally, Protean. This is a stock that you should watch out for on the, oh my God, look at that. It's reacting obviously to the fact that it has not been selected by the Income Tax Department for its PAN systems, and the stock taking a bit of a beating to say the very least. So strong moves both on the downside and on the upside, Neeraj, to key developments. Some unexpected, but most of them expected.
I mean, a bit, as you, Alex, as you yourself have said, is an understatement when it comes to Protea and EGOP. Very, very sharp downtick out there. On the flip side, very sharp uptick to Banco products. It's a stock that we highlighted in the trade setup as having good numbers. Look at that reaction, 20% higher for that one. So really strong move for that one. We've seen some gains for HCL Info yet again. Now, somebody knows something about HCL and Foxconn's tie-up and HCL Info being a potential beneficiary there, because it's the 6th day on a trot that this stock is locked on an upper circuit, 6th or 5th, what have you. But it's been locked on an upper circuit for the last 4 or 5 days at the very least. So keep an eye out for that one. Some strength in nuclear software yet again after the phenomenal set of numbers that it came out last week. Precision Wires, good numbers, up about 7%. You know, the thing with delivery, I think that Alex spoke about it. Maybe the street believes that it's moving to a different orbit when it comes to margins, as a result of which that 6.5% uptick. Just very quickly, aside of Protea and EGOP, what has not done well? Gujarat Ambuja Exports, weak numbers, down 7%. Credit Access, weak numbers, down 5%. Bharat Bijli, down about 8%. So watch out for 2 or 3 of these names. But Kush Boda, initial thoughts on anything that might be showing a very sharp reaction, if not the benchmark indices. And I don't know if we spoke about Adani Enterprises or no, I'll slip that in.
I don't think we did speak about Adani Enterprises, but just to complete that conversation, there has been good accumulation over the last week or so. That is also backed by good price action. I think the only hurdle now will remain the 200-day moving average, which comes close to the 26-25 mark. But other than that, while the trend, if you look at for the last 2 to about 3 months was positive, the one thing that was missing was actually the volume action, and that has now started to pick up. At least for the last week, that has been very healthy. So if you have positions, you should continue to hold. If not, then I would suggest wait, because 26-25, 200 moving average resistance, the stock is coming out of a consolidation. There could be a bit of a resistance there. So risk reward ratio will not be favorable. But if you did have a position, then the stock is starting to move up now. You could very well continue holding on to this one with a stop loss around the 2500 mark. Now, indices fairly in line, in fact, slightly positive compared to what GIFT Nifty was suggesting, at least on the Nifty. We'll take that action, especially because this allows the SMID, segment of the market to do well. One segment that I wanted to highlight, Neeraj, and you already mentioned it, the wires space was actually doing very well over the last week. Precision, now that you've highlighted, is up because of the results. But if you look at something like, Ram Ratan wires also, it's up today about 1% or so. But what's interesting is the volume and the accumulation that we saw over the last week. The volumes were fairly high. So this is one area that I want to keep,
wire companies.
The wire companies.
So Precision Wires
and Ram Ratan Wires. These are the
both.
two. Bharat Wires also. It's just that, it's not given that breakout today, or rather a follow through today. So slightly muted. But yeah, these are some of the stocks and the segment in general that you want to keep on your radar.
Sharp moves there for some of those for sure. Okay. Aditya, I don't know if we got a chance to speak about Divi's, but a very strong move, has done well, and goes with the line that CDMO API companies have done rather well in this quarter, save for 1 or 2 exceptions. What within this bucket looks good, if we have already spoken about Divi's?
Within the CDMO space, Piramal Pharma looks really very interesting. Syngene, for that matter, has seen a lot of correction. The valuation still there is expensive, but the quality of the company means Syngene will do exceptionally well. Lot of out of haters of about 2 to 3 years, where people hated the stock per se. I believe the seeds have now been laid down for a good growth over the period of next 2 to 3 years. So within the pharma pack, rather than going to the generic space, I would look at the CDMO space, which looks really very interesting, and companies are investing heavily there. At the top of this pack, of course, continues to be Divi's Labs. Exceptional company, exceptional mode that the company is really got. And hard to imagine a company operating at about 30 to 40% margin consistently over a longer period of time. So exceptional company is an all-weather company and should be inside your portfolio.
Okay, so Divi's should always be inside your portfolio. Let's look at some of the other winners today and how they're moving up. Kush, what are you spotting apart from the very obvious defense kind of a story? Other opportunities that you're looking at where positions can be built today?
So, why not just come back to the stocks that we discussed at open. EPL, 245 was the first target. It's fairly close to that. So, if you've got a very early position, then perhaps you could continue holding on. But I'm assuming that a lot of viewers might not have, because it opened with a gap and then went from strength to strength. But on the flip side, HDFC AMC, the other stock that we discussed for targets of 4900 and 5025, that is gradually inching up. A fairly large name, good accumulation, weekly basis. The last couple of weeks have been very interesting on this one. So I would continue with the likes of HDFC, AMC. Maybe now you could bump up the stop loss from 4600 to about 4650 thereabouts. But the second target of 5025 still very much in play.
Okay. I also pointed out that the broader markets once again doing better than the benchmark and gaining ground. Small cap index up about 0.8%. And the market breadth looking very healthy. But Titagar Rail stands out to me this morning, and it's gaining quite considerably. Kush, anything that you're spotting there? Yeah, quite considerably. 5.5% or thereabouts. So upside potential from this stage?
Very much. In fact, if you see some of these rail names, despite the kind of sharp moves that they had in the last week, nowhere close to overheated territories, volumes jumping up quite a bit, key resistance levels taken out. I'll add, one more name, Texmaco Rail, to that list. All of them doing rather well. And we know that, this is coming off a very long period of consolidation with a major negative bias. So I think this rally is starting again. What you could do now is, if you don't have a position, you could still very much consider entering some of these names and the erstwhile resistances. So that for a Titagar wagon comes close to the 850 mark, for something like a Tex Rail comes to 155 zones. So with those levels as your stop loss, you could enter these names once again. They may not have the same momentum and the same push as the defense names, but the rally is now starting to emerge and the momentum is starting to pick up. So you might want to be at the start of the rally. You might want to catch these at the start of the rally. So yeah, these are some of the names that I have on my radar and the stop losses that you could follow.
Okay, I mean, the real stars of the day are, look at the data patterns stock. Look at the Zentek stock. Data patterns about 8% up. 9% up almost. You're going to be hearing from the management after this very short break. Meanwhile, Aditya, great to have you on. Kush, great to have you on. Both our analysts, remember, in part one of the show have said that if you are holding these positions, have seen a huge profit, time to book. I don't know if anyone is going to have the guts to do that right now. Very short break. On the other side, you're going to hear from Zentek. You're going to hear from data patterns. Full focus on the hottest stocks this morning. Stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
India market open. The focus this morning continues to be defense stocks, and let's talk about Zentek. Zentek is up another 5% after reporting strong fourth quarter earnings. Company surpassed its FY25 revenue guidance and strong revenue growth in Q4. We're speaking with Ashok Atluri in just a minute from now, but let's bring in Anushi, who tracks the sector, for a quick setup on what has worked in the numbers. Anushi.
Well, it's a strong growth number that we are looking for Zen Technologies. Revenue up over 2.3 times, margins stood at 42.5% as compared to 36%, and net profit also about a 2.8 times of a jump that we are looking at. Now with this, if you take the FY25 consolidated performance in view, we've surpassed the FY25 guidance of rupees 900 crore revenue by 8% or so, and met their EBITDA in fact beat the EBITDA margin target of 35% and PAT margin of 25%. Now considering the order book positioning, here the focus would be main considering this happened with this Operation Sindoor, what could be the order prospect pipeline going forward. If you talk about the order book, that stood at about 692 crores. This is as of March end we are looking at. So this takes the FY25 book to bill ratio below 1 times level. So how this is expected to improve going forward is something we should be watching out for, because in the first quarter there is a huge pipeline of opportunities that the company had earlier pointed out. So How this would be executed in the current year is something that we need to be seeing. If you look at the order book mix, training simulators about 73% mix, anti-drone systems 27%. They've had a couple of key acquisitions also and are on watch out for new acquisitions as well. They acquired Applied Research International Private Limited to expand their presence in naval and maritime verticals, acquired a 51% stake in Vector Techniques Private Limited as well to mark their entry into the, for better entry into the drone ecosystem. They also acquired 45% stake in Bhairav Robotics Private for fast-tracking the entry into defense robotics. So, a lot of key areas that the company now wants to focus on. Now, again, this is in line with the 50% of a CAGR growth they are targeting for next 3 years. So, product portfolio expansion is something that we should be watching out for, along with inorganic growth opportunities. Expansion in this space is what the company is seeing. So, this is the overall view for Zentech. Overall, a strong set of results that we are looking at.
In fact, let's take some of those points to Ashok Atluri, CMD, Zen Technology. It's great to speak with you once again, Mr. Atluri, and thank you for your time to us here at NDTV Profit on what has been a stellar quarter. You've beaten your guidance. In fact, you've surpassed your FY25 revenue guidance. Let me start with your margin number at 42.5%. Is this the new normal for you going ahead?
No, not at all. It would be around 35%. I think, we got some good export orders. We had good margins there. But overall, I think 35 is an ambitious target that we have set ourselves. And we expect that, in the years to come, that would be something that we'll try to achieve.
Just give us a sense of what has happened post-Operation Sindoor. And, we've spoken earlier on this channel on the immense contribution of Indian companies like Zentech to Operation Sindoor. We've seen your work actually in action. It's gone from theory to practical. What has been the impact that you're seeing or expect to see on your order book going ahead?
So, the Indian Army has been always focused on buying from companies that have developed indigenous IP, indigenous R&D they have done and built the products. So that is where Zen comes out top in the anti-drone systems. Where again in 23 there are 2 tenders floated. In both the tenders, Zen was the single vendor because they needed something very broad, better specifications than anyone had till date. So we were resultant single vendor there. Based on that, it was very gratifying to see that the products that were used and they really did very well in the recent operations. And we have got really positive feedback from those on the ground. What we also got with the interaction with the armed forces is that there's a huge requirement and there will be acceleration of the products that have been proven in the field. So that's very gratifying, Tamanna. I think we look forward to government's next action, and we really feel so good that we were right there in the thick of the action, and our products proved very useful.
Fantastic. And, congratulations to you for that, because an indigenous company right there in an operation which has been so tremendously successful. Just trying to understand, Mr. Atluri, if the kind of products that you provide and anti-drone systems that you provide, would there be a need for replacement at this point, or would you expect a bulking up of orders?
So we do think that there is a lot of requirement. There are two stages. The first stage is scaling up to the complete requirement of the armed forces. That scaling, they have just bought a part of the requirement, and the scaling up has to happen so that all the complete requirement is bought. After that, typically what happens is Zen Technologies, after a year or two, we start generating annual maintenance contracts till the life cycle of 10 years is over. And post the 10th year, they have to replenish they have to replace the equipment with fresh purchase of the same equipment. So that's the cycle way it's going to go. So they have to just scale up, first fulfill the existing requirement, and then they move to the next stage. Tamanna, I hope I answered your question.
Yep, I think you did. Mr. Atluri, good morning. Neeraj joining in the conversation as well. And firstly, thank you for making such amazing products. And it was lovely to hear your comment on Tamanna's earlier interview, wherein you said that there was a scuffle in your office for people wanting to go to the front lines to help the armed forces. It's quite the sentiment that the nation had. So kudos on that. I have a couple of questions, sir. Firstly, it's quite something to see a company guide to doing 2x what they have done in the previous year as a guidance in the corresponding 12 months. Is this, but you know, the current order book may not show that, but I'm presuming you believe order inflows will make up for it. Is execution going to be as possible to enable you to do a sum of 2,000 crores which you're guiding for FY26?
No, FY26 we have said about what we have guided Neeraj is this, that for the next 3 years on an average the CAGR would be 50%.
Okay.
So that means to say so what we are saying is cumulatively over the next 3 years we should do a little more than 6,000 crores. So it will not be really linear kind of 50%, but overall so that we still feel confident about. We do feel that due to the delay in orders this year may be a bit muted. But we are very, very positive about the next 2 years.
Okay, so when you say muted, roughly relative to 925 crores that you may have done in FY25, you could probably maintain that number you are saying for FY26.
So I think we should probably may be around that figure. But till we get the order book position till till by the H1 end of H1, we will be able to more securely give the guidance on that.
Okay, fair call. So maybe we'll try and get some actual numbers on the guidance once you're in a position to be able to give it. Fair call, Mr. Atluri. The second question that one might have is that, yes, the sales, etc. have been good. Are receivables looking solid? And for a lot of you, I believe, Q4 might show bunched up receivables because a lot of execution might have happened in Q4, but the payments will come with a bit of a lag naturally so. So are receivables going to be an issue, Mr. Atluri? Or do you believe cash flow situation will ease out as the year goes by? Some color on that?
So we think the cash working capital cycle will come down to about 120 days, and the cash flow will improve significantly as we go. As you rightly guessed, the orders were received towards the executed towards the end of the year, so the receivables got bunched up towards the end.
Okay, so sorry, just the clarity before I hand it over to Tamanna again. 120 days it comes down to. What's the current receivable days, sir?
About 160.
Oh, from 160 to 120. Okay, fair call. Tamanna?
Okay. Now, just want to know about your order book for Q1. You've penciled in about 800 crores. Are you looking to meet it, surpass it, or be a little below? What is the picture looking like right now?
So we are out of the 800, we have got 150, Tamanna, and we expect another 650 crores. I think by H1 we should be getting the whole thing and some more because of the current activity that the government is going on. They have given a deadline of 40-45 days to start placing the orders. So I think the overall order we'll come to know maybe in another few weeks the exact position. But given the feel on the ground, we think these guys are going to be huge.
So just that point you made, by H1 we should get the whole thing. Are you saying, what is the whole thing? Are you saying that you should hit your target for the year by H1?
Yeah, no, the order book position should be built up by the end of H1.
Okay.
And any special new orders would be added to that, and then we'll get a clarity what would be the total execution during the current financial year.
Okay, just one last point, Mr. Atluri, and that is on your inorganic growth. You've had a lot of acquisitions and very strategic acquisitions to enter into new verticals. Like you're going from land to naval, marine, etc. From anti-drone, you're also looking at drone systems. Are you looking at building on that inorganic acquisition in this financial year?
So yes, we continue to look at acquisitions, Samanna, and we feel that there are some very good prospects which can integrate seamlessly with the company's strategic objectives. And yes, I think there will be a couple of more acquisitions, but we are not sure about the timeline or the quantum of the money that will be spent. But probably this should happen in this financial year.
Mr. Atluri, 2 or 3 questions, sir. One, there is this emergency procurement of 40,000 crores approved on Friday by the DAC, right? Does this include orders for anti-drone, drone systems, or any of the products that you might be making?
Yeah, we are very sure. We feel very certain that it includes requirement which partly then will be contributing to it.
Got it, sir. Okay. The two other questions, sir. You acquired AI Turing last year as well. I believe that's helped in the anti-drone simulation systems for you. A word on the technological edge that you might be having, because I don't remember it correctly or completely perfectly, but I remember you telling me that in some of the bids that you are putting in, you are probably the only bidder because of the technological specs that you own versus some of the other companies not owning. This was sometime 6 or 9 months ago. Just a bit on the stuff that you're doing around AI, technology, which might help you quite well.
We have done R&D not to win tenders, Neeraj. We have always said, how would India win a war if war were to happen? And our R&D has been directed towards that. And one of the things that we did, was building anti-drone systems with wideband, basically wideband or band independence. It means that, while all the other anti-drone manufacturers were focused on neutralizing commercial DJI kind of drones at 2.4 megahertz and or 2.4 gigahertz or 5.8 gigahertz, we knew that, when the terrorist or the enemy comes, they will not follow the government guidelines on commercial frequencies. They'll come with anything. So that is what we prepared our anti-drone system to be able to do. So this is exactly what happened in the real situation, that they came in non-commercial bands and our systems were able to neutralize them. So yes, because we are spending the R&D money to solve real problems, we typically have happened to be the single vendors in many situations where others are not able to do. So, and the acquisition of AI Turing that you were talking about, they actually made remote control weapon station where human in the loop is removed and the anti-drone system can be connected to hard kill systems like shooting down the drones, and so we connect with them. And so this has become a complete offering. Earlier, we were very strong in the area of soft kill. With AI Turing acquisition, hard kill has been coming within our reach. But the good part is AI Turing's equipment can be sold independently of the anti-drone systems also. We are seeing a lot of demand where unmanned, the weapon systems are required. They are being asked to come and demonstrate. So I think that was a fantastic, synergistic, and even otherwise a good acquisition.
One last question, Mr. Atluri, from my end. What about the export opportunity? I mean, does this, as sad as it may be, because we don't like loss of lives, but had to be done, but does this open up export opportunities meaningfully? Are you already sensing incoming interest for your products from global companies?
After this thing, we have got a lot of export inquiries. After the recent operation by the Indian government, there are a lot of foreign countries. They approached us and they are very keen to discuss about procuring the system from us. Very initial stage because it happened very recently, but this looks very, very encouraging to us.
I think Tamanna, me and the entire team at NDTV Profit wishes you all the best, Mr. Atluri, for a lovely FY26 and beyond. Thank you so much for taking the time out and speaking to us today.
Absolutely. And on the other side, look at another one of India's defense companies. I'm just loving this segment where we're getting to see a deep dive of Zentech and Data Patterns, another one whose stock is on fire. The conversation with the CMD of Data Patterns after this break.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Well, Data Patterns is the other stock in focus, and they come out with numbers which were reasonably good. The stock has come off maybe because of a bit of a margin disappointment, but we spoke to Mr. Srinivasa Gopalan Rangarajan, Chairman and Managing Director of Data Patterns. Listen into a slice of the conversation that I had with him. How would you sum up your second half performance, sir? Because you've done exceptionally well on the revenue front, beaten guidance all through. The operational metrics maybe leave a bit to be desired.
We had projected 20% bottom line growth and 25% top line growth last year. I think we met our guidance. And also, if you had been following, we had taken a couple of large contracts, complete radars, year before last. And this gives us capability building. So we've taken it at a very low margin, but that is necessary because the company has to build a lot of competence and capabilities going ahead to build complete systems. So knowingly that we had taken contracts, and that is what is reflected in the last quarter. The margin which you're talking about is lower than a normal margin. But we had compensated with the rest of the contracts to ensure that our guidance is protected.
Yeah, no, okay. And as I said at the start, you met the guidance for sure on the margins front. So I hear you say, sir, that you entered into a couple of these contracts which were necessary to build capabilities as well. Tell us a bit about that and tell us how does this augur for, let's say, the next 2 or 3 years as you build out some capabilities and as maybe order inflow improves as well?
See, what we have done is, India is going through a phase of looking inwards. The government is fully supporting Make in India. But, all along, we have been importing products from abroad and relying on foreign OEMs to supply defense equipment. So it is a large opportunity for Indian world-class systems to address the gap which is there in the market. What we have done is we've invested heavily in product development in the last 1.5 years. We went for a QIP and raised about 500 crores. We are spending the money to build radars, fire control radars, EW suites, communication equipment, seekers, a whole range of systems with local IP and building world-class products. Second, we are also building the required infrastructure. In the event that the contracts happen, we should be ready to deliver on the large opportunities. Third, we have now raised our engineering staff strength to nearly 1,100 people. We still continue to raise people, recruit people, and build competencies to see that we can go ahead in building Indian products as required to address the large opportunities. We're very bullish on the opportunities going ahead, and we're investing against those opportunities. This is what we're doing. So looking at the last year versus this year, we still retain the guidance of 20-25% top line and bottom line growth. The contract situation on the orders and position is a bit weak, as you said, but that has been delayed for no reason of ours. But this is all happening. We are now expecting a number of contracts to happen in the course of this year. One, on whatever we delivered products, which is getting repeated, and completed trials, we expect the contracts to happen. Two, also because of the existing skirmishes in the border, there is some amount of fast tracking of contracts is expected. So we are very bullish on the growth opportunities of Data Patterns.
Mr. Rangarajan, in the Q3 con call, you had spoken about how you are targeting 2,000 to 3,000 crores of new orders over the next 18 months. Maybe some spillovers from Q4 might happen in Q1 as well. So is there some color that you can give on what is the nature of the order inflows? Do you expect them to be front-ended in the current financial year or back-ended? Some numbers that we can work with?
See, there are some delivery delays. Though the products were ready, the offtake did not take place. Still, some of the contracts are not, we still have the products. The offtake is yet to take place probably this quarter, next quarter. But besides that, the number of contracts which you worked on earlier and the production orders are happening this year. I don't know whether I can give the flavor of the contracts because we don't want to talk about contracts which is expected and in an open forum. But this is largely in radars, EW, seekers. These are the areas, and avionics. These are areas where we expect contracts to happen this year.
Got it. By the way, with the presumption out here, and I do not want you to comment on this, Mr. Rangarajan, but with the presumption that some of your products might have been used in the recent times, you and some of your peers have made the nation proud. So kudos on that, sir. One quick follow-up that I must have then to your first answer, wherein you said that you accepted some of those lower margin contracts to build out capabilities. Have those contracts been executed completely, and therefore can the margins move higher from what you've done as an average in FY25?
We've delivered on the contracts. There are various stages of acceptance and installation. But what we've done is we've built building blocks and capability. This capability can be either used to address opportunities in the same field, same products to be expanded, or it can also be used in building other systems which we are addressing. We are looking at in the coming years. So I can't say that this will happen. Whether the contracts will happen. We did plan that this will get repeated in large volumes tomorrow, but that is not in our control. But the capability building will be definitely with us, and that will will go a long way in building in addressing the large opportunity ahead of us.
Okay, so I'm presuming that when you're saying that top line and bottom line growth could both be about 20-25%, margins will be stable in FY26 relative to FY25. We'll not see a material decrease, but we'll not see a material increase either.
We don't expect material decrease. We'll be happy with material increase. Let me say that.
Okay, fair call. One question that most people have for companies like yours, which are doing a lot of this work, is around receivables. How is the receivable positions? I do believe there is some increase in the trade receivables this year. So how do cash flows pan out over the next 12 months to 18 months?
Okay. First thing is we're a debt-free company. We don't have any cash issues. We have nearly 400 crores in bank. Mm-hmm. So we are very well geared in the cash position to address large opportunities.
Sure.
Point number two, this year you see Q4 billing is more than 50% of the annual billing. So obviously that is appearing on the debtors list, which is slightly higher. Third, we're doing a lot of development, and the development contracts during installation acceptance and integration with the customer takes a bit of time. So the debtor days becomes extended. But this will all change in the next 2-3 years. This is what we've been saying. The more and more we start getting production orders and complete system orders, the data situation will improve and the working capital cycles will also improve. But today we are not really very worried about it. One, because we have cash on hand. Second is because the nature of the business is development oriented. Moment it changes into production, we should be good to go in terms of debtor days.
Okay, Mr. Rangarajan, the scenario has changed, wherein demand from India for Indian products, as you said, is up. I'm guessing that post all that's happened, I think the demand for Indian products globally might actually perk up relative to what it might have been. So I would love to know, sir, how do you see, how do I say, visibility? I'm sure you're confident for the course of the decade and maybe longer. I'm trying to understand the visibility that you might be sure of or positive upon or hopeful on. How long do you reckon that you can confidently say that next 3, 4, 5 years, next 2, 3 years, next 1 year, you are confident of visible growth, if you will?
We are confident of visible growth, both in India and abroad. The opportunities are very, very large in India. And what we're doing, 700 crores, 1,000 crores is a very, very small number compared to the opportunities lie ahead with us. Since we also develop products which has a total addressable market of more than 20-30,000 crores, I think a percentage of that should come to us because we're building world-class systems. So we believe that the opportunity is being large and that we are doing local IP augurs well for the company's growth, not just in 1 or 2 years, but I think going ahead. We should really do well, and we are very bullish on the opportunities and our capability to deliver against these opportunities. Also, last year we did a lot more exports to Europe, South Korea, as well as UK. We did more than about 15% of our overall revenue came from our products, a full complete products, which was delivered to a NATO nation. So this also is a good thing. We've started also looking at outside India, where the products developed in India is also exported. Whatever product we're developing for Indian market is also export worthy. So I think the opportunities are large, and we are really gearing ourselves in building world-class systems here.
You reckon it could be a decadal opportunity or longer, sir?
Definitely. This is not we've always been long-term. Our investment is in long-term. We are always looking at long-term and investing towards future. So the direction is very clear. The opportunity is a long-term. And what we are trying to manage is 20% bottom line growth is a short-term. We believe that in the longer term, we should do much better with new products coming out. And if it's accepted by the customers, then the opportunities are going to be very, very large.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
stars today that are shining in the market. The market as a whole, if you look at the key indices, if you look at the key indicators, will seem a little blah, for lack of a better word. The Nifty completely flat right now. I want to pull up the advanced decline ratio as well. IT stocks are suffering today in relative terms. Banks doing okay, everything is flat, but the advanced decline ratio is still okay. Look at how it's narrowed though in the last 15 odd minutes of trade. So that's showing some pain point. Nevertheless, quite a few winners there. And look at a graphite right now, Graphite India zooming. Look at a delivery. I mean, it was in our watch list this morning, but delivery on the back of numbers is something that the street is truly liking. You're seeing that stock nearly 10% up. Graphite's doing well. HEG, a smattering of rail stocks. Jupiter Wagons, RVNL, let's pull up some of those. Those are also doing fairly well. Divi's Lab is another one, back of numbers, having a good morning. So is Zentech, and we just heard from the management a short while ago as well on NDTV Profit. But another company that has posted results over the weekend, and you'll see some reaction today, is Amber Enterprises, which is in focus because of their Q4 earnings. They saw strong revenue growth, but margins remain flat. Do you think that's the reason, Puneet, that you're seeing not that much enthusiasm in the stock despite an overview of okay numbers?
Thank you for that. So definitely the both revenue as well as the EBITDA has grown in the same growth rate of 32 to 33%, and that's why the EBITDA margin percentage is largely flat, but profits have actually grown by 22% in this particular quarter. That's also very strong. Across the three divisions, we're seeing a 25% growth for the consumer division, 74% growth for electronics, which includes the PCB manufacturing, and the railway division largely been flat, something that the company is guided for as well. Now, we've seen the operating performance also very improved dramatically in the RAC segment as well as the traditional room air conditioner business for the company, which is the AC business, to simplify more. That has grown to 8.5% in margins from 8.1 earlier. They've also said that the conference call is actually on right now. So they mentioned a couple of key highlights that I'll just mention. They mentioned that they are finalizing a new land for their joint venture with Ascent Circuits, and that will be part of the new EMS scheme as well. They've also said that they are optimistic of 10 to 12% above industry average growth for the consumer business over the next 2 years, as well as mentioning that they are aiming to reach 10 to 12% EBITDA margin in the electronic business. That did only 6% margin. So overall, the next 2 years, they're expecting a high growth in this business. And finally, in terms under the new electronic component scheme, they're looking to invest 3,000 crores over the next 5 years, and 800 crores will be in this FY26 as well. So I think the market is digesting some of this information coming in thick and fast. We've been flashing it on the bottom of the screen as well. But overall, results largely in line with the growth estimates. And I think for next year, they are planning to invest a lot more under the new scheme, and that will help margins overall eventually in the medium term.
Okay. Another stock that is truly buzzing is Delivery. In focus, the stock nearly 11% up. Strong Q4 numbers is what has enthused the street. Mahima joining us with all the details.
Right. So I think what the street is actually enthused about is the kind of substantial margin expansion that has taken place for the counter. EBITDA was also a significant beat despite revenues not, revenues seeing a single-digit odd growth. And the part truckload business is something that has contributed significantly towards margins as well as the overall growth in terms of EBITDA. Express growth, however, express delivery growth has remained tepid. In terms of numbers, revenue growth was at 5.6%. EBITDA stood at 119 crores versus that of 45 crores. So it's almost more than doubled. For margins, they expanded to 5.4% versus that of 2.2%, and net profits stood at 72.6 crores versus that of loss of 68 crores. So the company is also, turned into profitability versus loss last quarter 4 FY24. Now, in terms of what has led to growth, part truck volumes were up almost 19%, and it was up 24% in terms of its revenues. Express delivery margins have also improved, and this is due to mid-mile utilizations improvement. Freight handling margins have improved due to lower contractual manpower as well as line haul expenses. In terms of what brokerages are penciling in for this particular counter, Goldman Sachs has maintained neutral but hiked the target price to 325 from 290. What they're saying is that margin sustenance over the next few quarters would be a critical thing to watch out for the stock performance. Morgan Stanley has also maintained equal weight and with a target price of 320. What they're saying is that express parcel volumes and yields were lower than estimated, but the overall part truckload business revenue did beat versus estimates. And lastly, other business performance was also a miss in terms of what the street was expecting or what they were expecting. So this is the overall view as to what has worked for delivery.
Okay, definitely, despite valuations and of course those margins continuing will be a big question, but Delivery having a great day on the street today. Stay on with us, Mahima, because we also want to talk about ABFRL. Aditya Birla Fashion and Retail is poised for a demerger, record date of May 22nd and a 1:1 share ratio, creating lifestyle brands. Give us more details.
So as you rightly mentioned, the record date for the demerger of Aditya Birla Lifestyle and Aditya Birla Brand Lifestyle will be on 22nd of May, and the ratio is 1:1. Now the resulting company, that is Aditya Birla Lifestyle Brands Limited, will be the in-house Madura Fashions Limited, which holds brands like Louis Philippe, Van Heusen, Alan Solly as well as Peter England. Now in terms of how the financials stand at present in terms of these two companies, the brand lifestyle business almost contributes 53% to the overall Aditya Birla Fashion company, and how are streets expecting this in terms of valuations as well as the expectations as to how the share price will evolve. IIFL is penciling in 82 rupees share for ABFRL, and for Brands Limited they are expecting share price to be at around 179. In terms of EV to EBITDA, because the company is right now in loss making, we are taking valuations as EV to EBITDA, and it stands at around 11.9 times. In terms of guidance, strong guidance given by management for both of these companies. For Aditya Birla Brands Limited, management is targeting a 13% revenue CAGR over FY30, and they're targeting margin expansion of around 300 basis points to almost 11%. They're targeting an ROCE also of 70% plus in FY30. For Aditya Birla Retail, they are targeting a 20% revenue CAGR over FY25 to 30, and they're expecting margin expansion to around 7% versus loss right now, and ROCE is expected at 18% plus in FY30. plus they'll also be raising funds post the demerger, that is the retail segment, and this could be up to almost 2,500 crores. So all of these details are significant to watch out for before the company gets demerged on 22nd of May.
Okay, Mahima, thanks a lot for that. 6% higher for this one. Now, what is also high in trade today is Bajaj Auto. Let's pull that stock up because Bajaj Auto International Holdings has taken a loan. It's a 5,000 crore loan, of course, with a consortium of banks ahead of the KTM buyout. Tushar Johnson should tell us more. Is this I mean, how relevant is this to the near-term implications, Tushar, for Bajaj Auto?
Good morning, Neeraj. So this is essentially the latest step that Bajaj Auto has taken towards funding, so to speak, the restructuring of KTM. Remember, KTM actually went for bankruptcy in November last year. Since then, Bajaj has quietly invested certain amounts in the company since then. Remember, the Bajaj owns about 49.9% stake in KTM, and its bankruptcy does not work to its advantage. Production was stopped last year. It actually is moving on very slowly in Austria right now. So initially, the company actually, Bajaj Auto Limited, invested about, I think, about 150 million euros in Bajaj Auto International Holdings. That was in February. A second tranche was invested just a couple of, actually last week at about 125 million euros. In between, the company, Bajaj Auto International Holdings, has slowly, actually, literally dropped some cash into KTM about 4 times. About 50 million euros have been invested into KTM AG 4 times between February and May right now. Now, the company has picked up about 566 million euros of unsecured loan from 3 banks. That ahead of a KTM restructuring deadline, which is on the 23rd of May. That amount is 548 million euros. So it's no consequence, or actually not a coincidence, that the amount are very similar. Bajaj Auto has still not said whether they will acquire KTM. Remember, acquiring KTM will give it a good foothold in Europe, especially when we are increasing exports from India to other parts of the world, both in the car as well as two-wheeler space. Also, KTM is a big technology provider for Bajaj for the last 20 years or so. So what it will do, whether it will acquire KTM or not, we don't know yet, but we'll come to know when the company declares its earnings on the 29th of May.
Okay. Thanks a lot for that, Tushar. On to more updates, and Divi's Lab, Neogen Chemicals are amongst companies within the pharma and chemical space that have come out with numbers. Varsha Johnson for an update on those. Varsha.
Yeah, thank you for that. So let me start with Divi's Lab. Good set of numbers. Net profit did beat estimates. The revenue growth that you're seeing is led by the generic and custom synthesis business. EBITDA margin expansion that you're seeing is led by gross margin expansion and lower other expenses. On the segmental contribution, if I were to talk about, the custom synthesis business grew almost 12%, contributing 50% to the overall revenue, and growth was led by existing and new commercialized projects. Custom synthesis will continue to fuel growth. On the generic segment, it grew 13%, accounts for 49% of revenue. Stable price erosion drives generic segment growth, and growth was led by volume, and they're expecting growth in generics to be more volume based. On the con call highlights, they are expecting double-digit growth in revenue when it comes to FY26. Company's progress in contrast media remains steady and encouraging. The Kakinada unit is gradually ramping up, have started also production. The backward integration from Kakinada unit is expected to see benefits in phase 1, and management guided for another 2 billion capex expected from the phase 1 completion of Kakinada. While on Neogen Chemicals, weak set of numbers, but this was expected. If you see, the revenue growth is just 1% because of the lower bromine prices year on year, which impacted revenue trajectory. Lithium prices decline year on year basis, and the revenue growth of 2% that you're seeing is led by volume in base business. Prices across all the verticals remain soft. Profit impact that you're seeing, because there's a huge profit impact, profit is down almost 7x. This was led by an exceptional item due to a fire incident at Dahej plant, which leads to 14 crore of expense.
Okay, Varsha, thanks for that. Now, let's try and understand what to do in a market which is looking so strong. And I'm calling it a strong market because of all that's happened in the last 1 week and the way it bounced back after the geopolitical stress got out of the way. Prateek Agrawal, MD and CEO of Motilal Oswal AMC Johnson, right now on the show. Oodles and oodles of experience. Let's quiz him on all of that. Prateek, thank you for joining in. How do you view the current landscape, Prateek? We are no longer at 22,000, so valuations are not attractive, but a lot of stresses are out of the system. Does it make it a good playing field from a bull's perspective?
So we have interacted before. Our understanding of what went wrong in Jan-Feb was not valuations. It was more to do with currency and interest rate volatility that you saw, which caused levered players, both domestic and offshore, to square up positions in a very short period of time. And the message that you got from the market was just the opposite. People would sell what they own, people will buy what they may have shorted, and that causes the market to give you just the opposite feedback. Now that the interest rates and currency are more normal, not interest rates abroad are still high, but currencies have normalized. That's allowing people to buy and keep what they like and sell what they don't like, the normal activity, and that I think is being represented by the market.
Interesting. Okay. Prateek, the common sell side or the consensus sell side argument that is coming through right now is that the reasons may be whatever, but now that we've come to the levels that we have, we're probably trading anywhere between 22 to 24 times earnings for a market which is likely to grow maybe 10, 12%, 15% at best, but average about 10, 12% for the next couple of years. But it is also a market wherein foreign investors were heavily underweight and might now start turning overweight as well. What do you think the implication of all of this might be? Throw in, of course, the other factors that you believe are probably the more pertinent ones.
With whatever is going on globally, maybe the two largest economies will invest less into each other, which means if flows into global equity funds continue as before, chances of every other economy getting a tad more is higher. To the stated direction of policy making in the US is lower interest rates and weaker dollar. Weaker dollar has been happening. Interest rates, yields need to come down. Now, if you were an emerging market player, you would be salivating at this, right? And on top of it, we have got oil $20 cheaper, which, while the global slowdown has yet to happen, more than compensates for any export loss on account of global slowdown fears. So on economy, as yet we are net positive. So that is what it is. But most importantly, India is a market which is driven by Indian investors, particularly the larger investors, retail and HNIs. So they lost some bit of confidence in Jan-Feb because of the high volatility that was seen. Now, let's say second half of March onwards, we are definitely seeing a return of those investors. I thought the geopolitics that happened between us and the neighboring country, gave another opportunity to investors to come in. Now even that is behind. So unless you again encounter a large dollop of volatility on the currency, I think markets will do their bit. You spoke of earnings increase. Yes, this is a period when the old economy, what is there in the index, let's say, stuff that may have had a glorious past, but today most of that stuff is seen to be, baking in just about economic growth rate in numbers. We have to find newer spaces where the growth in earnings can be several orders higher. So our portfolios, we as growth investors just focus on those spaces.
Got it. Pratik, sorry, you seem to be suggesting that despite the valuation number looking higher optically right now, the markets are more likely to head higher as opposed to stabilize or correct.
Yeah, that is my personal view. I have said in December that valuations were not expensive, they're defendable. For the part that we were invested into, as yet, the part that we are invested into still leaves 15-20% from where they drop. So we think there is still a lot more upside to be had in that part. That's not to say the same about the index that people follow, and more pertinently, the larger cap part of the market. So look at it this way, stuff that has gone from being small to mid is what we like. From mid to large is what we like. We don't like stuff which may have been in the same cohort for ages. Clearly it kind of means that they are losing the growth tailwinds.
First amongst equals, Pratik. Now give us a flavor, and I will at some point of time talk to you about defense individually. So let's park that for the time being in your answer. But what is it that has moved, let's say, from small to mid, that you like the more? I mean, I have some access to your AMC portfolios, so we can gather it, but would love to hear from your views.
No, so we are growth investors. So please take us in the context in which we are talking. Value investors will have a very different point of view. The start point is to, in the index, not look at spaces where growth in earnings would be, let's say 2% plus index and lower, because we believe that markets over time follow earnings growth corrected for valuations. And our job is to deliver alpha to the investors. So if market follow earning growth 2% higher, fees is 2%, there won't be any alpha. So we look first. So this leads us to be away from commodities, most banks, most large IT, oil, refining, steel, cement, staples kind of stuff. All of this we will find very little in our house. What we are more focused on are newer spaces. So we have been saying this is time for alpha. Alpha gets created when a new space emerges. It's new, so it's not there in the index or is less there in the index, is able to grow faster for several years. A great example of this is what software did in the 90s. Maybe private sector banks did from 2001 to 2020 and so on. So if you look at our portfolios, practically all portfolios will have some representation of capital markets, new tech, be it fintech or consumer tech, defense, renewables, EMS, and you get this drift, luxury consumption on China plus one, reasonable amount of exposure to manufacturing, and defense, of course. So that is what our makeup is. And in all of these spaces, you will find the earnings growth not only for last 2 quarters, and we believe this quarter will be multiple times index earning growth, but it shall continue for at least 2 more years. So longevity of growth and higher quantum of growth, we believe, are great combo for delivering alpha.
Got it. Pratik, a focus on 2 pockets really before we wrap up this conversation. One of them is defense, right? Massive, massive moves, and maybe rightly so. This morning, we were having a conversation with 2 companies, Zentech and Data Patterns. Both of them seem to suggest that don't expect massive fireworks in FY26, but this sets the stage for some long-term global inquiries and longer-term execution, and therefore longer-term growth. Now, the street is buying defense as if there is no tomorrow. Can you speak about your view on this?
No, so like I said, we are positive on that space, hence all portfolios will reflect it. But as a part of the portfolio, in our portfolios, you should track weightages. In many of our portfolios, you will see us having trimmed positions when they become larger and build positions when they become smaller because of market movement, etc. So the whole point is to be not carried away by good happenings in one part of the market. Good happenings will happen to other part of the market also. So the way our portfolios are designed is to have all of the growth themes as the house fleshes out, represented in all portfolios. If I take a cricket match kind of an analogy, we don't want to let a over go maiden. Some runs need to be scored. Yes, one manager may be more optimistic on one space and so on. So when that space works well, hopefully over a period of time, he gets bumped up in performance. So that is the design of portfolios in our house.
Got it. But I think the small other space that I wanted to speak a bit about with you is energy transition. Does the move or does the business continue uninterrupted? Because yes, the market correction gave a chance to people to buy in, but the management commentaries thus far don't seem to be different from what they were 6 months ago. The government targets probably continue as well. What's your sense about energy transition at the current valuations that they might be, whether it's wind energy, solar, equipment companies, what have you?
No, so we are again positive. Look at it this way, 2 years from now, a lot of it would be trading at commodity valuations. So I think the market accepts the view that they have 2 years, 2 great years going ahead for them, and after that, competition will come in, margins will get squeezed, etc., etc. So point is 2 years hence, they will be at near commodity valuations with significantly higher growth rates. So if we expect power demand in India to move up by, let's say, 5 odd percent, these spaces would still end up doing a CAGR of double digit for several years, 11, 12% for several years. So that's a number which is higher than all commodities. And with the ROCE, which is higher than all commodity players. So we think the combo that is presented, even if one assumes it gets commoditized after 2 years, is a good combo for making money from where we are, is our sense. And in the interim, these are managements who have built businesses from scratch to the current level. Well, they are not sitting idle. I mean, the fact that the business will undergo a lot of change, competition will come in after 2 years is being told by them themselves. So we think they are taking actions to prolong the good period. Some may be looking at export markets. Some may be looking at doing a bundled service. So, buy land at some place so that they can do a full turnkey solution rather than just, supply a windmill or a panel kind of stuff. So I think all of them are definitely looking to elongate the good time while the times continue. Maybe some are looking at backward integration and so on. On wind, the increase in domestic content requirement, there is a paper floated for that, would hopefully reduce competition and again benefit the domestic players. So policy tailwinds are also there.
Most certainly, most certainly. Prateek, one final question. Anything that you are circumspect on, negative on?
The index, any space where growth is lower then the index we are very circumspect on. Lot of analyst focus goes there, but most of those spaces have had their best of times. They will grow at index or lower in terms of growth rates, and hence will result in or should result in lower than optimal results for investors.
Maybe. Or no? Like IT? I mean, or what? Just examples, one or two?
No, so take the best of banks. What will be the growth in earnings?
Okay.
Best of large IT, cement, oil and gas, metals. The earning growth wouldn't cross 10% for 1 year, 2 year, 3 years. So, which is why I'm saying, just take the analogy of what happened in the past, what delivered great outcomes for investors, software in the 90s, private sector banks in early 2000 till 20. And then see what is available to you just now. It is not about size, it is about growth. People say size is safe. I say growth is safe. Else the index would have never changed its composition, right?
That's true. I mean, that's such a powerful line. Prateek, thanks for ending the interview with that. Really appreciate your time and look forward to seeing you soon.
Thanks.
That's the view from Prateek Agrawal. Like I said, oodles of experience. And I think it's a powerful line. Size may not be safe. Growth is what is safe. Well, with that, just mark the index ones before we wrap up. But it is a wrap on this leg of India Market Open. Just pull up the Nifty ones just to see how we are faring. I think it will be a flattish move. No big shakes either ways. Yes, indeed, absolutely flat. Wrap it up. Up next is Ask Profit.
That's huge. That is a biggie. It's out of
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and sitting right beside me is Mahima Vashajani, and we'll take you through the next 1 hour of trade. And it's an interesting start to the trading session and to the trading week, in fact. You have the benchmark Nifty 50 that is it's treading water at this juncture, and it's holding on to that 25,000 level. But as you can see, it's a very, very tight range for the benchmark Nifty 50. Once again, as you've seen for a large part of the last 5 sessions, you have the broader markets that are outperforming the benchmark, and barring a couple of sessions, Thursday, for example, of last week, where you saw the benchmark really do much better than the broader markets, this has been the case. You have the mid-cap index that's gaining about 0.5% at this point, and you have the small-cap index that's up close to 1%. And so as a result of which, the market breadth once again tilted in favor of the advances, but that gap has narrowed from an earlier point in the day. It has been a little bit choppy. So let's keep a watch on that. There are a few pockets of tremendous strength, and the defense pack once again stands out as the big gainer today. Of course, it's off the high point of the day, but you have a few components of the Nifty defense that are continuing to do well. Among them, data patterns, among them Zen Tech gaining ground. You have a few of the shipbuilding names that have gained very substantially over the course of the last few trading sessions that are losing a little bit of ground, but not to a very large extent, 2.7% or so for Mazagon Dock Shipbuilders. You have Cochin Shipyard that's down about 1% or so. And so we'll get you a view as to whether or not you should take some money off the table if you manage to get in early enough. Just a couple of other stocks that I want to point out to you this morning, and this is likely on the back of an update from a Japanese company that has stopped graphite electrode manufacturing in China, and as a result of which graphite as well as HEG are doing particularly well in trade, up about 13% for graphite, HEG gaining about 9% or thereabouts. These are highly cyclical stocks, remember, and they usually see a spurt in activity once in a way. This is one of those instances. We're joined this morning by Brijesh L as well as Saurabh Jain to answer all of your questions. Let me go across to Brijesh first for a very quick view on the technical outlook and what he's seeing on the charts at this juncture. The benchmark, Brijesh, just about flat, not doing too much, and very tight range, but action in the broader markets. And the Nifty Bank is looking like it's not doing too much. It didn't do too much last week either. So what, according to you, is the technical setup at the index level?
Yeah, hi, morning. So if you look at the index, like Nifty we speak about, so I think there's a slightly, it is a kind of a range bound kind of a session what we are observing, but then the view is positive. I believe maybe sooner or later, maybe during the next second half of the day, one bounce back trade will be there, and I think Nifty should be approaching 25,200. So that is the immediate view for the Nifty, and on the way down 24,900, 24,850 is the support. So this is a very smaller range, but the directional view is positive, and I believe Nifty will see 25,200 during next 1 or 2 trading session. Same thing with the Bank Nifty. We're a little bit more aggressive on the Bank Nifty. I have a sense that the Bank Nifty will take off 56,000 on the higher side. So if you compare Nifty and Bank Nifty looks pretty much stronger, and that short covering can be seen in the Bank Nifty. And eventually, if it closes above 56, then definitely it has to ride further upside. But Bank Nifty looks much more stronger as compared to Nifty as of now.
Okay, so that's with regards to where the Nifty and Bank Nifty stands. All right, the first question today is from Santosh, who wants a view on Natco Pharma. He's got 121 odd shares bought at 9-10 a piece and wants to know the outlook for this one. Saurabh, a very good morning to you. I'll come to you on this one. What's the view like for Natco Pharma?
Hi, good morning. See, the street was disappointed in the last quarterly earnings because the numbers were short of the management guidance, and not much clarity was given by the management guidance as to how the revenue will flow from the company where they envisaged in the past. As far as valuations is concerned, I think it is one of the cheapest available in the pack, and overall the business is good. In my opinion, it is a hold.
All right, we've got a first caller for the day. We've got Dheeraj calling us from Hyderabad. Very good morning, Dheeraj. How can we help you today?
Good morning, sir. My query is regarding Bharat Bijli.
Okay.
So I bought 81 shares of Bharat Bijli today actually at 3,100.
Okay.
Can I hold it for the next few days? There is a lot of correction, about 10% correction, and I don't know the reason, but I bought it as there is a lot of correction. So could I hold it or should I sell for the near term?
Yeah, okay. So you bought it looking at, okay, fine, all right. And what is the time frame that you have in mind? You said a few days, huh?
For the next 1 month, sir.
For the next 1 month. Okay, I think it's reacting to its earnings, where its PAT number is up only about 4% or thereabouts, and its revenue is up only about 5.4% or thereabouts. So, but not the largest company, just about 3,500 crore market capitalization. Brijesh, on the charts, since it's a decision to purchase based on the stock move today, and he's bought at the low point of the day, but what are the prospects on the upside?
So I think, as you rightly said, because of the earning, the stock is corrected and it is almost down with 12%. So there can be further damage in the stock. So I think this may come somewhere close to 2,900. So that is what the percentage term it looks like. So closer to 2,900, I think this may see some support, because a few days before that was a level from where the stock has picked up the momentum. So I think on an immediate basis, if you can do some averaging at 2,900, and then I think if you can hold a position, you might get an exit opportunity. So I think he should hold, and close to 2,900, he should do some more averaging.
So that's the view with regards to where Bharat Bijli stands. The next question is on Kaplan Point. Rajesh Govda is writing in, his buying price for this particular counter is 1990 and he's bought 100 odd shares sitting on a profit of 13,000 odd rupees. Wants a short-term view on this particular counter. Brijesh, I'll stick with you on this one. What are the charts indicating for Kaplan Point?
I think this stock can see another 10% kind of a movement on the higher side. 10 to 12% momentum is there. So 2,300, 2,350 is what I can see. So maybe it will take maybe during this week there's a high probability that 2,350 can be seen. So he should play for that move and ride the momentum.
So that's the view with regards to where Kaplan Point stands. We also have a caller, Govind from Hyderabad, who's calling us. Govind, we've already answered your query on Natco Pharma, just 2 queries before this. So you can go back and watch the view on that particular counter. The next query is from Rajiv Sethi, who's writing in from Dehradun. He's holding ITDC 50 shares at 596 a piece, and his vision is from 2 years perspective, and wants to know if this stock is worth holding for the next 2 years or not. Saurabh, I'll come to you on this one. What's the view like for ITDC?
The company primarily works in the construction space, and it is a very old and good company. Since we are bullish on this space, I think the numbers would be good going forward. In my opinion, it is a hold.
Hold on ITDC. All right. Kapil from Dubai is asking the next question and asking about Shakti Pump. His buy price is 910, and okay, I'm not really certain about the overall holding. I think what he's trying to say is that his average share price is 1,169, and he's not really given us a time frame. So let me go across to Brijesh on the charts. Brijesh, what's the view on the charts? It's down about 0.9% in trade today.
It looks a little bit weak. There has been a distribution, so I think this may slip further on the lower side. So there is a probability that this may come close to 700, 750 levels. So I think more damage will be there. Let it come to this zone of 700 or maybe close to 700. I think then this one should review it. Those is a demand zone previously where it has taken support and there was a good rally close to 1300 level. So, but now it is very difficult whether that stock will take support or not. On an immediate basis, maybe another 100 points kind of a correction will be there. Close to 700, I think he should again review and understand what is the support if the market is taking. Like, you need to review at close to 700 levels.
Okay, so that's with regards to where Shakti Pump stands, and that's the technical view coming in from Brijesh. The next counter that we're talking about is Godavari Power and Ispat Limited. Sanjoy from Bengaluru has bought 50 shares at 190. 100 shares at 188 a piece, so he's averaged out a bit. First, he had purchased 50 odd shares at 192 and wants to know if he can buy, accumulate more at the current levels. His horizon is from a 3 to 4 years perspective. Should he go ahead and buy more at this level, Saurabh?
I think the company primarily deals into the steel segment, and we are bullish on the materials. We feel that the global economic growth will be higher going forward in the second half after the truce between the US and China. And we feel with the rise in the metal prices, the profitability of the Godavari Power will improve going forward. The last quarterly earnings were a bit negative. I mean, there was some kind of a degrowth. But in the future, we expect from the 3-4 year perspective that the company should do well. So it's a hold.
All right, so that's the view with regards to where Godavari Power and Ispat stands. Our next caller, Raj, is calling in from Hyderabad. Raj, a very good morning to you. How can we help you?
Hi, ma'am. Very good morning. Ma'am, I have IRFC shares at 177 rupees, 200 shares at 177. I just wanted to know whether I can add more shares at the current market price or I need to wait some more fall.
Okay, just wanted to understand, Raj, what's the time horizon that you're looking for to invest in IRFC?
More than 1 year.
More than 1 year. So you want a fundamental view on this, I believe.
Right, fundamental. And I just wanted to know whether I can add more stocks.
Okay, got your point.
At the current. Yeah.
Okay, got it. Saurabh, I'll come to you on this one. He's sitting on a loss of 7,000 rupees right now, but he wants to average out and add more. Are these the current levels to add IRFC?
Won't recommend to add, but at the same time, the valuations have corrected in the recent correction. And now it is trading close to 3.5 book value. And the company is expected to grow at a good pace. So in my opinion, he can hold.
All right. We've got Satyan who's asking about Aurobindo Pharma. He's looking at a fresh entry for the long term. And Brijesh, I'm going to come to you on the charts. It's trading at 1,217, up about 1.4% in trade. But what are the prospects for the long term?
Okay, I think I would take a buy call because currently it is consolidating sideways. The trigger will follow about 12,1260 level, and I think slowly it will move up. If he can make an entry at this price and on a trade about 1260, he can be more aggressive and he can bet for 1400, 1450 on the higher side. That's a technical view.
All right, we've got our next caller. Pratul is calling us from Jaipur. Very good morning, Pratul. How can we help you today?
Yeah, good morning. Good morning, and thank you for taking me on the show.
Our pleasure.
I have only 1,600 shares of BSE Limited, which I purchased at the rate of 2,600 about a year back.
Okay.
Now, the thing is that the share has been growing consistently. So at this point, when the record date for split is fast approaching, the bonus date is fast approaching, should I sell it before the bonus is declared? The bonus materializes, or should I sell it after the record date?
Okay. Do you have need for the funds, Pratul?
What did you say? I couldn't get it.
If you sell and if you book your gains of 75 lakhs, will you use it to deploy into other stocks or will you use it for some other purpose?
I'll reinvest it, possibly in BSE itself.
In BSE goes down. Okay, so it's a tactical play that you have in mind and you're wondering whether to book some profits and re-enter at a lower level. Is that right?
Yeah, there's some. Should I wait for the record date or should I sell it before the record date or after the record date?
I got your question. I got your question. But fundamentally, you're positive in BSE and you intend to hold for the long term. Is that correct?
Yeah.
Okay.
That's a good share. That's a good counter.
Yes. Okay. And congratulations on the buy price and on the kind of gains that you've made. Brijesh, since it's a question on the relative short term and he's talking about corporate action and whether or not he should adjust his strategy accordingly, what is the advice that you would give in the short term?
I will be doing a profit booking at this level because the prices are extended very far and there is a high probability that some profit booking will come into and this may go back to 6,500 level. So even to our clients, to somebody who is having a long position, we are saying it is wise decision to at least to take a part profits in this and to hold the position. But then sooner or later, I do believe there will be some profit booking in this. So it is advisable. It will be difficult to exactly point out from where the profit booking will come. But partial profit booking is advisable because 6,600, 6,500 is what I can look in the short term perspective.
And then, so if it does hit those levels, would you redeploy? And
yes.
at 6,500 levels?
Yes.
Okay, all right. So that's a Pratul. Hopefully that answers your question, and congratulations once again on having acquired BSE when you did. Balu Forge is a counter that we're talking about next, and this is Rahul, who's writing in from Jaipur. He's bought at levels of 620 rupees a piece, and it's more or less where the stock price is at right now, and he's wondering whether to hold for the long term. On the fundamentals, Saurabh, what is the view on Balu Forging?
Won't be able to comment on it.
You don't have a view. Okay. So let me take a technical view then. Brijesh bought at levels of 620, not too far away from the current market price. What's the view on the charts?
So I think he's already bought the position, so he need to hold because the last week there's a good amount of appreciation, like 20% appreciation was seen. And it may take little time, but then maybe some positive bias can be there. He can bet for another 100 points, like 700, 720 can be the possible upside. Time frame would be difficult, but then hold should be the view.
Okay, hold is the view coming in on Balu Forge where charts are concerned. Our next caller, Naresh, is calling in from Chennai. Naresh, a very good morning to you. How can we help you?
Yeah, good morning. I want to know about IDFC First Bank.
Okay.
Yeah, I have about 45 shares at 65 rupees a piece.
Okay.
So I want to know about the long-term value, like 1 or 2 years.
Okay, 1 or 2 years. Okay, got your point, Naresh. I'll take this up with Saurabh. Saurabh, in terms of Q4 earnings, your net interest income was largely in line, but PAT did decline due to elevated credit cost. Plus, we've also seen Warburg buying stake in IDFC First. With everything around this, what's the view like? Should he continue to hold for 1 or 2 years?
Overall, on the banking sector, our view is quite positive. I think in the next 1 to 5 years, I think the sector will grow. The legacy problems have been solved out, but in case of IDFC, I think better opportunities lies in the banking pack. If he wants to stay with the IDFC, he can stay. The valuations are also comforting in the long term. The bank looks good, but if he wants to switch over to another counter, so I would recommend better to switch to ICICI Bank or maybe Indian Bank.
The latest update coming at the bottom of your screen, Naresh, in case you can take a look at the screen, the latest update, of course, is that shareholders of IDFC First Bank have rejected the proposal for a Warburg Pincus board seat after the acquisition of stake that they have made. So bear in mind that Saurabh's view is that perhaps you might be better off shifting to an ICICI Bank at this juncture. We've got the next question from Abir, who's writing in from Raipur in Chhattisgarh, and he's asking about Varun Beverages, which he's bought at a price of 518.5. Number of shares is 200. Does he keep holding or does he sell and invest elsewhere? The stock price is currently at 503 or thereabouts, 504. He hasn't really given us a time frame. So Saurabh, let me come back to you on the fundamentals. Would you hold Varun Beverages or would you switch to something else?
I think they have a very good portfolio of the cold drinks and the chips, and they have also expanded to other geographies also. On the valuation front, the stock has always remained expensive, but recently it has declined. There is always a fear of a competition from the Reliance industry from the launch of Campa. But I think the industry will itself grow, and the competition, there will be a healthy competition. From 1 to 2 year perspective, I think it is a good company to hold.
Okay, so that's with regards to where Varun Beverages stands. Our next question is from Murli, who's calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Good morning, Mahima madam. Thank you for taking up my query.
Our pleasure, Yeah.
I got Xaver Technologies in March 25, on 12th March, at a rate of 773.
Okay.
And I will do some this amazing dividend also, 5 rupees, 7 rupees per share.
Okay.
And I am willing to wait for more than a year.
Okay.
What are the prospects? Or if you say no, I should sell and switch, what is the better option?
Okay, got your point, Murli. I'll take this up with Saurabh. Saurabh, in terms of Hexaware Technologies, where Q4 earnings were concerned, EBIT margins were largely maintained. Most segments' growth did slow down quarter-on-quarter basis, and overall the numbers were okay. What's the view like there? And do you suggest Murli to switch to some other counter?
If you look at the IT industry, even the biggies have called for in single line digit growth, because there is discretionary spending is not happening in the US. The business is not that great.
In fact, there has been some delays in the project implementation also. There has been some delays with the project awards also. So in my opinion, I think IT sector will not perform this year because of the bleak growth prospects. So in my opinion, I think he can switch over to some other sectors. The sectors where we are bullish is banking, capital goods, utilities, hotels, or maybe some banks also. So in the hotel segment, he can switch to Lemon Tree. In the banking, he can look to ICICI Bank or maybe Indian Bank. In the capital goods segment, he can switch look for KEC companies like KEC International or Kalpataru Power Transmissions. So he can switch his money.
Yeah, a few of those stocks reacting in trade today. Speaking of stocks that are up and about and have been in the recent past, Bharat Electronics is the name of the counter that we're talking about next. And Money is writing in from Vizag, Vishakhapatnam. He's bought at levels of 290 rupees per share. The stock is in focus today also because of earnings, but he's making quite a bit of a gain of as much as 16,000 rupees for his 210 shares that he has bought. He's wondering whether he should book profits ahead of the earnings. What's the view, Brijesh, on the charts? A lot of people talking about the run-up that they've seen in the defense portfolios. Should you take money off the table?
Yeah, 100%. Because see, this is the extended move on an immediate basis. So if it's done some kind of a trading kind of a setup, it is advisable to take the money, because in the near term, whenever the index is also near to the 24,000 mark, and if by any chance if there is some profit booking in the market, this will come back to 330, 320 levels. So definitely one should take their profits, and maybe the good level to make a re-entry is 300. So whenever it comes back to 300, that's a beautiful level. But then profit booking should definitely be done at this level.
Okay. All right. We've got our next caller for the day. We've got Snigdha, who's calling in from Hyderabad. Hi, morning. How can we help you today?
Hi. Hello, everyone. So I just want to know if I could invest. I want to invest 2 lakhs on either Bharti Airtel or Power Grid. So I just want to know which share would be better to invest.
Okay. And this is a short-term perspective that you're seeking?
Yes. For 1 to 2 months.
1 to 2 months. All right. Brijesh, a couple of counters, very large cap counters, frontline counters, Power Grid Corporation of India and Bharti Airtel. Which one would you pick for a short-term perspective?
So Bharti has already moved up, and Power Grid is about to take some. But the point is, the opportunity is there in the Power Grid, but it is a slow mover, so it will take a bit time. And Bharti, there is a probability some profit booking can come. So given a choice, if I need to make an entry, Power Grid is something which I will take a call, and maybe from this level I will bet for 10-15% kind of opportunity. So that would be my take.
Ask you this then, if it is not these two, seemingly that is the case, and if you were to be asked about the top 100 stocks on market capitalization, which is traditionally looked at as large cap, which according to you would be the best pick for a 2-month time frame?
So exactly, because the Bharti specifically, I can see there is a slight profit booking and some correction is there. So I would stick with Power Grid. I think if I need to buy, I would be buying a Power Grid from a 2 months time frame.
Okay, so that's the view with regards to where these telecom companies stand. All right, the next caller, Himanshu, is calling in from Lucknow. Himanshu, a very good morning to you. I believe you have a query on Canara Bank.
Yeah, ma'am. Good morning, ma'am.
Good morning. Go ahead with the query, Himanshu.
Ma'am, actually, I am having 100 shares of Canara Bank at the rate of 102.90.
Okay.
I can hold for long, but meanwhile, what should I do? Should I exit if it is going to dip, or should I continue to hold?
Okay, got your point, Himanshu. I'll take this up with Saurabh. Saurabh, what's the view like on Canara Bank? Should he continue to hold?
Yeah, view is quite positive on the banking sector. As far as Canara Bank is concerned, it is trading less than book value. The results were great. I mean, there was a good amount of profit growth, and the NII was largely maintained. The book grew by more than 10-14%. So, in my opinion, from the long-term perspective, it can be a good multi-bagger.
Okay. All right. Kantibai is writing in from Mumbai and asking about Tata Power and whether to buy it at the current market price. I believe he's got a relatively short-term view. Brijesh, would you buy right now? It's up about 1.3% in trade today.
Yeah. I think yes, Tata Power looks good on charts from the current level of just 700, 411. It can go back to 440, 445 levels. Even the derivatives data is suggesting strength in this counter. So there is an opportunity. So I would take a buy call in this in Tata Power.
All right, Brijesh, I understand if you leave us. Thank you so much for joining us this morning, and pleasure having you on the show as always. We'll be back on the other side to take more of your questions, and we've also got a management interview lined up. Kaynes Technology is the company that we're speaking with, so do stay tuned for that. Be back before you know it.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay
Hello, good morning and welcome back to Ask Profit. We're in conversation with Mr. Jairam Sampath, whole-time director and CFO of Kaynes Technologies, to talk more about the results as well as what is the outlook for FY26. Mr. Sampath, good morning. Thanks so much for giving us your time today at NDTV Profit. Let me start off first, directly with the results. We've seen Q4 was expected to be strong to meet the guidance as well. Slight miss on revenue, but overall the EBITDA margin profile has been very strong. I just wanted to start off first with the segmental performance. The industrial business basically is now 55%, up from 48% in terms of revenue. Within that, if you can just talk us through and break us the products. I know smart meters is one of them, and you gave a few in the presentation, but just if you can talk us through what's the growth of this expected next year, and is it largely led by smart meters or some other products that we should know about?
Thank you for having me here. So fundamentally, the order book contains a lot of new value accretive orders in the industrial, electronic vehicle, aerospace and outer space, and also even IT and other areas. So of course, last year the performance was shored up by industrial field, which is basically smart meters. But this year we have quite a bit of orders in the automotive area also. There's a European customer that we have added. And the industrial, of course, our key customer who we acquired actually is Eco, that continues. And of course, there are orders from new EV two-wheeler makers and also from the aerospace and defense, those kinds of areas. Even in railway, I think in FY26 we'll start doing some business in the Kavach area. Our product is almost near completion of development phase. So for the coming year, just want to clarify, we will grow our existing businesses, which is basically the ESDM businesses at about 60%. So that comes to about 4350. Plus we have acquired a new company in North America, which is August Electronics, and I think we'll be able to probably consolidate 6 months of their revenue into our business, and that will be somewhere around 175 crores or so. So if you take a consolidated company level basis, I think our business will be about 4525 or so. And looking at the order book and the kind of business that we have planned for execution, I think our margin will also expand this year in FY26 from 15.1% to about 15.6% at the minimum. So this is on the back of very strong order booking also. As you know, the monthly order rate has also gone up 20% on a quarterly basis, which represents about 80% on an annual basis. And the order book stands at about 6,500, 6,600 crores or so. And that's doing pretty well. Also, I think going forward, there are other orders also lined up in various sectors. And so for FY26, 27 and 28, you can see some fairly good revenue trajectory now.
All right, Mr. Sampath, you highlighted quite a few points there. So for next year, estimating revenue to be around 4,300 odd crores. It was roughly between 27 and 2,800 crores. That was what you said. You mentioned also on the EBITDA margin guidance, 50 basis point increase to 15.6% for FY26. So we got that as well. And order book, just had a follow-up question. You mentioned that you already are at 6,600 odd crores in terms of order book as of FY25. For the next year, how much of it is actually executable over the next year? Because you also have some order book that goes over 5 years as well. So when you mentioned that 60% of your revenue growth for the traditional business, do you already have the orders for that? And is that largely led by the industrial segment, or is that from automotives as well?
Yeah, so as far as the FY26 plan is concerned, we have, it will be led by industrial, electric vehicles, aerospace, and also railways. So aerospace and railways, of course, are better businesses for us because they are high-tech businesses and so on. And industrial, of course, revenues will continue to increase in the area of smart meters. As far as the guidance is concerned, what I said is 4350 is the number that we will have for existing clutch of businesses. We have acquired another company called August Electronics. So that will add another 175 crores, but that's half-year business for them. So you would have a total number of about 4525 as the number. And the new business that we have acquired is at a accretive nature in terms of EBITDA. So EBITDA also, I think you can see some a good increase. About 50 basis points is what we expect. We will see how much actually we get to.
And just want to take the point forward for a new the PLI component scheme that's been announced as well. Any kind of number that you can quote us, because we've already seen a few of your peers already announce capex for under this new scheme. Could you quantify what's your plan under the new electronic component scheme? I think it's a 22,000 crore scheme. What is the plan for Kaynes Tech regarding the same?
Yeah, so our two investments into PC board as well as OSAT were already covered by the earlier schemes of Indian Semiconductor Mission as well as the earlier SPECS 2.0 scheme. And we will try and see whether we can get some PLI done for the PC board, which is a component which is covered under the new scheme. As far as this round of investments is concerned, we already are well covered in terms of the capital subsidy. In case of OSAT, we get about 70% capital subsidy, state and central government included in for the eligible capex. And similarly for PC board, we get about 65%, state government and central government included. So this year, we are looking at making sure that these two businesses come on stream. And we start commercial revenues from the fourth quarter of FY26. Factory is under construction, so maybe before September, I think the physical infrastructure will be ready, and then we need to give some 3 to 4 months time for the customers to approve the factories and samples, etc. So at this point in time, we are depending on approvals already received. So there are no pending approvals required. Maybe in future, we will look at any expansion under those schemes.
Mr. Sampath, specifically, we asked you about, the order book specifically. You already have the orders for the growth guidance that you're giving for FY26 because it's quite executable over a longer term as well. But for FY26 to meet this 4,300 crores from traditional business, those orders are already with you at this point of time?
Yeah, so typically out of 6,500, close to about 60% of orders pertain to the coming 12 months. So obviously there is a few orders that yet to come in because some customers do give in orders only for less than 12 months coverage. So from that perspective, whatever is expected to be there with us is already there, probably beyond that. And so you can say that order book coverage is pretty much good.
You mentioned in one of our previous conversations that both, and you confirm right now that the OSAT, which is part of the semiconductor venture, as well as the PCBs, FY27 will be majorly the first full year of operations. So essentially, what kind of revenue can we expect from both these verticals? I think a longer term target is 8,000 crores for FY28 for you. Can we expect that the incremental business will slightly slower in terms of growth? How do we expect the traditional business and the contribution from these new verticals?
Sure, sir. So FY28, we had always talked about $1 billion, which has been our objective. So we think that dollar will be about 90 rupees, so 9,000 crores. And in that, the FY28, the contribution of OSAT and PCB was supposed to be about 1,500 crores. And the remaining 7,500 crores was supposed to come from the EMS kind of business, which I think we are pretty much on stream and maybe we'll exceed those numbers. So as far as FY27 is concerned, we probably will do enough to make sure that at least minimum 1,500 crores of businesses will happen in FY28, maybe more. So FY27, we might reach the same, say about 1,000 plus 500 crores in these two businesses in FY27 itself. Well, FY26 is the evaluation time, and FY27 we see significant capacity utilization also, maybe between starting with about 30-40% and going up to about 80%. So let's broadly we say that half of the turnover that we expect from these businesses should start kicking in by second half. So roughly 1,000 plus 500 crores is what we can expect from new businesses. That is OSAT as well as PC board in FY27. FY28 maybe will exceed that 1,500 crores that we had reckoned earlier on. So we will come out with fresh calculations probably towards the end of the year after looking at all the orders and all the customers that have been onboarded and all that.
Because you already mentioned 1,500 crores from these new verticals, you already are doing 4,500 in your traditional business. So you're already there between 6 to 6,500 crores at the start of essentially FY27 for both businesses. Got the view. One final question. There's a couple of questions combining them. So one is the IoT, IT as well as the consumer side of the business that's still new for you, roughly between high single digit in terms of revenue. That is very close to the traditional EMS business, which a lot of companies do, which is high volume and low margin. Is that something different for you because you have focused more on high margin and low volume products? What is your outlook for this vertical going forward, and exports as well? That's roughly 10% of your revenue. Is the strategy more for export from India to geographies as well, or from, like, as you acquired August Electronics in Canada, so you will be addressing those markets from those acquisitions, and Sensonic as well in Europe? So any just a color, some color on that as well as well.
No, sure. So firstly, our IT, IoT and others contains only professional electronics, which is business to business kind of thing. It contains most of these are high performance computing servers actually. So what you see there is not consumer, though we include consumers there, but consumer is almost minuscule, almost negligible portion of our business. Earlier on, we used to do some little bit of business in terms of ODM business, that is BLDC controllers and so on and so forth, which did have some consumer outlook. As far as the exports is concerned, exports is distinct from geography sales. So we are talking about India geography. India geography contains domestic and exports. So India geography exports would contain aerospace and some business in automotive and some business electric vehicles. And maybe at a later point in time, some railway business will also resurrect. So from that perspective, we expect the India geography exports to increase from current small single digit number to a much at least a double-digit number by the coming year. In addition to that, new businesses like OSAT and PC board will have almost a major portion of their business will be exports. And in addition to that, of course, there is these acquisitions outside of India. So that is called a geography. In our parlance, that's a geography business. That means you sit there and do business locally. So that may not be very significant in FY26, but then coming by FY28, 29, we would like to have geography, outside geography business to be close to about, say, FY29, FY30 time frame, $300 to $500 million should come from outside of India geography. And then, of course, you will have $1.5 billion from India geography. So that's what will make this FY30 $2 billion mark.
Got that, Mr. Sampath. Thanks so much for joining in, giving us a whole host of views on FY25 as well as what's the outlook for the next few years. We look forward to our next conversation, but thank you so much for joining in today, sir.
Thank you. Thank you for having me.
So Alex, very interesting in terms of business as well as the management mentioned, but stocks up 56% from the end of February. It had a major correction at the time, but really strong correction. So it didn't give too much time for investors to get into this very interesting growth prospect.
An interesting conversation as well, very transparent on the outlook going forward. Thanks, Puneet, for that. And that last bit as well. Saurabh, before we jump into some of the other questions, I'm sure that you listened to the conversation as well. Any view that you have? And by the way, Ajit, thanks so much for joining in on this side of the show. Saurabh, very quickly on Keynes Tech, would you be a buyer at this point based on what they've said, 60% revenue growth outlook in the traditional business itself in FY26?
Based on the company's guidance, the company looks good, and on the operational front, they are guiding of 60% kind of a growth. But in my opinion, I think, Alex, all the growth for the next 2-3 years have already been baked into the prices. The companies at the end of the day is doing 2,700 crore worth of revenue and about 300 crore of net profit, and the market capitalization 40,000 crore. In my opinion, it is too expensive.
Okay, all right. So that's a nice way to put it. Despite that 60% growth in the traditional business with a market capitalization of 40,000 crore, the question that you have to ask is, are you getting value for the business that you're buying at this point? Sure, the company is doing well. All right, let's take the first question on this side of the break, and this is on Crompton, which posted its results not too long back, and it's a shorter term question. It's from Suresh, who's writing in from Hyderabad. Can it be bought from the perspective of 3 months? And if I remember correctly, the earnings were bolstered by the acquisition that the company has made of Butterfly Gandhimathi, and the stock reacted positively. There you go. So post the results, it moved up quite substantially. Ajit, the question is whether or not there is a tailwind for the next 3 months, and what is the upside that you're seeing on the stock?
Yeah, hi Alex. So yes, see, if you see the past performance, it's been almost like 4-5 years of volatile swings that the stock has been experiencing. Means from 500 to 250, and then again to 500, and again it reached closer to the lower band of the same. Now we are seeing sign of reversal. So let's say if somebody's view is having 3 months to 6 months, probably 380 to 400 something that the stock can attempt. So the risk reward is favorable, means we have a very strong base at 320, 310 area. So with that as a stop loss, 400, 420 positionally can be considered for next 2 to 3 months target.
Got our next question on State Bank of India from Sandeep, who's calling us from Bengaluru. Very good morning, Sandeep. I think you've bought at levels of just under 800. What is the view that you're seeking?
Hi, Alex. Good morning. Thanks for the call. Just a very quick question. Given they have an annual general meeting tomorrow, where they have a proposal about fundraising for $3 billion, I just want to understand how the impact could be. In the sense, it's going to be looked at as positive, or how is it?
Actually, so before I toss or ask this question to Saurabh, and I'm pretty sure that he's going to echo this, for a bank the size of State Bank of India, this is not very large amount of fundraising. And also, if you look at the capital adequacy ratio, you will notice that it has fallen. And it is something that they need to bolster. Generally, you need to have a certain amount of tier 1 capital in order to have a certain level of growth. Saurabh, is that the perspective that you should have with State Bank of India? And do you think that it's going to have a material impact? Would you hold on? Would you buy more at this point?
You're absolutely right, Alex. In the you look at the balance sheet of the SBI, they have about 5.5 lakh crore worth of deposit and about 4.2 lakh crore of the loans advances. I mean, for such a heavy bank, bigger bank, 3 billion is nothing worth. I mean, nothing. But it is essentially happening because of the capital requirements. So nothing to worry. I think you should keep on holding.
Keep on holding. Is there potential upside that you have in mind? Of course, State Bank of India not seeing the kind of loan growth that it has seen in past years. Does that pick up? Because there has been a little bit of caution in the unsecured space.
I mean, the management has guided that they are quite. I mean, they are not afraid of their unsecured book. They are well covered, and of course, the balance sheet size is too heavy, and to grow at a higher pace at this pace is quite difficult. So I think one should keep in mind that with the investment in the companies like SBI, one should be seeing growth of 12 to 15% a year.
Okay, fair point. And buy these companies also from the perspective of distribution of profits in the way of dividend, right? So keep one eye on that as well. Sandeep, thanks so much for calling us today. We've got a next question from Prakash, who's writing in from Chikmagalur in Karnataka, and he's talking about RCF, Rashtriya Chemical Fertilizers, which he's bought at a price of 195, so slightly elevated levels that he's bought it at. And he's wondering what the prospects are going forward. I'll come to you, Ajit, on the charts. What are the prospects on the charts?
So, Alex, after this sharp correction from the record highs from 240 to roughly around 110 levels, we are seeing gradual recovery. The stock has reclaimed major averages also on multiple time frames. So, it seems stable now, but for his level to come means the stock should decisively break 160 level and hold above the same. Then only we can see, let's say, around 180, 85 levels. So once it reaches closer to his buying price, he should review his position or at least, book partial losses and maintain a trading stop at 170.
Okay. Speaking of losses, this is quite a blow to take, and I'm talking about Protean eGov. And this is a question from our viewer Vipul Sheth, who's writing in from Ahmedabad. He's holding 100 shares at a price of 1306. The stock is down at lower circuit today, so no buyers in the stock, and so it's taking quite a bit of a beating. And the reason, of course, is that there has been a cancellation or no extension of a contract with the Government of India for its PAN 2.0 project. It has sent out a statement. It said that it's no longer in contention for that project. It has been eliminated from the RFP race, and the government had plans to overhaul the PAN and TAN services under PAN 2.0 with a 1,440 crore budget. And despite earlier confidence, Protean is now completely out of the running. By the way, there's an Equirus note on the company. It says that this is a material negative as the PAN services contribute as much as 50% of the revenue of the company. FY26 impact may be muted, and it expects a 75 to 100% collapse in this revenue stream over the next 2 to 3 years, and a 35% decline in the FY27 overall revenue. So it's a material negative. Unfortunately, this has come out of the blue. It's not something that a lot of people would have anticipated. So the question is, Saurabh, I would think that you would try and get out when you can. But what is the strategy that you would employ?
I think all the reasons you have clearly stated, Alex. In my opinion, I think the valuations will get a reset on the lower side, and there is much room for the stock price to go down. So I think as soon as you can get out from the stock, it would be better.
Okay. Is there any point, Ajit, asking you about technical levels? At this point, there are no buyers in the stock. So, but what strategy would you employ?
So, Alex, since listing, the stock has been trading in this band roughly around 1240 to 1450, 1480. And with this kind of a move, a gap down start followed by this down circuit, it has ended this consolidation on the lower side. So this is not a good indication. Means as per the range itself, probably close to around 950, 900 is something the stock might test in the days to come. So please avoid any bottom fishing as of now until we see any sign of reversal.
Yeah, okay. So that's advice for anybody that's looking at the price downtick and wondering whether or not to buy, this is the definition of a falling knife, and avoid at all costs at this juncture till some clarity emerges, as Ajit has pointed out. A slightly broad-based, actually before we get to that, Raju is calling us from Andhra Pradesh. Very good morning, Raju. How can we help you today?
Yeah, hi, good morning.
Please go ahead with your question.
My query is about electricity casting.
Okay.
I want to take a fresh position in this counter. It seems very good as per valuation, so I want to take a fresh position for a long-term view.
Okay. What valuation metrics are you studying? And this is a stock that is about 7,000 crore, 6,800 crore market capitalization. It is in the pipe space. So you've obviously done your reading. If you're talking about the valuations, what metrics are you looking at, Raju?
Price to book, it seems attractive, 1 point something.
Yeah, 1.1 times. All right, let me take this question to Saurabh. Saurabh, trailing price to earnings also not very expensive in the larger scheme of things. Would you suggest that it's a good company to look at from the long-term perspective?
I mean, the company is good enough, and from the valuation perspective, as you have stated, it's pretty close to book value and 9 times to its trailing earnings. Overall, we have a view that the metal industry will grow and the activity will improve going in the second half. I think the company may get benefit of the higher prices going forward also. So I think he can go for a buy.
9.5 times trailing price to earnings when the industry is trading significantly higher. Raju, good spot, and wish you luck with that investment. And we'll check back with you later to see whether it makes sense for you. Maybe you can call us back and see what the view is. Harshit has got a pretty broad-based question for you, Ajit, and he's got a time frame of 7 to 10 days, which is a relatively short one. And he's got 50,000 rupees that he's looking to deploy. And I think there are a lot of people who are sitting on the sidelines and waiting for the bottom, but have missed out on the opportunity on account of the move over the last couple of weeks in particular, right? Last week in particular, you're talking about the benchmark gaining over 4% and the broader markets gaining over 5%. So where would you deploy?
So Alex, you rightly mentioned, means if you see that last week also all the sectors were ended in green and the broader markets were up in the range of 79%. So obviously it seems like that, I've missed out the opportunity. But if you'll see on the stock specific front, you still find decent opportunity across the board, especially in the banking, which was sitting on the sidelines. So let's say Axis Bank, which is currently quoting at 12.15, is something that one can look to go long if the view is very short term, and 1180 should be a stop loss and 1280 1300 should be a target area. Another safe bet which seems stable to me, and as a disclaimer that we have recommended to our client of late, is GAIL India. So after the recent correction, the stock has witnessed a fresh breakout today, and we are anticipating that close to around 198 to 200 is something the stock might test in a week. So here also the risk reward is favorable, means with the stop at 186, he can invest for next 7 to 10 days.
Okay. All right, so that's the view on which stocks you can look at. I missed taking this earlier. Premier Energy is in focus on account of its quarterly earnings, and this is a question from Santosh, who's writing in from Chennai, and he is holding since IPO levels. He's asking whether he can accumulate both from a short-term and a long-term perspective. Saurabh, on the fundamentals?
While the company has put up a good show and they're quite optimistic about the higher growth going forward, but on the valuation front, I feel the stock is quite expensive. So in my sense, it should be avoided.
Be avoided. All right. By the way, take a look at the update on the bottom of your screen. That is the latest update on Vodafone Idea. The government has rejected the plea that was made recently by the company. We'll circle back and get you the implications of that in just a bit. It's time to hit the rapid fire round. And this, by the way, is where we take as many questions over the span of 2 minutes. The first question is from Suchit Joshi, who's asking about Bharat Dynamics, bought at levels of 1841.66 rupees. He's asking whether he should book profits at this point. Ajit, on the charts?
Yeah, book profit and keep on trading stop losses in all the defense stocks.
Yeah, he's already lost the opportunity. It's trading flat. All right. Natco Pharma is the name of the counter. 121 shares, bought at levels of 910. What is the outlook going forward? The stock is up 3%. Ajit?
Recovery expected, hold 850 stop loss, 910 target.
Okay, ITC, should you buy it right now? Ganesh wants to know on the fundamental, Saurabh.
Buy.
Buy, all right. Okay, ITC Hotel. Okay, there's another question from Dhananjay who's asking about ITC Hotel. Is this the right time to buy? From the hospitality pack, Saurabh?
It's a buy.
It's a buy. Benson wants to know about Chennai Petroleum. He's got 18 shares at a price of 624 and he's holding based on the fundamentals. Should he hold or should he switch to something like an IOC? Saurabh, on the fundamentals?
I would recommend to book profit and won't recommend to switch.
Okay. Transformers and rectifiers. Long-term view is being sought by Lavanya, who's writing in from Chennai. Would you buy Trill at this point, Saurabh?
Yeah, you can buy.
Okay, Ambuja Cements is the name of the counter. Short-term outlook is being sought. Sunita from Hyderabad is asking. She's bought at levels of 502, is in the green. Ajit?
Hold, maintain a trailing stop at 550 and 585 target.
Okay, UCO Bank is the name of the counter. Partha from Kolkata is bought at a price of 49 rupees a piece. And so is seeing a loss right now. He's a long-term investor. Should he hold or exit? On the fundamentals, Saurabh?
Switch to Maharashtra Bank.
Okay. Aswini from Chennai is holding Eternal at a price of 271. He's looking for a time frame for the next 3 months. Should he hold or sell? What's the view? Ajit?
Hold, 225 stop loss and around 270 review.
All right. That brings us to the end of this edition of Ask Profit. Lots to talk about in terms of news updates. Saurabh as well as Ajit, thanks so much for joining in. Pleasure having you on the show. Do stay tuned. Up next is Know Your Company, and this is NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome. You're watching KYC. I'm Harsh Saita and with me is Anushi Vakharia. What we're going to do today is we're going to speak with Inox India and we're going to try and break this one down. Very interesting business. That's one reason why we've taken it up. Very low debt in terms of the relative capex that it does versus the debt that it takes up is nearly zero. And it's a business with a decent, deep kind of moat. As I was speaking with analysts, and what one analyst told me is that the number 2 player is 1/6 the size of Inox India, and therefore just the size of Inox India in terms of the business that it does, it has in a certain sense a very deep moat, a pure make in India story. Okay, but the risk of course is therefore tariffs. Anything to do with export could impact the numbers for Inox India. Any kind of headwind with regard to export, whether it's freight, whether it's tariff, all of those could well impact the business as well as the top line and margin for an Inox India. So that's point number 1. The second point is that with such a large market share, you could see market share erosion. What is the risk of that is what I'd want to ask the management as well. The third piece is the working capital outlook. The working capital requirements have gone up. Your cash flow from operations haven't kept pace with profit growth. Has this really peaked? Is there going to be an adjustment in FY26 is another question which I'd want to ask. The kegs business. Now this is where some good chunk of growth is going to come from. I'm going to give you some numbers. H2 of FY25, they've sold 50,000 kegs. The guidance for FY26 is so strong. 3 lakh to 4 lakh kegs is what they're planning to do in FY26. I want to understand what makes them so bullish. Does order inflow and business growth outside of kegs also add up? And what's the risk that if kegs would miss in terms of numbers, what is the downside risk to both top line as well as margins? They've guided for an 18 to 20% top line. I want to understand what the risk of that is. And the last one, what are they currently investing in? Where is the capex going? Where are they going to lever their growth outside of their conventional verticals? That's what I'm looking for when I'm looking at this company. It's a niche company in a very niche space, and that's why this one really stands out for us. Let me start off by describing what the company does. It's a manufacturer of cryogenic equipment. I'm going to double down and probably try to over explain what exactly is this equipment. It's used mainly to handle and operate material at extremely low temperatures. So just think about operating, transporting, storing material, whether it's gases or liquid, at sub minus 150 degrees. That is some seriously low temperature. You would require high quality, high precision, solid equipment to actually do that. This is where the business moat comes from, and Inox India is one of the very few which has the capability of manufacturing such equipment. Who uses it? Let me talk about that. One is it's used in storing and transporting LNG, liquid hydrogen, liquid oxygen, liquid nitrogen. So where all are they used in terms of the verticals? One is medical, something like storing blood, biological samples, cryosurgery, as well as liquid oxygen. All of those used in the medical space. These are just illustrative. The uses are maybe a few more than these, but broadly just giving you an understanding of what it does. Transport, LNG, hydrogen powered vehicles. That's where some of this will be used even going forward. Food, something like rapid freezing, preservation of food, green energy, development of hydrogen power. Those are some use cases where some of their equipment is getting used. Now let's talk about Inox India in particular. Inox India has 30 years of experience. It's a leading cryogenic tank manufacturer in the world, one of the leading ones. It has solutions across design, engineering, manufacturing, and installation of these equipment. It also does maintenance of these equipment and systems, and therefore it actually takes care of not just the one time but also the recurring thereafter. It has 3 divisions currently. One is the industrial gas division, which manufactures, supplies and installs cryogenic tanks. It enables storage, transport and distribution of industrial gases. LNG is the other piece which it does. Manufactures and supplies and installs standard and engineered equipment for LNG storage, distribution and transportation. It gets a lot of its orders with regard to LNG even from India, given the India requirement. And then you have Cairo Scientific, where it provides equipment for technology and intensive applications. Cairo Scientific is what has led the numbers in this particular quarter. So Cairo Scientific is a slightly nicher segment where you may not have as many players, and there is a far heightened amount of precision which is required. Let's talk about products now. Industrial gas. The use case is bulk storage, transport and vaporization. Again, some of this may sound repetitive, but what we've tried to do is try to break it up and present it as concisely as possible for a lucid understanding. So, bulk storage, transport, vaporization. What are the products available? Tanks, which are available for storage and transport. Vaporizers and piping is also what they sell, and oil and gas equipment. So these are their 3 products in the industrial gas space. In the LNG space, they are providing products for aiding storage and transport again. LNG infra is the other space in which they operate, where they give industrial applications and LNG equipment. So some of these are use cases, some of them are products as well. Then there's Cairo Scientific. This is used for clean energy, advanced technologies and turnkey solutions. So what are the products here? Satellite and launch facilities use some of the products which are provided by an Inox India. And then there are propulsion systems where some of these products are used for the purpose of satellite launches, etc. You're talking about thereafter sustainable industrial packaging. Here it is used in containers and kegs. Kegs is the new business, or the business which they started in FY25. Industrial containers, beer kegs. Let's talk about Cairo Bio. This is used in dairy organizations, for animal husbandry, cattle breeding, infertility clinics for humans as well. Pharma companies use it even for biosamples, when you're collecting and when you're transporting biosamples. What they do in terms of products here is containers and tanks. A lot of the products that they do is containers and tanks. And this is the last piece, cylinders. Use case, they allow for storage of gases. So this is how it really stacks up in terms of product as well as in terms of use case. We hope we've tried to do the best we can to try and get you an understanding of exactly what this company does, because it's in a very niche space, right, Anushi? You want to add anything with regard to the product line?
So, you've given a very precise description about how the products are shaping up, the 3 main divisions. It's, the cryo division, which is important for the company. A lot of key growth expectations that we are seeing is stemming from this division. So, let's do and walk through the numbers if we can. I'll start
let's do that.
Yeah. So if you're talking about the revenue, now it's been a stable sort of a picture that we are looking at in terms of where the growth is concerned. So FY23-24, we saw about a 17% or a 23% of an odd growth. In FY25, while we did have a slow start to the year in terms of where the 9-month picture was concerned, it was the 4th quarter in particular wherein the revenue growth was back at it at 16%. The company ended with a 16% of a growth. Margins have majorly remained stable in the 21 to 22% of a range that we are looking at. And if you talk about the profit growth in the last 3 years, taking the CAGR of that roughly stacks up to 20%. So it's an overall decent sort of a picture that we are looking in terms of where the income statement is concerned. Again, order backlog is interesting for the company, as that would provide the visibility for revenues going forward. at the end of March, the order book stood at about 1,356 crores. Order inflows were up around 28% for the year. Do note that the company had marked a couple of large order wins, in particular FY26 remaining important in terms of where the cryo division is concerned. So overall picture on the order backlog side and the income statement side remains on the healthier side, right, Harsh?
Absolutely. So it's looking good. What I'd want to understand is how much of this component in terms of top line growth going forward will get added by the beer kegs business.
Right.
And how much of that are they able to deliver? Because they've spoken quite a bit about it. Q1, Q2, Q3, all the con calls mention it. Q4 also mentions it. But we've not seen that translate to numbers. So something that we need to really watch out for. Let's talk about balance sheet. Not too much here. I'm not going to go into detail because you've got very, very low amount of borrowing. It's a 10,700 crore odd market cap company with almost zero debt and a decent amount of cash balance. So definitely a thumbs up on our KYC metric here. Let's talk about cash flow as well. Anush, you want to take that up?
Yeah, so in terms of where the cash flows are concerned, around 122 crore of odds. So at the end of FY25 is what we are looking at. Majorly no changes from the previous year. What we are seeing, net cash flows almost negligible at the end of this financial year. Interesting would be to understand the working capital of the business, because if we break down the cash flow from operations, we have seen a pickup in terms of where the receivables are concerned. There's an increase over there and also on the inventory front. So management commentary on how there would be improvement in cash flows and the net working capital cycle is something that we should be focusing on, right, Harsh?
Yeah, we've seen that. We saw that kind of uptick. And see, I mean, they've maintained it at these levels when I'm looking at FY22 versus FY23 versus FY25. Actually, FY24 was a year when those numbers compressed a little bit. And that's why you're seeing a little bit of that impact coming in with regard to FY25 cash flow from operations per se. But otherwise, we've seen a decent trend with regard to cash flow from operations. But let's talk about the other metric, return ratios, and this is where it gets really impressive. The ROE and ROCE metrics, very solid. You look at those numbers and you'll agree with me that it's a thumbs up. But shareholding pattern.
Shareholding pattern after now the company marked its listing in December 23. So from there onwards, we've not seen a particular change in where the promoter holding is concerned. It's remained very strong at the levels of 75%. If you talk about FIIs, now we've seen a pickup in terms of where the FII stake is concerned. So from what was in December 23 around the levels of 4.65% has moved upwards in the range of 6.9% is what we are seeing. DII is mainly stable around the mark of 6 to 7%. So overall, it's a good mix that we are looking at in terms of shareholding pattern as well.
Okay, so that's shareholding pattern. Let's talk about street cred. Stock's not done too much when you're looking at the last 1 year and the year-to-date numbers. But since listing, it's up around 28%. So a decent kind of uptick. But would you say that they've left money on the table for investors? Doesn't look like it, right?
Right.
Especially since December 23. Stock is up just about 25 to 28%. So that's how we look at it. We'll give this a neutral because we'll want to wait and watch as to how performance continues. You want to take the outlook?
Yeah, so if you talk about the outlook forward now, see, in FY25, what we saw is about a 16% of a growth. They've given us projections for the year forward, that's FY26. Revenue is expected to see about a 18 to 20% of a growth here. EBITDA margins also majorly in line with what the historic trends have been in the mark of 22% or 24% of an odd is what we are seeing. PAT margins again at the mark of 15 to 18%. Now, if you break down the segments for you, now industrial gas segment is interesting, 16 to 18% is the growth expected here. LNG now that has seen, if you take that segment into consideration, that is expected to see about a 20% of a growth. But you know, as Harsh was talking about it in the beginning, it's the beer keg division which is interesting. Now, the Inox sold about 50,000 units in FY25. They currently have a pipeline of around 3 lakh to 4 lakh. So that's almost a 6 times of a jump that we are looking at for FY26. Now, with some of those approvals, some issues which were there in FY25 now subsiding, interesting to see what's the kind of growth that they expect from this division. So overall, even in terms of outlook forward, the guidance that the company has given is mainly on the consistent side is what we are seeing, right, Harsh?
Well, yes, it seems like. Let's quickly look at how the valuation stacks up for this, and we'll reverse engineer this a little bit. So market cap currently at 10,600 crore. The FY25 numbers versus FY26 estimates and FY27 estimates. What we've done is we've estimated a sales growth of roughly 18 odd %. 1,300 crore is what they've done in FY25. The estimate for FY26 expected to be around the 1,550 crore, and the FY27 estimate expected at around 1,800 crore. What's the downside risk to that? We'll have to wait and watch, but we'll talk about valuations till then. The EBITDA margins we've expected around the 21 odd % mark, and the PAT margin expected at around 17%. That's how your MCAP to EBITDA works out, and that's how your price to earnings ratio also works out. So 35 times FY27, certainly not looking cheap. Something to be watched will be the execution part. How well can the group continue to execute? See, they've done very well. That there's no doubt on. The last 5-year data seems to suggest that it's a strong set of numbers that they consistently post. But can that sustain will be the question. Let me bring in Mr. Siddharth Jain. And actually, let's quickly also have the KYC ratings while we are at it. But let me bring in Siddharth Jain, promoter and director at Inox Group, to talk to us about Inox India and what to expect from the numbers going forward. First off, Siddharth, good speaking with you. Thanks for coming in. I want to first talk about the beer kegs business. There was plenty of anticipation in FY25. FY26 also, in terms of expected numbers, there's plenty of anticipation. Talk to us about what's the likelihood of these orders translating. That's the first part of my question. Second part, you're building in 18 to 20% growth. How much of this comes from beer kegs? What are you anticipating in terms of numbers?
Good morning, everybody. Hi, Harsh. First of all, thank you for having me on your show. And
absolute pleasure.
I was hearing your commentary for the past 5 minutes. And I'm extremely impressed with the in-depth analysis that you've done about the company and how you've presented it to your viewers. So thank you. I think you've done a much better job than I could have.
Thank you so much, sir. An appreciation coming from the promoter himself means the most to us. Anyway, so please go ahead.
Coming to the beverage containers division, as rightly pointed out by you, it's a new investment we made in Savli over the past 2 years. And I'm very happy to inform you and all your viewers that we've received approval from the 2 largest breweries in the world, AB InBev and Heineken, and since these have to be FDA approved and therefore global supplies in the food division, they have to go through the most rigorous standards and in-person approvals. Those guys traveled all the way from Europe, and now we finally have that. So when you've got a positive outlook from the 2 largest customers in the world, we hope to see those converting into orders very soon. What happened over the past year is that it takes an awful long time with these European vendors to get them to India and approve our facility. And after they saw it, they were very happy to inform us that, in fact, it was not only world standard, potentially some of the best that they've ever seen. So coming to your question on what percentage of this would be in our growth this year, out of the 18 to 20% that you mentioned, and we certainly hope to achieve that kind of growth. It's difficult to put a number to it, but a low single digits out of that should be attributed to this, primarily because all our other 3 verticals of industrial gas, LNG, and cryoscientific, all of them are firing very well as well at the same time. So I think we're in a good place right now.
Hi, Mr. Jain. This is Anushi joining in. Now, in FY25, there were some of these overhangs in terms of where the capacity constraints are. Now, that is lifted. For FY26, you're expecting about a 6 times of an opportunity for the beer kegs business. Just want to get your sense from FY27 onwards. What is now, while we do have a 18 to 20% of a projection for FY26, for FY27 or maybe the next 2 to 3 years, what's the kind of outlook that you see? Do you expect these margins to be better? Do you see a higher revenue growth, even if you take the other 3 main verticals in consideration? Want to get an overall sense on this.
No, Shreya, good morning. So, the way we look at growth, we look at it in batches of 5 years. We don't look growth on a quarterly basis or on a yearly basis. primarily because we are in the capital goods business. A large percentage of our orders that we're getting nowadays are in the non-standard EPC driven. You've seen our LNG order book. We had our highest order book last year of 500 crores. And I see that division continue to grow because it is a fuel that is being adopted at a very fast pace globally. It is a transition fuel before things go electric, and it is it is far cheaper than current fossil fuels, emitting far less CO2 as well. You've seen in our last quarter's order inflow, we've received some of these very unique opportunities of mini LNG terminals such as Bahamas. These are large value EPC orders which take 12 to 18 months to execute. So it's not just about shop capacity, it's about an entirely engineered solution to the customer to be delivered at site. Which is why you won't see exact 15 to 18% or 20% growth per year, but you'll certainly see that in a block of 5 years. And each of these verticals contribute a bit to it. And we're very excited about the growth possibility in each and every one of them.
You've got quite a few verticals, Siddharth. So give us an insight on the margins of each of these verticals. Does the beer kegs margin, is the beer kegs business margin accretive for you?
So the highest margin comes from a cryo-scientific division because that's by far the most complex division. I must give credit to our full team, and we're proud of it being in India, that we have, I would say, some of the finest brains in not only designing, engineering, we also do the manufacturing and execution on a lump sum turnkey basis for these cryogenic projects, which our competitors frankly don't have, and which gives us, a real edge in the market. So the highest margins we would have are in the cryo-scientific division, followed by LNG, which would be these more complex systems being executed, such as mini LNG terminals all over the world, followed by industrial gas and our beverage containers division, which would be similar margins. So I think they'll all be range bound. It's not about being accretive. We promise to keep the margins in the early 20s itself. Our focus is not to expand margins too much because in the capital goods industry, it is unnatural to have extremely high margins. Our goal is to capture a larger percentage of the global market share, not to expand margins to a very large amount.
Okay, so that's the margin outlook that you have, but I also want to understand on the order inflows. Now, FY25, about 28% of an odd growth that we've seen in inflows, a lot of portion of it also attributable to the export side of it. For FY26, is this kind of growth sustainable going forward? What's the key expectation here?
Anushji, first of all, our focus on exports is part of our strategy that we had spoken about during the IPO time, and which is primarily the reason we went for the IPO, is that we believe that the global market for cryogenic equipment is far greater than what is available in India itself. Not to say that India isn't growing, but our aspirations are truly global. We did achieve fantastic growth last year in terms of order inflow, and that was also driven by some great orders on the mini LNG terminal side. We hope to see that continuing. I wouldn't want to say that we are for it to reduce. There is very, very aggressive bidding going on, for very large number of projects, and we certainly hope to see them converted. I can't promise that we're going to beat last year's number or last year's growth number, but we certainly hope to achieve it.
And Mr. Jain, considering all of the global uncertainties that are taking place, are there any risk-offs in terms of where some of these orders are concerned in the global market?
Anushji, we deal, as you mentioned at the beginning, in a niche product which requires tremendous amount of engineering knowledge and skill. It isn't a product that can be easily replaced. We aren't a company that can be easily replaced. So in spite of the global uncertainties, since we are a very critical, high-value capex item, it's unlikely that global uncertainties will have any impact on our business.
Is the ROE, ROC sustainable? Because 25% plus on a consistent basis is hard to do.
Well, I certainly hope so. I don't see any reason why not. When we look at our balance sheet, we look at the amount of capex that we need to invest. We aren't a very capex heavy company. We, mostly an IP driven company. The knowledge base that we have, the skill sets that we have in the design and engineering, which leads to getting orders, high value orders. It all comes from the margin, frankly, Harsh. It's not as much about capex. It's about how to maintain margin, and that's what's going to give you the higher ROEs and ROC.
Mr. Jain, sorry, just 30 seconds is what I have. How is competition domestically as well as globally?
Competition will always be there, but I think we stand out, greatly because of the solution that we provide. And our knowledge across industries. Most of our competitors, specialize in one vertical. We specialize across verticals, and that learning across the verticals, combines, into a fantastic product that we provide to our customers.
Thank you so much, Mr. Jain. It's been a pleasure speaking, and love to keep track of this as well as speak to you every quarter to try and get better insight on how this is playing out. So thanks for coming in. But with that, we're out of time. I want to quickly just highlight all the KYC parameters that we've highlighted today for you. The income statement, the balance sheet, the cash flows are neutral, return ratios thumbs up, seeing shareholding, street cred, outlook, as well as valuations. We've covered all of those, and that gives us a 6.5 on 8 on our KYC rating. Very solid rating that Inox India has. We'll have to wait and watch how that plays out. But out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay
Hello and welcome to Markets at 12. This is Anushi Bakharia. Let's quickly see how the markets are faring currently now in terms of where the benchmark indices are concerned. Nifty 50, what we are seeing currently, cuts of around 0.1%. We've seen a bit of a pressure in the last half an hour or so. While we did see some flattish movements throughout the day, now it's in the red is what we are looking at. Just shy of the 25,000 mark is what we are seeing. Let's also look at the Nifty Bank, how that is faring in trade today. If you're talking about the Nifty Bank, that's doing particularly well, seeing about gains of 0.4%. In fact, let's pull out the point contribution table to see where we are seeing some bit of pressure in the benchmark indices. So Infosys, Reliance, TCS, 3 stocks in pressure, seeing cuts, while HDFC Bank, Bajaj Auto and SBI are in the green. In terms of where the sectoral action is concerned, let's pull out the sectors and see how that is faring. So in terms of that, we are seeing Nifty Realty as the top gainer today, gains of around 2%, Nifty PSU Bank, similar moves that we are looking at. It's Nifty IT where we are seeing some bit of pressure building in, cuts of around 1%, Nifty FMCG also down about 0.19% or so. Nifty Metal, we are seeing about cuts of 0.1%. So that's as far as where the sectors are concerned. Nifty Realty has been doing particularly well in the last few sessions itself. DLF would be in focus on the back of earnings as well. But let's see how the broader markets are faring in comparison with benchmark indices. So in terms of where mid-cap 150 is, that's up around 0.52%. Of course, outperforming where the benchmark indices is, and Nifty small cap 250 seeing gains of around 1%. In fact, let's look at the advance decline ratio to see how the market breadth is shaping up currently. So if we are looking at advances, around 1,700 advances to a declines of around 531. So that's the kind of ratio that we are looking at. Let's look at BSE 500 to see which are some of the stocks in focus here. So if you are looking at BSE 500, something like a graphite right at the top, seeing gains of around 15%, delivery buzzing on the back of its results. 11.3% is the kind of upside that we are looking at. HEG, another stock in focus, 11% of gains. However, on the downside, Credit Access Grameen seeing cuts of around 6.5%, of course, results being another trigger over here. For Nesco, 4% of a cuts. For Sterlite, also 4% of cuts is what we are looking at. But you know, one sector in particularly that we've been emphasizing is on the defense back. And now Zen Technologies did come out with its results. The stock currently, if you are seeing today, Nifty India Defense Index is seeing some bit of pressure after about a 19% of an upside just this last week itself. Centech currently locked in an upper circuit of 5%, and this is after its fourth quarter results that we are looking at. Now they've reported a revenue growth of around 2.3 times, margins expanded to 42.5% as compared to 35.7%. And in terms of how they've overall shaped up against the guidance given, they've surpassed their FY25 revenue guidance of 900 crores by 8%, while they've beat their EBITDA margin target of 35% and PAT margin target of 25%. It's the order book positioning that we need to focus on going forward for Centech, because if you look at the order books, that stood at 692 crores, which is around a book-to-bill ratio of 0.7 times. So this is below 1 times of level that we are looking at. So focus would now be on the new order inflows coming for the business going forward in FY26, especially after Operation Sindoor, more emphasis on defense prospects pipeline going forward as well. They've also had a couple of acquisitions through the year. This includes acquisition of Applied Research International Private Limited, which expands their presence in naval and maritime verticals. Along with that, Vector Techniques Private Limited, which reduces their dependency for indigenous drone manufacturers. Along with that, marking their entry into the drone ecosystem, along with something like Bhairav Robotics Private Limited, which fast-tracks the entry into the defense robotics sites. So this is what we are seeing for Zen Technologies, but we also have Data Patterns in focus. Now, what we are seeing for something like a Data Patterns is that they've also reported a very strong set of numbers that we are looking at. They've invested heavily on product developments, and their shares are also posted gains. They're looking at around 2% or so of an upside, cooled off from days highs is what we are seeing. So even here we have seen a revenue doubling to 396 crores. So this is the overall outlook that we've seen for Zentech and Data Patterns. Let's also talk how the management had seen what is happening with these two companies. So let's listen into that as well.
I think what's changed is the perception that India, the made in India brand has improved because of this. I think this was a fantastic marketing opportunity for us. And I do feel that some companies have really come out tops. They have proven their products, and the government is really very excited that it's not only. And so now the government has shifted from talking about only make in India for the India, but making in India for the world. Now they are trying to identify global champions. When we talk about being a net exporter, what we want is identify few product segments in which we can absolutely dominate the world and pour a lot of R&D amount into it, and then so export it to the world. But again, even before that, these companies should be have been battle tested. They have been also indigenous IP tested, in the sense there is a category called Buy Indian IDDM, in which they examine the IP content and they buy only Indian-made, Indian-developed drones and anti-drones. So I think this whole thing, from basically the effort that was started in 2016 by Mr. Parikar when he introduced the IDDM category, 2020 reiterated. So, and now we are actually seeing that in the battlefield, the products have worked. This is a huge thing, and I think the days for India to become a major defense player, not a made. So when people say make in India, I do get a little irritated. It is design, develop, and make in India. The IP is owned by us. We are not just partnering with it. So that's one category. Of course, there are other categories, as you said. We are collaborating with foreign players to develop locally and then sell it. Yes, but this is a complete India game now.
See, what we have done is, India is going through a phase of looking inwards. The government is fully supporting Make in India. But, all along, we have been importing products from abroad and relying on foreign OEMs to supply defense equipment. So it is a large opportunity for Indian world-class systems to address the gap which is there in the market. What we have done is we've invested heavily in product development in the last 1.5 years. We went for a QIP and raised about 500 crores. We are spending the money to build radars, fire control radars, EW suites, communication equipment, seekers, a whole range of systems with local IP and building world-class products. Second, we are also building the required infrastructure. In the event that the contracts happen, we should be ready to deliver on the large opportunities. Third, we have now raised our engineering staff strength to nearly 1,100 people. We still continue to raise people, recruit people, and build competencies to see that we can go ahead in building Indian products as required to address the large opportunities. We're very bullish on the opportunities going ahead, and we are investing against those opportunities. This is what we're doing. So looking at the last year versus this year, we still retain the guidance of 20-25% top line and bottom line growth. The contract situation on the orders and position is a bit weak, as you said, but that has been delayed for no reason of ours. But this is all happening. We are now expecting a number of contracts to happen in the course of this year. One, on whatever we delivered products, which is getting repeated, and completed trials, we expect the contracts to happen. Two, also because of the existing skirmishes in the border, there is some amount of fast tracking of contracts is expected. So we are very bullish on the growth opportunities of Data Patterns.
Well, that's the outlook for defense that we are seeing in terms of where the order pipeline could be for these companies. That's Data Patterns and Centech for you. Let's shift focus to the auto space. Bajaj Auto International Holding BV takes loan of over 5,500 crore rupees from JP Morgan, DBS Bank and Citigroup ahead of KTM restructuring deadline. Tushar joins us to tell how this loan rescue will shape up.
Good afternoon, Anushi. So while Bajaj Auto has not declared why it has made this borrowing about 566 million euros, but cannot be just a coincidence, because just a few days later on 23rd May is coming up the KTM restructuring deadline. KTM has to submit to creditors 548 million euros to actually push ahead its restructuring process. That's the first step that it has to do. In all, the company, the Austrian bike maker, needs about 800 million euros to pay the creditors as well as restart operations in its Austria-based plant. We have to also see that Bajaj Auto has been quietly investing in KTM over the last few months. It just cannot be a coincidence. First, in February, Bajaj Auto invested about 150 million euros in its overseas investment vehicle, then topped it up with 125 million euros in May, earlier this month actually. In between these months, from February to May, Bajaj Auto International Holdings actually invested 50 million euros in KTM AG 4 times between February and May. So a total of 200 million has already gone into KTM. This particular tranche is also coming in 566 million euros against 548 million euros for KTM. Bajaj also has not on record confirmed that this investment or the loan is for KTM. More clarity should emerge when Bajaj Auto declares its fourth quarter earnings on 29th May.
Okay, so Bajaj Auto in focus on the back of that, another stock which is in focus is something like Dodla Dairy also. We've seen a revenue growth of 16% currently, net profit up over 45%. The stock is reacting based on its earnings, stock up over 2.8%. Another stock which is also in focus is Delivery. Now this stock is up more than 9% as the company had a strong fourth quarter numbers. We have Mahima with all the details on this one.
Delivery has seen a good set of Q4 numbers. But is the kind of substantial margin expansion that has taken place for the counter. EBITDA was also a significant beat despite revenues not, revenues seeing a single-digit odd growth. And the part truckload business is something that has contributed significantly towards margins as well as the overall growth in terms of EBITDA. Express growth, however, Express Delivery growth has remained tepid. In terms of numbers, revenue growth was at 5.6%. EBITDA stood at 119 crores versus that of 45 crores, so it's almost more than doubled. For margins, they expanded to 5.4% versus that of 2.2%, and net profits stood at 72.6 crores versus that of loss of 68 crores. So the company is also turned into profitability versus loss last quarter 4 FY24. Now in terms of what has led to growth, part truck volumes were up almost 19% and it was up 24% in terms of its revenues. Express delivery margins have also improved, and this is due to mid-mile utilizations improvement. Freight handling margins have improved due to lower contractual manpower as well as line haul expenses. In terms of what brokerages are penciling in for this particular counter, Goldman Sachs has maintained neutral but hiked the target price to 325 from 290. What they're saying is that margin sustenance over the next few quarters would be a critical thing to watch out for the stock performance. Morgan Stanley has also maintained equal weight and with a target price of 320. What they're saying is that express parcel volumes and yields were lower than estimated, but the overall part truckload business revenue did beat versus estimates. And lastly, other business performance was also a miss in terms of what the street was expecting or what they were expecting. So this is the overall view as to what has worked for Delivery.
Okay, so Delivery in focus on the back of its fourth quarter earnings. But DV's Lab is another stock. DV's Lab, Neogen Chemicals, if you can see how they are reacting in trade. While DV's Lab, we are seeing gains of around 6%. Neogen Chemicals is under pressure on the back of its earnings. And we have Varsha to break down these numbers down for us.
So let me start with DV's Lab. Good set of numbers. Net profit did beat estimates. The revenue growth that you're seeing is led by the generic and custom synthesis business. EBITDA margin expansion that you're seeing is led by gross margin expansion and lower other expenses. On the segmental contribution, if I were to talk about, the custom synthesis business grew almost 12%, contributing 50% to the overall revenue, and growth was led by existing and new commercialized projects. Custom synthesis will continue to fuel growth. On the generic segment, it grew 13%, accounts for 49% of revenue. Stable price erosion drives generic segment growth, and growth was led by volume, and they're expecting growth in generics to be more volume based. On the con call highlights, they are expecting double-digit growth in revenue when it comes to FY26. Company's progress in contrast media remains steady and encouraging. The Kakinada unit is gradually ramping up, have started also production. The backward integration from Kakinada unit is expected to see benefits in phase 1, and management guided for another 2 billion capex expected from the phase 1 completion of Kakinada. While on Neogen Chemicals, weak set of numbers, but this was expected. If you see, the revenue growth is just 1% because of the lower bromine prices year on year, which impacted revenue trajectory. Lithium prices decline year on year basis, and the revenue growth of 2% that you're seeing is led by volume in base business. Prices across all the verticals remain soft. Profit impact that you're seeing, because there's a huge profit impact, profit is down almost 7x. This was led by an exceptional item due to a fire incident at Dahej plant, which leads to 14 crore of expense.
Okay, thanks for that, Varsha. But moving to the telecom sector, the Indian government has turned down Vodafone Idea's plea for fresh relief on its adjusted gross revenue dues. This is days after the debt-laden telecom operator filed a fresh petition before the Supreme Court. My colleague Aishwarya joins us to tell us more details on what's happening here.
And I think your clutches well, as far as AGR dues with respect to Vodafone Idea is concerned, what we're hearing, and of course we saw in the court filing as well, that the government rejects Vodafone Idea's interest as well as penalty request. The plea was upwards of 45,000 crore rupees towards the interest as well as penalty. Now, government says that the request cannot be considered at this point, and the matter, of course, is sub judice. This evening, Vodafone Idea has its plea. In fact, submissions will be given from both the sides. It has been scheduled at the Supreme Court today, and we will be closely watching that. But what's important is that since Vodafone Idea's plea has been rejected by the DoT, Airtel also, which has earlier followed into the footsteps of Vodafone Idea in terms of waiver of interest and penalties, that might also possibly be affected or impacted, and that is something that we really need to watch out for very closely.
That's the update that we are looking for Vodafone Idea. Thanks for that, Aishwarya. But shifting focus, Commerce Minister Piyush Goyal left for the US to participate in trade talks with his counterparts there. Remember, Donald Trump has been continuously putting pressure on India during the bilateral talks. Apart from calling India the country with the highest tariffs, he recently stated that he asked Apple's Tim Cook to move production of iPhones out of India and to the US. Rishabh joins us now to tell us what is on the negotiating table now. Rishabh, what are you hearing?
Right, what we're hearing is the fact that Piyush Goyal is in the US to lead trade talks for the third in-person round of negotiations between India and the US. What we're also expecting from Goyal is the fact that he is set to hold meetings with two very important figures of the Trump administration. The first one being the US Trade Representative Jamieson Greer, the second one being his counterpart in the US, the Commerce Secretary Howard Lutnick. What is expected from the various, I think, 3 to 4 days talks is also the fact that he will also build upon the already done negotiations over the past couple of months. Remember, a team from the US had visited New Delhi, and a team led by Chief Negotiator Rajesh Agarwal, who is also the Commerce Secretary designate, had also gone to Washington last month. So this time we're seeing sort of a deepening of these talks between India and the US. Two very important contextual points also coming in as part of these talks. The first one being the easing of the US-China relationship that is also set to sort of dent India's pitch to the world as a global manufacturing hub, as an alternative to China, if US and China, that relationship is mended. And secondly is the retaliation or the sort of posturing that India has done at the WTO with respect to reserving the right to retaliate against US's steel, aluminium, auto parts tariffs that continuously exist, that is currently being levied. What is also very interesting is the fact that the last time the Commerce Minister Piyush Goyal went to the UK, he came back with an FTA announcement within a few days. So, and what is also noteworthy here is the fact that because there is no sort of ruling out from any of my sources that a mini trade deal or an early first tranche of the deal cannot be done before July 8th. There's no ruling out of that possibility as well. So all eyes peeled on Washington, given the fact that India's chief negotiator Rajesh Agarwal as well as Commerce Minister Piyush Goyal are both in Washington for trade talks.
All right, Rishabh, thank you so much for breaking that for us. And in fact, the two key takeaways are that the deal might not be closed before 8th of July, and plus the amending of US and China relations might overall impact India's relation with US as well. All right, with that, let's also shift focus to KRBL. It came out with its earnings. It's a strong set of numbers, largely led by exports. Profitability and margin improvement was on account of lower cost of raw material as well as lowering of finance costs. The company, the stock is seeing an up move of 7% in trade today. Revenue was up 9%, EBITDA was up 25%. Margins stood at 15.5 versus that of 13.5, and net profit was up almost 35%. Now, to discuss as to how the quarter has gone by and how overall FY25 is shaped up, we're joined by Ashish Jain, CFO of KRBL Limited, joining us now. Ashish, good afternoon to you. My first question to you is, how has overall Q4 panned out? Was it up to your expectations?
So FY25, I think we was on expected lines. At the beginning of the year, we had said two things on the export side. One is that we would address the distribution challenges in one of our key export markets. And the second would be that the private label business should do much better than what it did earlier. I think on the first point, I think that journey has begun. The process has begun in terms of addressing the distribution challenges, and the impact of that is visible both during the year as well as in the fourth quarter. On the private label side as well, we've done as per our expectations, and both of these fold into the export performance that you see for the year as well as the quarter.
Okay, got it. Ashish, just wanted to get a sense as to what the volume versus value growth has been like, because I believe price hikes would have been taken this quarter. And overall, what's the gap between volume versus value?
Yeah, so if you look at rice basmati volume overall, we are in the quarter, we've seen about 10% volume growth. Similarly and this is on the basmati side, and similarly on the value side, we've seen about 10% value growth in the quarter. For the year as a whole, the volume is at around 5% and the values are around 6%. This is for basmati, right? So this is on expected lines.
And do you think that value growth will be ahead of volume growth going in FY26 as well for basmati?
See, difficult to say for the year as a whole, but I'll give you a sense of the price that we saw. See, for most of FY25, rice prices were subdued. In fact, if you look on a year-on-year basis, the rice prices were around 20 to 25% lower. And in fact, they were falling continuously. Only in quarter four and towards the second and third month of quarter four have we seen the rice prices stabilize. So as far as the volume is concerned, on the export side, with the distribution challenges, etc., getting addressed, and the private label business should also continue to perform at similar levels. On the price side, our current outlook is that prices should now remain at the current level. I mean, this is what we feel right now. Of course, the whole year has to evolve. So with that, we should see reasonable volume as well as value growth in FY26.
Got it. And in terms of your domestic revenues, because your export has done significantly well in terms of this quarter growth, also it's grown over 44%. But domestic business is something that has remained flat this quarter. FY25 growth has also remained at just 2%. What has led to that? What's not working there? And do you think that this will improve going ahead? And if yes, what will be the levers that will lead to that recovery?
Yeah, I'll explain. So in our view, I think domestic business has shown reasonable performance. And I'll explain why. See, if we look at our branded basmati volume growth in FY25, right, it is in line with the overall category growth that's been published by agencies who track it, right? The challenge on the branded basmati side has really been realization, which, like I mentioned, rice prices were dropping. In fact, till January 25, the rice prices were dropping. Now they seem to have stabilized. Now, as against a commodity price drop of anywhere from 20 to 25%, our realization has dropped by very low single digits. So to that extent, we've passed the storm from a realization point of view. And given the current outlook, which is that rice prices stabilize, you should see this realization impact getting addressed in FY26.
All right. And in terms of one more observation in your balance sheet, I saw that lease liabilities have significantly gone down. I mean, they've almost halved as compared to FY24. And because of which finance costs have also gone down. What has led to this? And do you think that this kind of number in terms of lease liability is sustainable?
So yes, finance cost has come down, but the reason is relates more to our working capital borrowing rather than lease liabilities. Now, although we bought similar rice equivalent quantities in the last season, which culminated in December 24, but because the paddy prices and the rice prices were lower, it required a smaller amount of working capital to be invested. So because of that, we borrowed less during the season, which is why you are seeing lower finance cost in Q4 and also for the year.
Right. Ashish, your export business revenue in Q4 stood at around almost 419 crores and it grew by 44%, and right now almost 30% of your total revenues is from the export business. Just wanted to get a sense as to what's the outlook like for FY26 when it comes to rice exports, and do you think that overall there will be a change in terms of mix in terms of domestic sales versus export sales, and then will the margins improve on the export front, and overall blended margins will also improve, because I believe that margins in the export business are going to be better than that of domestic business?
Yeah, so see, the growth of 44% is obviously coming on the back of a small base, because in Q4 last year, there were challenges with respect to the export business. So I would not project that for FY26. However, we feel that the long-term growth averages of the export business should resume in FY26. Now, in terms of margins, of course, exports do give higher realizations and therefore tend to have higher margins. So I think on the revenue side, if that delivers, you should also see improvement in margin over overall FY25 levels.
Overall FY25 levels margins should be something to watch out for FY26 as well, and Q4 is a good picture to kind of figure that as to where margins will be in FY26. All right, my next question, Ashish, is that is there a kind of change in terms of channel mix strategy that you're adopting? Because I don't remember the last time I went to a retail store and bought rice. Right now everything's being done through e-commerce and quick commerce. Just wanted to get a sense as to what is the trend like that you're observing, and is there a shift in terms of strategy when it comes to channel distribution for you?
No, sure. So you are right. QCom is the fastest growing channel in our domestic business, right? And in fact, we see that it has affected the growth of other channels. So, however, in terms of what we are doing to address it, I think, see, QCom as a channel requires completely different capabilities. Over the last 2 years, we've developed a team that focuses on that channel, and from what I read, other players are also doing that. So, but we are fully cognizant of the potential of that channel and are gearing up to kind of meet it.
Got it. And just one last question, Ashish, before I let you go. FY25, you've done almost 5,600 crore in terms of revenue and 470 crores in terms of net profit. Your 3-year CAGR has been at 10%. Just wanted to get a sense as to how FY26 will pan out. Just a brief in terms of percentage, what is the growth that you're penciling for the top line and bottom line?
See, we don't give out guidance, but we expect FY26 to be a better year in terms of sales growth for the factors that we've discussed broadly, stabilization of realization on the domestic side and higher volume growth on the export side.
All right, Ashish, thank you so much for giving us all those insights, and thank you so much for being candid with all those answers and taking us throughout how Q4 FY25 panned out for you. All right, so that was the management of KRBL indicating that FY26 is going to be better than that of FY25, and that margins could improve on the back of better export sales. With that, it's a complete wrap on this edition of Markets at 12. Stay tuned to NDTV Profit, more lined up on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Welcome to NDTV Profit and Profit Buzzers. My name is Varsha. Let's see how markets are doing today. So Nifty 50 is, I would say, a flat kind of thing. It's trading, it's like at 25,000 mark, but it's little under pressure, 0.03% down, but yeah, it's under pressure. But let's see who are the constituents when it comes to Nifty 50. Let's see who are the losers. You have, Eternal, that is Zomato. You have Infosys, RIL, TCS, and others which are on the loser side when it comes to Nifty 50. But on the gainer side, though, you have HDFC Bank, Bajaj Auto, Eicher Motors, and Hero Moto, NTPC also on the gaining side. Even Power Grid is actually buzzing on this on the trade today. Will announce results today. On the sectorial heat map, let's see. When it comes to sectorial heat map, Nifty FMCG, Nifty IT, Nifty Media are actually under pressure, but Nifty Auto, Nifty Bank, and Nifty Pharma, Nifty Realty are in the gainer side when it comes to sectorial heat map. But on the let's see how are broader markets performing in trade today. Let's see Nifty 150, Nifty Mid Cap 150 is up almost 0.6%. Let's see what the gainers when it comes to broader markets. That is Nifty Mid Cap 150. You have Delivery buzzing today. Let's see what that stock is doing. Delivery is up on the back of Q4 numbers, but guys, Protean E Gov is one of the stock which should definitely we should talk about. Locked in a lower circuit with losses of 20%. Now this is after company announced that it has lost the PAN 2.0 government project. A few brokerages have downgraded the stock as the PAN business generates 50% of revenue. The company is now addressing a business update conference regarding the same. Let's cut across to that.
Put out by the Income Tax Department. Over the weekend, we received feedback that our current bid has been considered unfavorably at this stage. We have reached out to the tax department to seek further clarity. And while we are in the process of doing that, we wanted to just share with you that that is the status as of now. With regard to the PAN RFP 2.0, as we've earlier mentioned, the RFP was with regard to design, development, integration and management of the tax ITD systems, which today we don't manage. This is a system which is used for allotment, updation, and correction of the PAN data, which is today run by the ITD department. We currently have a mandate from IT department with regard to the processing and issuance of PAN cards, primarily meaning that we collate the data from the individuals who are seeking a PAN card or any PAN card update, and the same information is sent to the ITD department for them to then do the allotment and issuance. And we, as of now, see limited impact on that. And the RFP, as we see it, would anyway take around another couple of years for implementation. So currently, at present, we don't see any immediate operational impact on our current PAN business. I would like to open it for questions with regard to this. So over to you, please.
Thank you very much, sir. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Prakash Kapadia from Spark PMS. Please go ahead.
Yeah. Wanted to clarify, you mentioned in your opening remarks about the PAN2 project. So is this right understanding a PAN2 is more of a IT related project and the operational modalities currently which we are doing in terms of issuing PAN cards, dispatching PAN cards is not part of the scope of work of PAN2 refresh? Is that understanding correct? And if not, then, can you just highlight the difference as to, what is the scope of work and how is it being currently done? That will help clear a lot of doubts.
Sure, Prakash. So, Prakash, I'll just give a little bit of background. We received the mandate for PAN issuance in 2002-2003. So this mandate was given for collation of citizen data, which is towards application of the PAN card, and then sharing it to the IT department, where IT department then does the allotment of the PAN card number, which means they do all the deduping of data and everything to ensure everybody has a unique card, and that works at the ITD end. The work that we do in line with the fact that this is a citizen-centric national ID. So we have both channels today where we have a huge distribution network where we provide assisted services. We have a network of almost 400,000 agents across the country where any citizen can go and submit their PAN card application. And there are also today direct channels on which you can directly apply for a PAN card. So this is about processing of the PAN data and then getting the PAN card issued to you. The PAN 2.0 RFP is to do a tech revamp of that entire tech stack which ITD has. And that, in a way, is not directly linked to the entire distribution and application process for the PAN card. And therefore, we are saying that while it is a separate IT project, as of now, as we see it, it does not impact the distribution and the processing part of it. Currently, almost 3/4 of our applications are today still processed in an assisted mode, which means somebody is using the help of an agent to be able to submit the application, which is passed on to the ITD department. And that distribution is something which we today run as a multiple product distribution, PAN services being one of them. Plus that answers the question to an extent.
Right. And we've been hiring a lot of employees upfront to, build execution capabilities. Obviously, this is across the line of businesses and multiple business revenues we have. So is, the employee cost and some of the, increases which we've seen was in anticipation of this too also, the PAN 2 coming to us, because, we were pretty gung-ho and confident, given our leadership and whatever work we've done, we should be a very strong contender to the PAN 2 project. So what I'm trying to understand is, assuming, there is no update and, it is awarded to somebody else, how will, the cost shape up? How will margin shape up? And is there a cross-utilization which we can do of employees and whatever cost we've built in?
Prakash, PAN 2.0 is like a regular RFP. So when we are bidding for RFPs, naturally we do the groundwork over there. But it is just like any other RFP. So rest of the numbers, as we've been discussing, we will be sharing during the results, and we'll provide more details. But with regard to RFP businesses, naturally we don't build up the full stack of resources prior to the RFP mandates coming through.
Sure. I'll join back up the queue if I have more questions. Thank you.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Yeah, good afternoon, sir. I just want to understand, see, once PAN 2.0 goes live, you indicated 3/4 of the PAN applications comes via the distribution network. So the remaining 1/4 of the PAN applications will move to the new vendor. Is that understanding correct?
Ron, that is a difficult one to predict. The PAN 2.0 RFP, as and when it is mandated, there's a clear period of development and deployment of the tech stack. So it will take 2 years. And at that stage, we'll naturally have to see how many citizens are seeking assisted services, which means, depending on an assisted agent to put the application across, and how many would be going on to direct channels. Even as we speak today, we have direct channels. You can actually go to a Protean website and directly apply for a PAN card. So the direct channels are already available even as we speak. So I think this is about citizen behavior and what sort of, digital capability the citizens have and the comfort they have at that stage. So difficult for me to predict what sort of distribution will there be between assisted applications and direct applications 2 years down the line.
Like so direct would be with the new vendor, and on the assisted thing, if we were to look at the revenues, if Protean is participating in the assisted distribution of the PAN card and the PAN 2.0, like out of the current profit pool that Protean is getting, what would get shared with the new partners in the assisted distribution thing? Yeah, if the 91 rupees stays as it is, currently, as we understand, there's a certain payout that goes to the franchisee, and the remaining difference is what Protean retains as profit. So with the new implementation partner in PAN 2.0 and with assistant distribution where Protean is helping, what kind of a synergy would exist, or what kind of profitability would get eroded?
It's difficult to predict 2 years down the line where things will stand. But I'll give a similar example. Today, when you look at UIDI and issuance of Aadhaar cards, today Aadhaar cards are issued by multiple entities who have distribution networks. There is a revenue model on which they work when they issue the Aadhaar card. Similar indication is there even in this RFP that if somebody is seeking a physical PAN card, which today is, almost 100% of the cases seek a physical PAN card as we speak, there is a cost of 50 rupees of issuance, which even the RFP mentions. But difficult to talk about revenue split down the line. I would, sort of refrain from making a forward-looking statement or a judgment where it stands.
Okay, but you told me that some part of revenues would get split. That is
the fundamental point I'm raising where there is probably clarity we would like to provide that PAN 2.0 is primarily a tech stack revamp. That is why it's in the form of an RFP. The business we run is for processing and issuance, which is a separate business. As and when the new tech stack gets deployed, there will naturally be interfaces which are there also today for direct applications, which will come into play. But the current things as they stand, there is, majority of people seeking assisted support to apply for PAN cards. 2 years down the line, we'll have to see which way it plays, but there is no immediate impact on the business we run.
Got it. And on the PAN verification business that we do right now, after the PAN 2.0 goes live, what happens to that line of business? The PAN verification.
There is indication in the RFP that the entire verification business will then run with the direct ITD department. Currently, we provide these services at a very low margin to the market, and it's a very minuscule part of our revenues under the online PAN verification. And this is a business we actually club with our identity business, because this is towards opening a bank account or authenticating a transaction or so on, and we club it with our e-sign, e-KYC, and e-authentication services. So it sits under that revenue line, and it's a small component of that.
Got it. And any reasons that we got to know why we were not considered for the next round?
We are seeking clarifications, as I mentioned. This came only over the weekend. As of now, we've requested clarification on where it stands.
Sure, sir. Thanks a lot.
Thank you. The next question is from the line of Love Jain from Artha India Ventures. Please go ahead.
Hi, good afternoon. Thank you for the call. My question is on PAN 2.0 project. So I can see that this is a one-stop solution or a platform where I can make the updates, corrections, and other linkage, reassurance, and validation, all kind of solution on the 2.0 project. So if we haven't got the bid or haven't been selected, can the market share of this business can go down in Protean? Is there any clarification on that?
Now, again, as I mentioned, that ITD does that today also. So all allotment, updation and correction in the PAN database is done by the ITD. We don't do that today. As I mentioned, we do the processing and issuance of the PAN card, which means that we collate the data. So when you're making an application, you naturally have to fill up the application and provide multiple details, including your ID details. And that is what we do today. That is the mandate given to us in 2002, 2003. And today, as I mentioned, we collate this data. There are people who go to the agent and provide this information to the agent. Similarly, people have the ability to also take a non-paper journey, which means at the agent point, they can do e-sign and, do everything without submitting any paperwork.
Well, this was, Protean eGov, which do not see any operational impact immediately, but the current bid was considered as unfavorable by government. But the other stock which is in focus is Uflex. It's reported its Q4 FY25 numbers, but we have Mahima. Mahima, how are the numbers?
Right, so in terms of the overall numbers, not very bad. Revenue was up 11%, EBITDA was up 12.8%. Margins, stood the storm up at 10.8 odd percent versus that of 10.7%, and net profit at 266 odd crores versus that of a loss of 140 crores in Q4 FY24. I mean, what's led to profitability? Purchase of stock in trade did reduce by 53 odd percent. Deferred tax credit was also observed in this particular quarter, so a couple of things aided the profit. But to discuss as to how the quarter has gone by and how things are shaping up, we're joined by Rajesh Bhatia, Group President and CFO of Uflex, joining us now. Rajesh, a very good afternoon to you. Always a pleasure speaking to you. My first question to you is, was the quarter up to what you had expected? It's a good set of numbers, or were you expecting the performance to be better?
I think quarter-wise, we were definitely expecting, around the same number. And it's a good year overall. We've seen the volumes grew, especially the packaging films volume grew by more than 10% during the year when we compare to the last year. So overall, with the revenue growth of more than 12%, 12.4%, good year for Uflex. And, we also saw the revival of the packaging films pricing power, so which came in FY25. FY24 was a washout because of many reasons. but FY25 has been pretty good for the packaging film business. So the revenue volumes grew by more than 10%, and overall volume for us grew by 12.5% for the year as a whole.
Okay. And Rajesh, can you give us a sense as to how volume versus value gap is either narrowing or broadening? And what's the sense like once we enter FY26?
So FY26, as we are entering, we are looking at between 10 to 12% of revenue growth, coming especially from the projects that we've just completed. And also the projects where the capacity utilization in FY24 was low, especially in countries like Poland, Dubai, where we could do better in terms of our capacity utilization levels. But, the noteworthy was Nigeria did exceptionally well. Hungary did exceptionally well. So, but there are a few jurisdictions where we can still do better, and also we need to draw faster from our newly commissioned projects. Especially we are looking from our aseptic packaging capacity expansion from 7 to 12 billion packs. This year again, we've done our highest ever performance of the production as well as the sales volume in the aseptic packaging business. And that momentum will continue to take it forward to FY26. So FY26, we are starting on an extremely positive note. And definitely we'll look for both volume as well as the value growth, and obviously with a 12 to 13% range of an EBITDA margin in our business, we'll look to consolidate our EBITDA as well.
Mr. Bhatia, hi, Vaisha this side, good to have you here. In FY25, please correct me if I'm wrong, you were expecting around 2,000 crores of EBITDA, but EBITDA came at around 1,600 all crores. Any reason for the dip?
So operational EBITDA for FY25 is about little over 1,900 odd crores for us, 1,904 crores, 1,902 crores to be precise. So we had estimated a EBITDA of about 2,000 crores, and that was predicated upon commissioning of some of the projects in the Q3 or the beginning of the Q4, which are slightly delayed. So I won't draw much on that. I think we'll make up for those numbers in FY26. But yes, EBITDA, the top line growth guidance and the EBITDA growth guidelines are within acceptable range that what we had given.
So Mr. Bhatia, this 2,000 crores of EBITDA guidance that you had given in last con call was operational EBITDA guidance that you have given?
Operational EBITDA. We're only talking about operational EBITDA because, some of the currency derivative movements are not in our control. So we focusing only purely on the operational EBITDA levels without considering any impact of any currency losses coming out of the, the cross currency deviation or, any fall in the value of currencies. We've seen in the past couple of years, Egypt and Nigeria has been hurting us on a currency devaluation side. So obviously we can't take those factors, but let me also tell you that, whereas last year we had a very substantial loss on account of the currency devaluation. This year, in the first 2 quarters, we had those losses, but in the next 2 quarters, we've recouped those losses as the currencies have performed better. And for the overall year, we've still lost about 177 crores, 78 crores on account of this. But last year losses were about 872 odd crores. So overall, and as a result, we see that, we are PAT positive this year by about 142 odd crores.
Rajesh, just thinking out loud and wanted your view on this thing, because a lot of, customers that you are catering to are adopting sustainability in terms of packaging. Just wanted to get your sense there, because that is a structural change that is going to happen. If it's not happening right now, it's for sure going to happen, 5 years down the line, where people are going to just go for sustainable packaging. Your sense as to how that trend is shaping up, and secondly, what are the strategies in place that UFlex has right now when it comes to sustainable packaging?
See, I can't think of any other company other than Uflex who's the market leader in these innovations. And we've been at it for many years now, and this is now the next 5 years, as you rightly said, are going to be the time when all the work that we've done on the sustainability, on the recycling, on the biodegradable packaging is going to give us fruits now. We are expanding our capacity. We announced last quarter that we're setting up a new plant in Noida, where we're going to spend about little over 300 crores in terms of adding our recycling capacity. So we are adding to our existing recycling capacity in India. We are setting up a 36,000 tons, where we're going to convert the PET bottles into a resin to be reused for making of either PET bottles or the packaging films. So I think no other company has done more in this space than Uflex, and surely Uflex will reap the benefits of this. We'll see as to how this is embraced by the industry as a whole, because this is the first year that this is we seeing the implementation of this, and everything is the execution, even at the policymakers end and even at our ends. But we have fully sort of developed this technology, so that way there are no gaps.
Right.
What the regulators will do in terms of ensuring that this is strictly followed is what remains to be seen.
Got your point there, Rajesh. One more question in terms of your recent update, which said that you have set up an arm, Flex in Middle East, that has incorporated a step-down subsidiary, that's Flex Films AZB. This is in Azerbaijan. Just want to get a sense, a first thought, in terms of the current conflict that's going on between India and Azerbaijan. Will that have any impact on your business in your subsidiary as well as your...
I think there's nothing in Azerbaijan as of now. So, this is just a company incorporation. Similarly, we've recently also guided that we've set up a company in Qatar also. So I think these are all future enablers, and they'll only evolve over a period of time. But as of now, there is no plans on any Azerbaijan or any other businesses.
And Rajesh, one last quick question. You've done 15,000 crores in FY25 and a bottom line of almost 142 crores. Just wanted to get your sense as to what's the guidance like for FY26. Where will this top line go from 15,000, and what's the kind of growth that you're penciling in terms of bottom line?
I think overall we'll expect anywhere between 10 to 12% at a revenue level, and keeping the EBITDA margin at about 13%. It will be anywhere around 2,100 to 2,200 crores of an EBITDA. Rest of those are some factors which are outside us, like currency things, etc., and all that. So I think we focus more on the revenue as well as the operational EBITDA numbers. So at a 12% revenue growth, we'll surely deliver an EBITDA level of between 21 to 2,200 crores.
Right, so 10 to 12% of revenue growth and operational EBITDA between the range of 21 to 2,200 is the view coming in from Mr. Rajesh. Mr. Rajesh, thank you so much for taking all the time and speaking with us at NDTV Profit.
Thank you. Thank you.
All right, with that, it's time to slip into a very short break, but we'll be right back with 2 more management conversations on the other side, so stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research. shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
It's a volatile day on Dalal Street as heavyweights Infosys and Reliance Industries drag the Nifty and the Sensex. Defense stocks snap their 6-day winning streak as traders book profits. PSU banks and realty stocks are on a troll.
Indian cooling and sealing system maker Banco Products is locked in upper circuit as it surged 20%. Now this is on the back of company posting 125% uptick in profits. Sales too rose 21%.
Delivery gains close to 12% after EBITDA beat expectations and margins saw substantial improvement, but revenue misses estimates.
Protein Eagle management says losing the PAN 2.0 project will not affect its PAN business operations materially, but the company has reached out to the tax department for greater clarity. The stock hit 20% lower circuit as soon as the market is opened and remained at those levels since.
Government rejects Vodafone Idea's request for relief on interest and penalty. Company moves the Supreme Court, cites public interest for the company's survival. Welcome back. You're watching Profit Buzzers. I'm Mahima Vachhajani. With me is Varsha. Let's take a quick look as to how the markets are doing. Well, the Nifty 50 is trading in a very tight range, but withholding the levels that it's trading at, that is the 25,000 levels, and down by about 0.03%. Let's pull up the broader markets. Clearly, broader markets have been outperforming the benchmarks in the past few days, and that's been seen today as well. The mid-cap 150 is up 0.6%. The small cap 250 doing well in trade today in terms of performance, up almost 1%. Let's pull up the Nifty 50 heat map and see what counters are buzzing in trade today. There you go. The counters that you see on your screen are the top buzzers in terms of stocks that are losing ground today. There's Eternal, there's Infosys, Tata Consumer, TCS, Grasim, as well as RIL. But counters that are doing well, Bajaj Auto leading the pack up by about 3.8 odd percent, Shriram Finance up 1.4%, Eicher Motors, Hero MotoCorp also up by about 1 odd percent. So a lot of auto names doing well. Let's pull up the sectoral heat map and see what sectors are doing well in trade today. In terms of the sectoral performance, like we mentioned earlier as well, the Nifty Defense is seeing some kind of profit booking in trade today, down by about 0.6 odd percent. Nifty IT feeling the heat, down by about 1 odd percent. There's Nifty Media seeing some sorts of pressure, but Nifty PSU Bank leading the pack, up by about 2.4 odd percent. Nifty Realty up 2.35 odd percent. Nifty Pharma also up 1%, and Nifty Auto also up around 0.8 odd percent. But in terms of some specific stocks that are doing well in trade today on the back of their earnings, let's pull up the Nifty 500. And see what are these counters that are doing well in trade today. There you go. There's something like 361 WAM doing well, 3M India doing well, Aarti Drugs doing well. Some names like Banco doing very well in trade today on the back of its Q4 earnings. Graphite up 15%, Nucleus Software up 12.7%, Delivery up 11%, HEG up 10%, KPI Green locked in upper circuit up 10%, Usha Martin up 8%, Hindware also up 8%, KRBL on the back of its earning up 7 odd percent, largely export led gain for KRBL. There's Central Bank doing well, Kaplan Point, Shada Motors, Central Bank, IOB, all of these counters buzzing in trade today anywhere between 6 to 8% but some counters under pressure and languishing. You have stocks like Heritage Food on the back of earnings down by about 4% and it's sustained that kind of loss in terms of trade today since the start of the trade. Gujarat exports is also seeing a downtick of around 7% in trade today. Credit Access on the back of earnings again down by about 6.3%. Paras Defense down by about 5%. Kalamandir down by about 4%. Nesco also down by about 4%. But another counter that is in focus is Dhanuka Agritech. And we've Varsha with more details on that. Varsha, the stock is right now around 0.8% higher, but overall in terms of earnings, what's worked and what's not worked?
Yeah, so Mahima, overall good set of numbers, especially on the margin side. If you see, revenue was up 20%, EBITDA margin were at almost 24.8% versus 22% last year. Now, although gross margin contracted due to higher raw material costs, but the surprising or the interesting fact over here is the EBITDA margin. There was an expansion in EBITDA margin. And of course, net profit was up 28% at rupees 75 crore versus 59 crore last year. But to speak more on the numbers and what is the outlook going ahead, we are here joined by Mr. M.K. Dhanuka, who is the chairman of Dhanuka Agritech. Welcome, Mr. Dhanuka. Great to have you. Just wanted to have your view because good show when it comes to margins. Although your gross margin contracted due to higher raw material cost. What went right when it comes to EBITDA margin? What were the levers and are these margins sustainable?
Yes, last year actually we have introduced 3 new molecules first time in India. They were Lenevo, Purge and Mycore Super. So being no competition in the market, Dhanuka got good margin in these molecules and we hope that we will be able to sustain these kind of margins in the current financial year also because the volumes for these molecules will further rationalize in the current financial year.
Got that point. So you are saying this EBITDA margin of around 25%, this is sustainable or this kind of EBITDA margin you will be seeing in FY26 as well?
No, it is not 25%. EBITDA margin is 20.47%, which are sustainable in the current financial year.
That point. Also, on the initial monsoon estimates, sir, which seems to be favorable, and given that your company's base has also reached to around 2,000 crore, what is the revenue growth that you are expecting when it comes to FY26?
We on the front good expectation of normal monsoon by SkyMet and the IMD forecast because monsoon plays an important role in the agriculture and the agrochemical industry consumption. So we are confident that farmers will have, in anticipation of good yield, will sow maximum acreages and we will be able to have a double-digit growth in the current financial year as far as the top line is concerned.
Okay, got that point. So, can we see this 20%? If you can just quantify that number, sir, for us, can we see the same growth, the 20% that you have seen in the Q4, or you can see 25 to 30% of growth when it comes to FY26?
No. For the whole year, the growth was 15% only. We cannot see the quarter-to-quarter growth because it's a seasonal industry. So we have to see the Y-over-Y, basically the results. So that's why the yearly growth was around 15%. So we expect a similar growth in the current financial year also.
For that point. And sir, the revenue growth of 20% that you have seen in Q4, is there any kind of contribution from the Bayer product in terms of royalty that has helped to achieve this 20% growth?
Yeah, there was 12 crores royalty which we have received from Bayer in the Q4. So that has been included in the top line. And in current financial year, with effect from 1st April, the Iprovalicarb product has been transferred to Dhanuka and Dhanuka will be marketing this molecule in the current financial year in India. But in the other countries, the registration is under process of transfer. And once the registration is transferred, then the volume will start coming in the books of Dhanuka. But till that, buyer will continue to sell the product for another 6 months, and royalty will be received by Dhanuka for 6 months in this financial year also.
Okay. And sir, in terms of volume and value growth, if you could bifurcate those things for us, how much was the value growth versus how much was the value growth in this year?
The last year volume was 3% higher overall for the year in comparison to the value, because the prices were declining. That was the major reason. And this year we see either flattish. There should not be any major difference between volume and value wise. However, since the prices are on the rise, we expect 1 to 2% higher value growth in comparison to the volume.
So 1 to 2% of higher value growth in versus in comparison to volume growth. Got that point. Also, on the Dahej facility, so what is the current capacity utilization when it comes to your Dahej facility, and what is expected in FY26, and for EBITDA margin to become positive when it comes to Dahej facility, what is the capacity utilization that Dhanuka will need?
Presently, we are utilizing only 25 to 30% of the utilization of the capacity at the Dahej unit, since we have only one molecule in our portfolio, and that too we are selling only in domestic market. We have applied for the registration for exports in various countries. Once we will get the registration, then we will be in a position to export, and the volume will start increase, as well as we will be able to utilize more capacity. However, we are adding one molecule in the Dahej facility this year, because it's a multi-purpose plant, so we can manufacture other molecules also in the same plant. So that molecule, although very small this year, but from next year onwards, it will also contribute significantly. It will take another 2 years for the Dahej plant to become EBITDA positive.
2 more years for the Dahej plant to become EBITDA positive. Also, on the buyer's product, so how much revenue this segment or this buyer is expected to generate when it comes to FY26, and are the margins of these products in line with the Dhanuka's EBITDA margin? And also the third question is, what is the opportunity size when it comes to this portfolio?
You see, we are expecting similar EBITDA margin what the Dhanuka is getting, around 20% from buyers these two molecules, and we are expecting the Indian domestic market turnover in our books in this financial year, which is around 60 crores of rupees, while the half of the volume of the overseas will start coming in the books of Dhanuka if the registration are transferred to Dhanuka by buyer in the overseas 20 countries. So that way opportunity is big, because the Pro Valley Carb is used on grapes mainly, but other horticulture crops also, and in 20 countries we hope we will be able to get the market in the next year.
Also, sir, just trying to understand this more deeply, how the international market is doing, given that in most of the cases, we have seen that international agri markets it's not doing so well. So just wanted to have your thought when it comes to international market, considering these 2 fungicides that you have acquired.
You see, earlier for 2 years, definitely the export was not doing well. But from current financial year, the exports have started doing well, and there is good demand is seen in the export segment, because one is China is not more competitive in comparison to in India. Earlier, a lot of exports were happening from China, but in US, because of imposition of tariffs, the China has become more costlier. So India is the preferred choice now after China for export, and we are now the second largest exporter of agrochemicals in the world. So we hope that in this financial year, the export demand will remain good.
So export demand is expected to remain good. Well, thank you so much, Mr. Dhanuka, for answering all the questions, and all the best for the business.
Thank you, Varsha ji.
Hello and welcome. You're watching NDTV Profit. I'm Mahima Vachharani. Emami is in focus on the back of its Q4 earnings. It's the second quarter in a row where the company has reported mid-single-digit volume growth. Overall results were ahead of what the street was expecting. Domestic revenue has seen a growth of 9%, volume growth of around 5%, and strong healthcare performance-driven growth was seen in Q4. Now, to discuss as to how the quarter has panned and how FY25 is shaped up, we're joined by NH Bhansali, CEO, Finance Strategy and Business Development and CFO of Emami Limited, joining us now. Mr. Bhansali, always a pleasure speaking with you. Your sense of how the quarter has gone by, was it as per expectations? What has worked and what has not worked?
Thank you, Mahima. As at the outset, let me apologize for my bad throat, but I will try to come to your expectation in terms of replying to your queries there. Overall, it is a good, satisfactory performance. It's a bundle of both. While there were a lot of hits and there were misses as well. In terms of hits, if you look at overall, the domestic core business has grown in double digit by almost 11%, core domestic business. While there had been some negatives in terms of the strategic investments could not come up to the expectation. International business has done well with 5 to 6% kind of a growth in terms of constant currency and also INR. So broadly, the growth has been intact. Looking at the kind of markets with a lot of variations in terms of seasonal variations, geopolitical conditions, and forex volatility, all taken together. And on the top of it, there had been some inflationary was earlier, but now it has also started inching down. So hopefully, I feel that the performance had been good looking at the kind of environment where we are operating in.
Right. Mr. Bhansali, your margins have improved on an FY25 basis as compared to FY24 basis. Just wanted to get a sense there as to what's the kind of normal range of guidance in terms of margins that you're expecting in FY26. Do you think that 27-28% is sustainable, or do you think that it'll grow beyond that? And if yes, what will be the levers?
So we expect the margins to remain almost at the same level. So we would be investing behind the brands as we have done earlier also. We are since we are delivering the highest margins in the industry, if you look at, and so we are looking if there are right opportunities. No, we would not be shying away from investing behind the brands, and so the margins all broadly would remain in the same range.
And when you say you'll be investing in brands, any particular acquisition that you're looking at, or you'll be investing in already existing brands?
So it would be a mix of everything. So we would be investing behind our existing brands because there has been a lot of steam because our penetration levels of the existing brands, the core brands, is still very low. We are working on so many adjacencies there in the beside the core brands. So we would be investing behind them. In the past we have done acquisitions kind of Dermicool, Kesh King and all. So we also feel these brands have a lot of potential. We will be investing behind them. And also in the strategic investments where we have invested a lot in the past, and we feel that the good growth would come in, strong double-digit, more than double-digit growth would come in from the strategic investments. So would be investing across.
Okay, and in terms of the new brightening cream category that you forayed into, just wanted to get a sense about Pure Glow. What is it like, and what is the kind of revenue growth that you're penciling in from this particular new product?
So it is we are entering into the market, though we were earlier there also in this market. It's a very tactical move. We feel that the product is very good. It is highly scientific proven, and so we would, but the market is cluttered and is cluttered, and it is not that easy. So we would be we have launched them in the few markets, We are looking at the results. We are very hopeful. The early signs has been very, very good. And we expect this brand to do well going forward.
Right. Mr. Bansali, the pain point right now for the company is your pain management products, because Zandu has not been doing well. Just wanted to get a sense there as to what's not working, and is there a strategy in place to improve sales with respect to that counter?
No, Zandu has done exceedingly well. If you look at 5 years trajectory, so what has happened during the COVID, the base has increased substantially, and after that, the consumer preferences have changed. But despite this, we have been able to maintain the base, and the growth has still been good. In fact, in the last quarter, we have grown by 1%, and for the full year also we have been able to maintain that growth.
Okay, and just one more quick question on the trend that I've observed, because you have more penetration in terms of rural markets. There's an interesting trend that has come out this time, which is that now people are preferring lower end of products. That's getting sold more than the premium category for a lot of these FMCG companies. Is that something that you've also observed? Because this is something that will work in favor of Emami for sure.
Yeah, that often happens and is also happening also. There will be a lot of down trading in terms of the brands and also within the brand in terms of the packaging. So, and if you look at, we have LUPs across in all our brands, right? From Navratna to any other brand, you will find we work across LUPs, and we feel that is where there has been a lot of demand for this kind of a product, this kind of sizes there. So it's a mix of both. In rural markets, you will find a lot, but in kind of newer channels, you will have much bigger and different SKUs which are helping. So we are working on both sides, and we expect growth to come from both rural and urban going forward.
Okay, interesting. And one last question, Mr. Bansali, before I let you go. FY25 ended with over 3,800 crore of revenue and a PAT of almost 800 odd crores. Just wanted to get your sense, FY26, what's the kind of revenue growth and bottom line growth that you're expecting?
Expecting the same kind of a growth, if not better.
Right, that was Emami on the growth prospects going ahead. But there's some breaking news when it comes to telecommunication companies. Now, there's a setback which has come for telecommunication companies. Supreme Court has rejected Bharti Airtel, Vodafone Idea pleas seeking waiver of AGR dues. Let's see what those counters are doing today. Now, Bharti Airtel is up almost 0.35%. Now, the Supreme Court has rejected Vodafone Idea, Bharti Airtel pleas seeking waiver of AGR dues. This is what we have breaking news now. This is according to Informist. We'll speak on this in the later shows as well. But the other stocks which are actually buzzing in trade today, you have HEG and Graphite India, which are buzzing in trade. Now, HEG is up. Let's pull up that chart. HEG is up almost 11%, while Graphite India is up almost 15%, 16%. There you go. Now, let's see why these stocks are in focus. Now, Japan's Resonec Holdings is expected to close its graphite electrodes plant in China and Malaysia. Now, this Resonec exits China and Southeast Asia graphite electrode production is due to margin pressures that they are seeing. Resonec is a major producer when it comes to graphite electrodes, and they are scaling back to improve their margins and the high competition. There's also high competition which is seen from low-priced Chinese parts. Now, Graphite India's global graphite reach, if I were to talk about, now they export to 27 nations, which drive 35% of turnover, and company's diversified export portfolio across multiple geographies company do have. And the Graphite India own a fully owned subsidiary in Germany and also serves 27 countries. Export accounts for almost 35% of the total turnover of the entity. Now, HEG, if you see, exports over 70% of its production to more than 30 countries worldwide. Now, India's, when it comes to HEG is India's leading graphite electrode manufacturer, and the graphite segment contributes or accounts for almost 80% of the revenue for HEG. So, this is what we have when it comes to HEG and graphite. Well, the stocks are doing well in trade today. But moving on, And there's an update from the financial space. The shareholder of IDFC First Bank has rejected Warburg Pincus' seat at the board of the bank. This development has come as Warburg Pincus had agreed to invest 7,500 crore rupees in the bank last month. We have Shubhana Sheikh with further details on the same.
Yes, so it is a significant development that has happened at IDFC First Bank's shareholder meeting today. Now the proposal to actually induct a non-retiring board member of Currency Investments, which is an affiliate of Warburg Pincus, who was set to invest in the bank. They did not get the necessary approval that they were supposed to get. Now this is because they did not get the majority vote. Now only 64.1% of shareholders voted in favor of this appointment, which was falling short of the 75% threshold which is required for the approval. Now this has actually this setback has casted uncertainty over Warburg Pincus and Abu Dhabi Investment Authority's investment into the bank. Now last month, as you rightly said, both these global marquee investors had decided to invest about 7,500 crore in the bank through convertible preferential shares. Now what we're understanding through this is that the rejection of the board seat indicates that there is some shareholder apprehension about the terms and conditions or implications of this deal, which could actually potentially delay the fundraising in the bank. Now just to glance back, the two investors include Currency Investments and Platinum Invictus, which is an affiliate of ADI. Essentially what the bank was trying to do through this fundraising is that they want to increase their capital adequacy ratio. That is the whole motive behind this.
Right. Thank you so much for all the details. Well, the Apex Court of India has rejected the pleas of Vodafone and Bharti Airtel to waive AGR dues. Aishwarya Patil is at the court with the details.
Well, the Supreme Court has dismissed the petition outright, calling them misconceived. Now, just before the Supreme Court could break for lunch, the counsel from Vodafone Idea side did approach the court to move the case higher because it was scheduled later in the day. While they asked for that, few things were asked from Vodafone Idea side, from their counsel side, and the Supreme Court said they will not be part of this. It also acknowledged that the companies can explore other remedies. Although having dismissed, he said they can explore other remedies, just not through the Supreme Court and in this manner. That's what the bench in the Supreme Court said today. And they also said and implied again that don't make us a party of this because the government has already rejected their plea. That was the context of the bench conveying that to the counsels of Vodafone Idea. Again, Vodafone Idea did point out that they've already paid about 50,000 crore rupees and that the government now owns 50% of the company. During the arguments and the submissions that were made by Vodafone Idea's counsels, of course, is there another legal recourse? Is there other remedies? What the counsel also asked, and the court bench did say that there is legal recourse, and the government, if the government wants to help, and they are free to do so as far as Vodafone Idea's waiver plea in terms of AGR is concerned. Earlier this morning, we had reported that We's plea to the DOT had been rejected in terms of interest and penalty relief. And that was the context of what the Supreme Court was also referring to. So the case so far has been dismissed. Their plea has been dismissed. Is there a remedial issue? Supreme Court says yes, but not in this manner.
Right. Thank you so much, Aishwarya, for all the details. Well, on this, we are here joined by Mr. Balaji Subramaniam, who is Vice President at IIFL Securities. Hello, sir, and welcome to the show. Now, this rejection that has been announced by Supreme Court, do you see this major negative when it comes to Vodafone India?
Hi, thanks for having me on the show. So I don't think the rejection is surprising because Supreme Court has rejected this multiple times in the past. But based on what I heard a little while earlier on what was getting updated on your channel, the Supreme Court at least as per what we heard right now. Provides some legal recourse for the company and some leeway for the government to, in case there needs to be any relief that has to be offered. I think the Supreme Court only says that don't expect any relief from our side and don't make us party to, any of this. So I think, one way out could be that the government is free to work on, certain remedial measures within the contours of the Supreme Court verdict. We don't know, what that be, what that might be. But there is a probability that the government can bring out a special ordinance or something in the parliament to kind of, circumvent the Supreme Court verdict. But all that is as of now is conjecture, and we just have to see what is the kind of leeway that the government has got. The other alternative is the government can extend the moratorium by a few more years. Even though that will not completely solve the problem, because what all that will achieve is that unless the liability itself is brought down, we are basically postponing the problem to future years. So I think, while any relief, though it looked unlikely, would have been a clear positive for Vodafone Idea, I think now the uncertainty will persist. But at least, the government might have some leeway to kind of, get this problem sorted.
So, given the fact that in the morning government had also rejected the plea and now Supreme Court has also rejected the plea, do you see this anywhere as a possibility that Vodafone Idea might be able to pay this or might be able to generate this cash to repay the interest amount going forward, given the fact that there has been tariff hikes?
See, I don't see any possibility of them making the AGR payment, first installment, which is 16,500 crores by March 31st, 2026. I think that is probably out of the window, unless they manage to raise debt funding, which doesn't look that easy at this point, based on what the company itself had mentioned in the writ petition before the Supreme Court. So, can they generate? I think that possibility is very limited. But will can they get around this problem? Maybe if the government is willing to either extend the timeline or extend the moratorium, or in case the government is fine with holding more than 50% stake in the company. So, I think those are the only two possibilities. But I don't see Vodafone Idea generating enough cash flow even after these tariff hikes to kind of make those kind of payments.
Right, and sir, just wanted to understand this as well. Conversion is now out of the picture for the debt and the interest part, or can that also be considered by the government?
See, these are, extraordinary circumstances. So while in the regular course, the government wouldn't want to hold more than 50%, I don't think one can say never, because, at the end of the day, the government has also mentioned multiple times in the past that they remain committed to a free private player market. So, at some point, the government will have to balance both these objectives, which are, increasingly looking a little conflicting at this point.
Just one question here from me, Balaji, on this side. What should a retail investor do who's bought shares of Vodafone Idea at this point of time?
See, the situation remains very fluid because, this is more of a binary outcome where, in the event of a meaningful release, the stock could see a pop, even though, fundamentally, I don't see a lot of upside from here on. But, in case the release gets protracted and the company is unable to raise either debt or, the clarity on the AGR matter doesn't come, in a reasonable amount of time, then I think the stock could languish or even probably head southward if we start approaching the 31st March 2026 deadline without any meaningful progress.
Thank you, sir. Thank you for joining us and explaining that very clearly. What should our retail investors do and what is the way forward for Vodafone Idea? Let's also welcome in HP Ranina, the lawyer with Supreme Court. Sir, time and again we have seen Vodafone Idea making this plea to the Supreme Court for waiving off either the interest amount or the due amount or for extending the moratorium. What is the way forward now as per you with Vodafone Idea?
See, Vodafone Idea has no judicial review open now. The court has shut its doors on Vodafone Idea. So there's no point in keeping on going to the court. This is not a judicial issue. This is an administrative issue. The only solution is for Vodafone to get in touch with the government and let the government give them some relief. Either they give the moratorium is increased, the interest is spread out, the interest is reduced, the payment is spread out, or they increase the share capital. But the share capital will not be increased because then Vodafone will become a subsidiary of the government of India. So you cannot go beyond 50% as far as shareholding is concerned. So the only solution is for them to get moratorium or to get a further extension of time or reduction of interest payments if the government can do that. It's entirely an executive decision now, nothing to do with the courts. Courts were very angry with Vodafone for keeping on going there and trying to get some relief. But court has no power to give relief. This is not a judicial matter, this is a pure administrative matter. So Vodafone has no recourse now to the court of law on these issues.
So just to make it clear for our viewers again, so even if Vodafone Idea please again makes another plea in the Supreme Court, this won't be entertained right now. Supreme Court going forward will not entertain such plea, right? That is what you mean to say?
Not at all. Supreme Court is supreme. You can't go to any other authority beyond Supreme Court. And Supreme Court can only entertain where there's a review petition if there's some mistake. There's no mistake. There's only asking for relief. They will not give relief. They said it's administrative. Go to the government and get the relief.
Right, sir.
We cannot give any relief.
Right. Sir, in your experience now, given the fact that Vodafone Idea would not be able to generate enough cash to repay this amount, and I guess equity conversion is also out of the picture given the fact that government's holding has already touched 50%. Do you think moratorium would be the only possibility left, or else if that is also not the case, then will Vodafone Idea head towards NCLT?
Yes, of course. Moratorium is the only way out, or giving them more time to pay that amount, spread out the payments, amortize the payments. That's the only thing they can do. Only other solution, otherwise promoters have to bring in more funds. They cannot throw their hands up and say, we don't have the money, we can't do this, do that. They have to bring in the funds. Let them raise capital from their private company if they want to do that. That's the only solution. So either raise funds on your own or ask for the government moratorium or spreading out amortization of the payment for a longer period of time.
The last option would be going to NCLT?
No. Who will go to NCLT? NCLT is only if they are on the verge of bankruptcy.
So if they are not able to pay their dues, then what would we consider that? That's what I wanted to understand.
No, that's not possible. Yeah.
Right.
Okay.
Right. Thank you, sir. Thank you for joining us and explaining that.
Thank you. Bye.
Well, with that, it's a wrap on this edition. Stay tuned and keep watching NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to Profit Top Trades. I am Puneet Zaveri. With me is Anushi Vakharia, and over the next half an hour or so, we'll tell you everything you need to know about the markets. We also have a very special corporate conversation lined up with Kalpataru Projects. But before we go to the management, Anushi, how were the results essentially for Kalpataru? If you can just give us some highlights and then welcome in the management as well.
Right, so for Kalpataru Projects, I'll start off with the headline numbers first. While we were seeing about in line sort of a revenue growth at around 18%, margins have remained flat this quarter at the levels of 7.6%, and net profits saw, however, 37% of a growth. Now, coming to the order book positioning of the company, they reported about a 10% of a growth here. Order book standing at 64,495 crore as of March 25. They received new orders worth about 2,372 crores till date in FY26 period. Order inflows, however, for FY25 stood at 25,475 crore. In terms of how the segments have performed, now T&D, transmission and distribution, has remained on the stronger side for the business, along with buildings and factories. Also, we've seen about a 20% plus of a growth here, but it was water and railways where we've seen a bit of pressure throughout the year. So commentary on that is something that we should be watching out for. In terms of what the outlook forward is, let's welcome in the management, Mr. Amit Uplenchwar, the director of Kalpataru Projects. So, Mr. Uplenchwar, first question, your assessment on the fourth quarter. Now, we have seen margins majorly remaining in line. Revenue also, the expectation was also 18% of a growth, and we see this. So, just give us your assessment on FY25 as a year.
So first you asked me for Q4, so let me start with that. I think it was an exceptional Q4, a blowout quarter for us, and I'll tell you why. Because we've got revenue, EBITDA, PBT, order book at an all-time high for Kalpataru Projects on a standalone basis in Q4. If you see, we've crossed 7,000 crores in revenue at console level, which was the first for us. Our EBITDA in absolute numbers went up by 19%. And our net profit went up by 37%. So all in all, a great Q4 for us, and made up for a little sluggish Q1, which generally is for our industry. And I think if you see the whole year gone by, FY25 from on all counts was for us quite heartening. We achieved our order guidance of 25,000 crores for last year. We said we'll be between 4.5% to 5% of PBT, and we were towards the end band of 5% thereabouts. So that was a good number that we achieved. If you see in terms of revenue also at a console level, we were at 18% in spite of a dip which you just showed on your screen a little while ago on the water business, which was a drag at 30% then year on year. And that was a temporarily yearly blip, a sectoral problem, which is now hopefully getting resolved in the next 2 quarters. And that should be back on its regular growth trajectory as well. So I think we've been able to achieve all our guidance parameters of FY25, and the trend of Q4 looks very, very promising, because of which, as management, we are very, very bullish that next year we should be able to get in FY26 a revenue growth of 20% on a very high base already, both for standalone and console. And we are also pushing ourselves to increase our margin profile to go on a standalone basis from 5.25 to 5%, 5.5% PBT, and on a console level of up to 4.75% for FY26.
Okay, so Amit, this 20% of revenue growth that you're expecting in FY26 along with this margin expansion, which are the segments that will contribute to this growth? Would the focus remain on the transmission distribution side of it? Would it be the export business, which would drive international business, which would drive the revenue growth? If you can give us more clarity on that as well.
So as you mentioned, our T&D business, both domestic as well as international, is seeing huge order wins already last year, which gives us enough visibility for the next 2-3 years from a revenue perspective. So I expect that growth to continue. Our buildings and factories also is sitting on a very large order book. And again, those kind of 20% growth expected in FY26 as well. Oil and gas, we grew at 114% last year and over 150% on a YOY basis in Q4. And I think this year as well, we expect very, very robust growth in oil and gas. Water, hopefully, it all depends on our cash flow situation. And hopefully, we are expecting by Q2, Q3 as an industry, what we get advised is that monies will start flowing in because there is also a very large sectoral allocation from government in current year budget to around 70,000+ crores. So hopefully we grow at 10% in our water business on a very conservative business, which can hopefully get better if the situation with receivables gets better. So that's why we are very confident that we should be able to get 20% growth already on a standalone closing order book, revenue of almost 19,000 crores last year. 20% would be a big, large jump.
Okay, so you've talked about water business. You started seeing improvement from the second quarter onwards. So if you just had to project, like for FY25, while we did see about a 35% of a decline in terms of where the revenue is, what is the kind of growth that we expect for FY26 coming back for this segment?
So, we ourselves have factored in a modest 10 to 12% growth in the water business for FY26. And, we will only revise these numbers if we start seeing trends of our old receivables getting liquidated and industry in general starting for the new order cycle kicking in. So we're going to be observant for the next, a quarter and a half, and let's see where we are at. But assuming those modest assumptions for water business, we are still confident of getting a 20% revenue growth given the order book that we already have in hand for our other businesses in the group.
And in terms of where the railways is concerned, there is high competition here along with other issues which have led to the revenue downtick. This is not just the fourth quarter, but even in the previous quarters, we've talked about railways also as a division. So what's the approach here? Is there going to be a selective approach towards the projects that you'll undertake? What's the outlook here?
So, railway, as you are aware, as a sector, you cover other companies in the sector, has been going through competitive intensity of severity we've rarely witnessed, right? And this is across all EPC companies. Our focus is to be cautious. Last year we did FY25 revenue of 1,000 crores thereabouts in terms of revenue. And I think if you see as an overall number in our books, that's a very reasonable number. So it does not move the needle as an overall company performance. Our focus for railways is to be selective, close our ongoing projects and ensure that we take the railway business overseas. We have been at it for the last 3 to 5 years. We've been scoping several countries in Africa, looking at funded projects. And our target is over the next 24 to 36 months, focus on railway business overseas and all the 75 geographies, wherever it's relevant for the business to be our plan going forward for that sector.
Okay, so focus more on overseas for railways. Now coming to the overall order picture that is there, your total order book stands at 64,495 crore. Want to understand the execution part of it. How much is to be executed this year? What's the kind of projection in terms of new order inflows? Last year we've seen a couple of order wins which were on the larger side. So do you see more of these high ticket orders coming back for the business? So I want to get a perspective on the order inflows.
So quite a few questions from you in one question, but I'll take them one by one. I think our order inflow for FY26, given the fact that we want to maintain a ratio of between 2.25 to 3 of order book to revenue, I think we should be looking at 26 to 28,000 crores of new order wins for FY26. Yes, we are looking at, large ticket items, orders which are in excess of 750 crores as a single unit order, because given our merged synergy, we have several opportunities, be it data center, airports, oil and gas, underground metro, HVDC networks, building and factories, etc., where such tenders are visible to us today. So far as our execution capability, that is where we are trying ourselves on. In the last 4 years, I think we've created one of the strongest balance sheets in the country in the sector. We have practically very, very little debt on our books. And if you look at next year, I mean, it's just mathematics. If we closed our standalone number close to 18,900 FY25, and you look at a 20% growth on that number, that's what we are looking at for our next year guidance. And we are quite confident because, last 4-5 years, we've been investing a lot in technology, a lot in mechanization at our projects. We've built a extremely high-tech center of excellence when it comes to engineering. We have a large team of multi-sectoral engineers with every possible software out there with us today, bumping up our execution capability from an engineering standpoint multifold in the last 5 years, and that focus continues. We've also set up a central, very large project monitoring group with a war room in the corporate office where we can see all our 240, 250 projects in 75 countries live tracked on a daily basis in real time in our office in the headquarters in Mumbai. So with that kind of thrust and focus, investment in technology, with over 25 startups working across various parts of our business, I think we are quite confident of getting a robust performance in FY26 on the parameters that I just told you as our guidance for, various indicators of the business.
Okay, so 26,000 to 28,000 crore is the expectations in terms of where the order inflows are for FY26. But is there any selective approach or any cautiousness to the domestic bidding that we are seeing, considering that overall as a sector in infrastructure space, we are looking at for some of the companies out there increase in terms of where the receivables are. So just wanted to ask you this, are you seeing a similar increase in terms of where the receivables are concerned for Kalpataru projects?
So we don't have any problem whatsoever on any of our sectors, either domestic or international, when it comes to receivables. Water as well, if you look at our track record for the last 6 years, I think our growth CAGR has been phenomenal, right? And I don't see that as a long-term structural problem with receivables that occurred last year to persist going beyond Q4. And I think things should get back to even keel. There were, as you're all aware, several uncontrolled events that happened last year. And I think even for water sector, receivable is absolutely not a problem because these are all central funded projects backed by the sovereign. So I don't see that as an issue for us.
And Amit, my last question to you would be on the CAPEX. Now, can you just give us an outlook on in terms of where the CAPEX plans are for the business, not just for FY26, but next 2 to 3 years, and where do you plan to deploy these funds?
So if you see our last 2-3 years CAPEX profile compared to the last 10 years of CAPEX that we did at Kalpataru, our last 3 years has been a pretty significant CAPEX cycle. And, we did almost 600 to 650 crores in FY25. And that's the reason because, we've gotten into underground tunneling segment for metros. We own 6 tunnel boring machines now. Similarly, we've got single size projects in our building and factories crossing 2,000 crores of a single EPC project. So all of this, of course, required for us to spend in CAPEX to meet the growth requirements of the future. We're looking at similar kind of number for next year. But as our strategy is to keep that more or less in line with our depreciation on an annualized basis, a little bit, plus 10-15% here and there. But keeping our overall balance sheet in check, our net working capital days below 100, our interest cost below 2% of revenue. And I think in that line, we will keep our, going forward, I see in the next 3 to 4 years, our CAPEX coming down actually because we've invested significantly over the last 2 years and including in FY26.
Got the view, Amit. Amit, thanks so much for joining in, giving us a whole host of views on the Q4 as well as the outlook for the next year. We look forward to our conversation, but best wishes essentially for FY26 as well for you.
Thank you so very much.
Thank you so much. Let's look at how the markets are doing now, because we mentioned in the morning as well during the FNO link that we are expected to trade in a narrow band. Essentially, that's happened slightly below the 25,000 mark, but 24,800 is something to watch out for. Let's quickly look at the sectoral heat map as well. Some of the key sectors that are outperforming as well as underperforming. Nifty Realty is continuing its growth momentum from the last week, up 2.2%. The PSU Bank as well has seen a decent picture in terms of growth. While we are seeing a continued pressure on stocks in the IT space, media also has been underperforming the larger index as well. Let's finally look at the mid cap, small cap, and the BSE 500 to go with, because we've seen the benchmarks, underperforming the broader markets as well. Let's look at the mid cap index first, see if there's any outperformance versus the peers, and we're seeing within the BSE 500, stocks like Graphite is up, HEG as well in the Graphite and nodes business is up almost 8 to 15%. We're seeing some strong moves in the likes of Delivery. That was, on the back of quarterly earnings as well, really strong number in terms of EBITDA, 5% now. The other ones, GR Infra as well, that's a stock we don't talk about much, has been underperforming since the last 18 months since the IPO. On the other side, Vodafone Idea, my colleague Swami did highlight at the end of the last show, that court ruling coming in as a big negative for something like a Vodafone. Credit Access Grameen also down a bit in trade as well, but largely, let's quickly pull up Bharti as well, if it's also impacted similarly to Vodafone as well. Let's look at how that stock is doing. Slightly in the green, 0.09%, but it's off the day's high as well. But time for an NDTV Profit exclusive now, and it's a big one. The government is reviewing Interglobe Aviation's tie-up with Turkish Airlines and may not allow to renew the lease pack going forward as well. My colleague Shesha joins in with some more details on this.
Right, the government is reviewing aviation ties between India and Turkey following Ankara's support for Pakistan during Operation Sindoor. Now, while the review exercise is underway, sources indicate that Indigo's leasing agreement with Turkish Airlines has been identified as one of the concerns, and it is thus being scrutinized. It is also learned that the current lease, which is set to expire on May 31st, is unlikely to be extended. Now, this comes, as the government has been actively cutting diplomatic and commercial ties with Turkey following the military standoff last Thursday. Remember, the government revoked security clearance of Turkish firm Celebi, which used to handle ground operations in 9 airports across the country. Meanwhile, there are reports, which also suggest that Air India has sought government intervention to halt Indigo's leasing pact with Turkish Airlines over security concerns. Air India, however, has denied to have engaged in any talks, involving competitors' business. Now, Yet, as tensions grow, Indigo on its part has also defended its partnership, saying that the tie-up, which also includes a code-share agreement with Turkish Airlines, allow Indigo to provide multiple benefits to Indian travelers, boosts the country's aviation growth, and also supports employment. Currently, Indigo operates direct flights to Istanbul using 2 leased aircraft, which are capable of seating over 500 passengers each. The code-share partnership with Turkish Airlines also enable Indigo to serve more than 40 countries across Europe and the United States. Now, the government is likely to hold dialogues with Indigo before taking any definitive action, considering various stakeholders are involved and competing interests at play. Indigo has not yet responded to NDTV Profit's queries on this matter. However, we expect the management to address these issues after its results on May 21st.
Well, thank you for that, Shesha, but that's all the time we have on this edition of Profit Top Trades. India Market Close comes up next.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. Let's talk about how the Nifty is faring today. And it's a very range-bound day of trade. We're down around 0.25% thereabouts. We're at the day's low. Let's pull out the Nifty 50, but it's extremely range-bound. So while the last few minutes we've seen a bit of a slip, outside of that we've traded in just about 100-point band almost through the day. Now it's going to be interesting to see from here where the Nifty actually goes, because we've breached 25k now. It seems a little bit more convincingly than we have pretty much all through the day. Let's look at the heat map as well on the Nifty. Let's pull out pockets which are doing well. Auto seems to be doing well. Some select NBFC names, maybe a Shriram Finance is one of those. Hero Oysher within the auto pack definitely standing out. A Power Grid and IndusInd, a Bajaj Finance, that's the flavor. What's not doing well, you're seeing Eternal or Zomato at the bottom. Consumption names and IT names are dominating at least that bottom rung of stocks. And that's how it's playing out. Let's look at sectors very quickly. And within sectors, look at the ones which are standing out. Realty is up 2%. Nifty PSU Bank is down 1.6%. Nifty Pharma is up nearly 1%. So that's how, at least those are the sectors which are standing out. What's not doing as well is an IT, not surprisingly. We saw that those frontline IT stocks on the Nifty also take a bit of a knock. So you're seeing that as well here, that trend play out. Outside of that, within the broader markets, oil and gas and media, which are also standing out. Not too bright on the broader end of the spectrum as well. But before I come to that, I want to quickly pull out the Nifty Bank for you intraday, and that's the one which is doing okay. Again, it's fairly range bound, but it's doing relatively better in that sense. We've seen a bit of a fall there as well. That's replicating on the index. Last off, I want to quickly look at the advanced decline, the breadth, and there you go. So the breadth surely in favor of the bulls as we speak. 2:1 in favor of the bulls. The advance is currently doing fairly well. And therefore the Nifty mid cap and small cap, which have seen an outperformance on Friday, they are seeing a bit of outperformance even now. The Nifty mid cap is up around 1/5% thereabouts, and the Nifty small cap is up around 0.5%, but nothing significant in terms of gains that we're seeing here. I want to last off again look at sectors, and within sectors look at the Nifty PSU Bank, because that is one pocket which is sharply outperforming. And those are some names for you which are keeping the Nifty PSU Bank well in the green, 1.6% higher. Let's look at the intraday chart on the PSU Banking Index as well. And my reckoning would be, we've seen a bit of a fall in the last few minutes. There you go. So we're seeing a bit of a fall even on the Nifty PSU Bank. It's fallen quite a bit from the highs, 798 to now 728. So around 1% or so is the fall that we've seen on the Nifty PSU Bank. So keep an eye out on this one as well. We want to wait and watch as to how this plays out. But that's on the index. Let's go across. We have Jay Bala with us. Let's quickly go across to him. Hi, good afternoon, Jay. I want to first quiz you on the Nifty 50, Jay. What are the levels you're looking out for? We are in the midst of what seems to be a bit of a consolidation phase. Would you expect that to last for a bit longer? Can we expect a breakout? What are the levels you're looking at?
It's good to be here. I mean, after a long time, and yes. I'm already counting this market as a breakout. And I've turned bullish since the middle of last month. I'm expecting record highs from a slightly higher time frame, but from a very short-term perspective, this consolidation is a pause to refresh for the markets. Even if the markets were to drop something like 23,750, it'll be a welcome pullback for the market. Probably by the end of the year, or maybe beginning of next year, I'm anticipating Nifty to hit somewhere close to 29,000, and if it does even better, probably 35,000. So it'll take the conservative estimate as 29,000 for the Nifty from a 6 to 12 months perspective.
Did I hear that right, Jay? 29,000 from a 6 to 12 month perspective.
That's right, spot on.
Okay, and so therefore, what's going to drive the rally, Jay? Is it going to be the conventional banks? Are you banking on some of the larger heavyweights? What way do you think this market is going to move? Where is the outperformance going to come from?
Yeah, I like two sectors, and I think those two will actually lead the markets. That will be the autos and the capital goods space. And some of the capital goods stocks probably overlap into the defense space, like BEML, BEL, and HAL and all those names, which constitute part of the BSE Capital Goods Index. So, this is pretty similar to what we count in the US markets as a Dow theory. For the Indian markets, we can count the capital goods space as the Dow Jones Industrials and the autos as the Dow Jones Transportation Index. So, basically, I'm anticipating these two sectors to do well. And Reliance itself, I will consider that as a sector. That was a problem bucket, but it's come up and saved the bulls by trading above 1,400 on the cash market. So that's also a positive for the equity markets, Indian equity markets in specific.
So a 16% performance from the Nifty is what you're penciling in from here, Jay. What about the Bank Nifty?
Yeah, the banking index has a little bit of a long-term resistance going into the highs that come around 58,000 to 59,000. If you draw a trend line from the 2004 highs and connect it through the 2011 highs, it will run through 2021, 2022, and where the banking index is currently now, that trend line comes to somewhere about 58,500 to 59,000. So the upside from here on is not as big as compared to the Nifty or on a relative basis. So it is trending higher, but as long as the index can stay above 52,063, that's 52063, the banking index is still trending up. I don't think the banking index will, even during pullbacks, will drop that much. But as long as the index stays above 52,063, you can be positive on the index and expect somewhere about 58,500 to 59,000. Keep that as a conservative estimate for the moment. If the markets start to outperform, basically the banking index, mainly driven from the private sector banks like HDFC Bank and ICICI, then we can revise the price objective. But as of now, take it as 58,500 to 59,000.
Okay, so bullish on the Nifty, bullish on the Bank Nifty. Jay Bala, give us some short-term ideas, something which you're tracking from maybe a week's perspective. What are those names and what are the levels you're looking at on those names?
Yeah, I have two from the cash market space, and these are positional calls, not intraday calls. Basically, we're seeing graphite and HEG do well. Usually, there's another name which tries to play catch up when these stocks perform. That's PCBL. It's related to graphite. PCBL looking good with a stop loss of 330 for a positional price objective of 560. Likewise, Linde India is again not related to this, but it's got a very interesting price structure. From a long-term perspective, it's probably into its fifth wave, as we call it, an elite wave structure. And it's also breaking out of an inverse head and shoulders pattern. And I'm anticipating Linde India to hit somewhere about 9,800 to even 10,000. The stop loss for the stock is 57.79. That's the right shoulder of the inverse head and shoulders pattern.
Jay, what is it that you're seeing on technical charts that making you so bullish? And I'm going back to your call on the Nifty with regard to the 29,000 call you've made. What's making you so bullish? What are you seeing on charts?
See, I look at markets from a elite wave perspective. So the structure is, I'm counting the 2021 high as the first wave within the structure, and the 2024 high of 26,277 as the third wave, and the correction that we saw into the April 7th low as the corrective decline in the fourth wave of 21,700, 21,500 and change, 20,600 and change. I don't recall the exact figure. But the April 7th low is a completion of a corrective decline. So obviously the next step higher is beyond the 2024 high, and we have Fibonacci projections that's run into and parallel channels that run into over 29,000 on the Nifty. This is the same case for the US equity markets too. If you recall, during the October interactions of 2024, I projected the decline to come into about the June 4th range, which is the election post-election decline range. The markets did come into it and reversed exactly from there. So the price structure is behaving exactly as anticipated. So I'm anticipating the markets to do well over the next 6 to 12 months.
And how do you view IT, Jay? Because we've seen a sharp pullback from 45,000 on the IT index to 32. And now we've seen a bit of a surge as well. So where does IT go from here, in your opinion?
IT is a problem pocket for the market. And I'm seeing the current rise as a corrective ascent, and it's been anticipated. I anticipated it to come from about 32,000. It went a little bit lower, and so it's been weak, and it still remains weak. The resistance for the Nifty IT index comes at about 38,500 to 40,000. And as long as this one sector alone remains an underperformer, it's not a problem. We don't want another sector to join in, then it'll be a problem for the overall bullish case. I don't anticipate that to happen, but I'm not able to reconcile IT's decline as a corrective decline, at least for now. So I will avoid IT index for the moment, and not to be too bearish too. Let's see what it does over the next few weeks. There are many ways to reconcile the decline, but bullish reconciliation is not something that I'm able to look at the IT index from a charts perspective. And it's a problem pocket for the market. So watch out, avoid it for the moment. Let's see how the index does over the next few weeks.
Very interesting. Thank you so much, Jay, for joining us and giving us those views, because indeed, if the Nifty were to go to 29,000, you are cashing in the chaos. So that's Jay Bala from Cash the Chaos giving us all of those views. But let's switch focus. Now, there have been plenty of stocks we've spoken about, but two stocks we haven't really spoken as much about. We'll talk about Adani Enterprises and Adani Ports. Both of them have done extremely well. One, Adani Enterprises is up 11% in this month. Adani Ports is actually up 35% from its recent lows in March, giving phenomenal returns to investors. Let's do a little bit of a deep dive on this first. Anushi bringing us with what's transpired, and thereafter we'll quickly take views as well. So Anushi.
Right. So in terms of where the stock performance is concerned for Adani Ports and Adani Enterprises, we've looked at a decent amount of return. In fact, Adani Ports gains for the third consecutive month. We've looking at gains of about 28% in this 3-month period itself. While we are seeing something like stock gaining around 28%, while for Adani Enterprises, 11% is the kind of upside that we've just seen in the month of May so far, which marks its highest monthly return in the last 12-month period itself. Now, what are the factors which is aiding to this rally? First of all, let's break that down for us. So firstly, Adani Ports Q4 earnings and guidance is something that was on the stronger side, along with Adani Enterprises as well. Both had posted a robust set of numbers this quarter, and it was the guidance forward which was excited the street. So far we've also, so that is another factor to consider. For other factors which are leading to this kind of rally that we are looking at is firstly the government's push in terms of where the infrastructure sector as a whole is concerned. We are seeing more focus over here, even in terms of where the budget is and factors like that. We've seen an increased allocations toward infrastructure. Second is in the recent few sessions in the month of May in particular, FIIs flows have been coming back in India, and for major weights like Adani Enterprises and Adani Ports, this is a positive considering this. And overall market rally, now we've seen a lot of small cap, mid caps recovering, large caps also in focus. So general market rally has also led to this kind of an upside that we are looking at. But on the micro level, if we see for Adani Enterprises, now Adani Ports, first of all, if in terms of where the numbers are concerned, the numbers are a beat. We've seen about a 23% of a revenue beat this quarter, margins up 33 basis points at 59%, and net profits are about a 48% of a growth. It's the guidance also which was very interesting this quarter. We've seen a revenue expectation of around 16 to 22% at the levels of 36,000 to 38,000 crore that we are looking at. EBITDA is expected to rise about 10 to 16% to 21 to 22,000 crore, while it's the capex which is interesting. Capex expected at 11,000 to 12,000 crore is what we are looking at. And net debt to EBITDA, now this continues to remain at the levels below 2.5 times, again in line with what the company had indicated in the previous fiscal years as well. But coming to something like Adani Enterprises, if we look at Adani Enterprises numbers now, what we were seeing over here is that while Jefferies has remained bullish on both Adani Ports and Enterprises, it's also Enterprises that had reported a decent set of numbers. We've seen about a 8.5 times of a growth in terms of where the net profit is. EBITDA over a 19% of a growth is what we are seeing. In fact, they also had an exceptional gain in terms of the Adani Wilmar stake sale which took place. So that has also resulted in this kind of a gain figure that we are looking at for Adani Enterprises. Jefferies also had come out with a note on Adani Enterprises now saying that the strong EBITDA growth has returned in the fourth quarter for the business. Along with that, they're estimating about a EBITDA CAGR growth, revenue to EBITDA CAGR growth of 26 to 28% respectively. This is over the FY24 to 27 period that we are looking at, and expect a faster scale up. Now this is in line with the paced rollout with its green hydrogen ecosystem that we are looking at. So that would be a particularly interesting segment to look out for Adani Enterprises. So overall, these are the factors that have led to this rally for Adani Ports and Enterprises, and why we are seeing these strong kind of returns over the last 2-3 months that for both of these companies.
Well, thanks so much, Anushi, for breaking that down for us. Of course, it's been an extremely strong Q4 for both of these, but they are also within the core infra basket per se, from an India standpoint, and crucial, especially the ports business from an export-import perspective as well. Let's bring in Deven Choksi, Managing Director at DR Choksi Investment Managers, to talk to us a little bit more about his views with regard to both of these names. Welcome, Deven Bhai. It's always good speaking with you. I want to first start off, sir, by asking you what you make of the kind of rally we've seen on both of these counters. What's your sense like with regard to the core business and the growth prospects? Let me first actually take ports. What's the sense with regard to the ports business?
Yeah, Harsh, good afternoon.
Good afternoon,
and thanks
sir.
for having me on the show.
Our pleasure, sir.
Well, I think importantly, the port operations domestic, port operations international, logistic operations domestic, and SEZ operations. I think these are the 4 verticals in which I think Adani Port is operating currently. And each of these four verticals are generating significantly large amount of cash. Interestingly, when you look at, I think, country as a whole, the way in which the port business has been handling the cargoes, FY25 they closed at in excess of 500 million metric tons of cargo handling that they did. And going forward, in 5 years from now, they are talking about handling more than 2,000 million metric tons of cargo, which means I think we are talking about 4 times growth over the existing growth which we have seen in this business. Completely, I think, justified as I see it, largely because of the fact that domestically they operate about 15 odd ports in the country, which is connecting the east and west corridors completely. And similarly, I think some of the strategic 7 ports that they have been operating outside the country. So which is again, I think, strategically connecting the global market from the point of view of handling the cargo. In my viewpoint, I think if they're talking about 4 times growth of cargo handling from now on, I think they are completely justified, largely because of the fact that the trade is expanding, the business is growing. And if you look at the China model of 20 years back, what they actually ended up achieving, I think you would get the validation of this particular number. China, in fact, I think ended up achieving 7 to 8 times or maybe 9 times kind of a cargo handling during this 20-year period, which Adani Port is basically talking about achieving now in next 4-5 years. So in my viewpoint, I think we are relatively more game for this particular growth in the country. And this business is also generating free cash flows. That is more important. Around 65 to 70% of the revenue is EBITDA in the business. So I think the company has relatively better ability to invest money back into and further create further capacities.
Do you think, sir, the return ratios are sustainable in this business, can grow from here as operational efficiency starts to kick in? And second, sir, you spoke about how the geographic presence of Adani Ports is solid, but you also have some worries around tariffs. Would that at all, in your view, impact the business?
Well, I think tariff is something which I think everybody is worried about. But I think if you really look into the real sense, I think it's not going to be so. Because everywhere, I think you will find the integration of the business in whichever way you want to have it. A single country cannot have the entire end-to-end manufacturing, as we all have understood. So I don't think that one should be unduly worried about the tariff-related situation. It could possibly hamper the trade for a quarter or two, but beyond that, I think again things would get normalized. So I don't think that I'm overly concerned about the tariff as a situation in this environment.
And sir, what about the return ratios? Can they build on the operating leverage, in your opinion, based on how the numbers are stacking up?
In fact, yes, because I think suppose if we take one example of Mundra Port, which they have, wherein I think they have started putting across the entire operations on an autonomous basis, wherein I think the entire operation of Mundra Port, I think, is being handled currently without the humans in some pockets. I think this is a similar situation is also happening with other ports. I think we are counting them into. So from a perspective of keeping the cost structure down and at the same time, I think handling a higher amount of volume, this is all possible, as we have seen in other parts of the world as well. So in my viewpoint, I think be it logistic, be it port business, I think they have the ability to keep the cost structure under control, and so would be the margins, because the margins would be on a higher side going forward, given the kind of strategic location that they have created and given the kind of volume that they are inviting because of the industry's expansion, etc. So I don't see much of a challenge over there. And plus, at the same time, these businesses are always capital-intensive businesses. Initially, you invest hard into the business, and in subsequent period of time, I think you generate equally high amount of EBITDA and make significantly large amount of cash generation as well. So that's what I think this company is experiencing currently.
Okay, so I want to shift the conversation to Adani Enterprises. Now there's just so much happening here. One, from a defense perspective and the opportunity that's opening up for Indian defense companies. This one is decently placed with regard to the defense space. Second, with regard to infra that it does. Third, with regard to solar PV. And fourth, just with regard to the airports business. And there are multiple businesses that they have even outside of this. So it's an incubator of sorts. How should one view the business as an investor? Just how would you view it?
So on one side, you have the complete cash flow generating machine in form of road and airports, wherein more than 7,000 kilometers of roads are already in operation. They are likely to get, I think, more than 10,000 kilometers of roads into operation going forward in next 3 to 4 years time from now. So which means that business is built on operate and transfer basis, wherein I think you are basically getting the maximum amount of advantage of generating the daily cash flow. In fact, the bigger problem should be, I think, how to park this daily cash flow that they are having. So that is the advantage they are having. And similarly, the situation with airport business, wherein currently, I think they are they are handling about 8 crore plus passengers, I think, which is expected to increase to about 30 crore passengers going forward in next 5 years' time. Again, I think this is a daily cash flow generating business. So daily cash flow generating business is a boon for the company as a whole, because on the other side, when you have the newer segment of business, which is your data center kind of business, which requires higher amount of cash flow at the same time for investment till 2027-28. In my viewpoint, I think it is justified to have the cash flow generating engine on one side and deploying engine on the other side. So that's what they are doing. Similarly, the situation with the mining business, I think they are generating significantly large amount of output, which is giving them the power to generate more amount of cash in this, and at the same time allowing them to do acquisitions, inorganic acquisitions that they are currently doing. So in my viewpoint, the manufacturing business on one side, the annuity business on the other side, again, I think a good combination of the business model. And at the top of it, I think adding or investing money into renewable segments like green hydrogen, where they're talking about 10 million metric tons of capacity addition in next 4 to 5 years from now. So all in all put together, in my viewpoint, I think it's a balanced portfolio as I see it. And they hold the potential to monetize this portfolio. As I see it, I think the airport and the road portfolios are likely to get monetized, so that at least I think the cash flow comes into the company. Fantastic ability to, I think, generate the best benefit out of this kind of a business model that they are incubating at this point of time.
Okay, and so just from all the businesses that Adani Enterprises is doing, what's the one which excites you the most in terms of potential opportunity and the skills that the group has to execute? So that's the first part of my question, and also give us some thesis as to why.
Okay, so leave aside the trading part of the business for a while, because I think that is their typical legacy that they have. The cash flow generating businesses are probably, I think, the ones which are likely to grow significantly larger in my viewpoint, because of the higher amount of volume that they are experiencing and expanding further into it. So that could possibly become, I think, a more exciting. We do not know yet at this point of time how the data center business and how the green hydrogen business is going to shape up and contribute to the revenue, because I think practically one is short of making a lot of assumptions at this point of time as to what exactly the rollout would be. So from that point of view, I think we'll know. But I think if you ask me, I think what excites me maximum, probably the green hydrogen and the prospects built into it. I think that is what I find, I think, very, very exciting. Maybe the data center business is again an annuity model, but I guess I think the more importantly, green hydrogen business, what technology they adopt, how they exactly convert the seawater into the hydrogen power and green hydrogen power. I think that is something which I would like to see how exactly they will roll out this part. So it is more important to see how they unfold this business, how they implement this business.
Okay, so we'll wait and watch for that. So with regard to debt, you know, this was the other one concern which was there. In your view, has the group brushed that off pretty much entirely now?
So well capitalized as I see it, I think in the past 2-3 years, I think they have systematically brought in the additional equity by selling the equities to the financial investors. So in my viewpoint, I think it's a good strategy, because whatever the debt component, I think, which was overhanging at one point of time, today, at least, I think, as I see it on a consolidated basis across the group, against the free cash flow generation and the EBITDA that they are talking about, the debt is not more than 2 to 2.5 times in every respective situation. Now, for a company of this size and the volume growth that they are handling, which is strategically important assets for the country, I don't think that I think this kind of debt is high. On the contrary, I believe that anywhere else in the world, if you go to, I think they would probably have at least double the size of the leverage than what this company has done. So not concerning at all. Earlier years, I think when they were small, when they were not generating enough amount of cash and deploying hard amount of or hard assets, I think significantly for investment. At that time, situation was different, but today they're generating significantly large amount of cash from respective businesses. So not too much of concern at this point of time. As long as the operations are managed efficiently, it should be seen as a good growth driver for the company or the group.
Thank you so much, Devin sir, for coming in, speaking with us. Always engaging, speaking with you, and this was, of course, a conversation best had with you. So thank you for coming in and speaking with us. But,
thank you so much.
You know what? We're going to slip into a short break, but before that, let's hear a view coming in from Zen Technologies, Ashok Atluri, where he says that the company is targeting margin growth, in fact, margins expanding for FY26, and he talks about growth as well. Listening.
So the Indian Army has been always focused on buying companies that buying from companies that have developed indigenous IP, indigenous R&D they have done and built the products. So that is where Zen comes out top in the anti-drone systems. Where again in 23 there are two tenders floated. In both the tenders, Zen was the single vendor because they needed something, very broad, better specifications than anyone had till date. So we were resultant single vendor there. Based on that, it was very gratifying to see that the products that were used and they really did very well in the recent operations. And we have got really positive feedback from those on the ground. What we also got with the interaction with the armed forces is that there's a huge requirement and there will be acceleration of the products that have been proven in the field. So that's very gratifying, Tamanna. I think we look forward to government's next action, and we really feel so good that we were right there in the thick of the action, and our products proved very useful.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Welcome back. That time of the show where we go across to Somit, who joins us with all the chatter coming from dealing rooms with our special segment Heard on the Street. Somit, what are you hearing?
Multiple stocks that remain in focus today in trade. Firstly, picking up some things on PB Fintech and Delivery. Both these counters are buzzing in trade, and deals are indicating that there is a potential block deal that could happen in both these counters very soon, and that is one of the reasons why Delivery at one point of time was up 15%. Now it's up just 10% in trade. Anantraj is another stock that remains in focus. The company is internally considering a fundraise and could announce the same via QIP route, is what dealers are indicating for this stock. Astra Microwave is another stock. The company's board meet is on May 20th to consider fundraise, and dealers are indicating that the company might choose preferential issue as a way for this fundraise, given the fact that multiple influential investors have expressed interest to invest in the company. So keep an eye out for Astra Microwave as well in trade. Then there is Lupin and UPL. Dealers indicate that a lot of buying interest has been seen on the large HNI desk for both these counters. Hudco, Laurus Labs and SRF, there is buy flows when it comes to mutual fund desk in all these three counters. And lastly is the two-wheeler OEMs, which has been seeing FI buying interest. In fact, a clear basket buying that we are seeing in two-wheeler OEM names like Bajaj Auto, Hero Moto and Eicher Motors. So this is what basically these dealers are indicating in trade today.
Well, very interesting, and you know, a ton of names that you've come up with. You've spoken of two-wheelers, Somit. Anything on the four-wheeler side? Because we're seeing good buzz, at least in the auto segment, since quite a few days now. So any specific reason why two-wheelers and not four?
Two-wheelers at this moment, given the fact that they could be one of the beneficiaries of the rate cut cycle that we are seeing, plus the hike in 8th pay commission that we have seen, plus personal tax rate cuts that are coming in. So these factors could benefit the
two-wheeler space than the four-wheeler.
They tend to benefit more given the fact that the ticket size is lower.
Understood. Okay, so that's keeping the two-wheeler space in focus rather than the PV space. But so thanks so much for that, Somit. Let me go across. Hemen Kapadia joining us as well from DR Choksey FinServ. Hemen, any of these names on your list, and I'll list them out very quickly. A PB Fintech, a Delivery. There's some buzz with regard to a block deal. Would any of these look interesting when it comes to charts?
A very good afternoon to you, Harsh.
Very good afternoon.
I think Delivery was good, but I think it's 240 to 370 in a matter of 6 weeks is quite a bit. So that is something I wouldn't go for. PB Fintech, I would be slightly neutral, but I think Somit was also speaking about DLF on the desk, buying desk. I think that looks very interesting. I know it's beside what we spoke about, but that looks very interesting. Base formation, consolidation, breakout coming in. So instead of Delivery PB, I think DLF is something one can look at. Looks quite promising.
DLF looks promising. What about a Hudco, a Laurus and SRF? There's buy flows coming on 3 of those.
Hudco is once again looking interesting from a slightly longer term point of view.
Okay.
If you had a 1 year view, excuse me. If you had a 1 year view, it's a clear buy. There is absolutely no, I mean, not only Hudco, you have many of these PSU banks or PSU stocks, maybe a PFC, some of the defense ones which have run up a bit, but all of these, Harsh, look good. Or for an example, Hindustan Copper has corrected for 13 months. Okay, it's different from Hudco, but Hudco has corrected for at least 6 months, 7 months that I can see. So they've given deep time price retracement. So frankly speaking, it's a no-brainer, Hudco, the buy, absolutely. But once again, since it's run up from 160 to 240, one can buy it on declines, or two, spread your purchases. Don't go the whole hog at the same time. Laurus Labs is also looking very interesting. 660 is a major headache, but we are safely ensconced in a longer-term uptrend. So Laurus Labs, it's been here for some time. Meaning 1, 2, 3, 4. This is the 5th month that we've been around in the same area. So I'd say any small decline buy.
Okay, and what are you seeing, Hemen, with regard to the Nifty, Bank Nifty?
Bank Nifty seems to be working towards the breakout. The breakout hasn't yet come in. but the setup seems positive. And I would be more positive than negative. And in case if there's a decline of sorts, I think it's a clear buy. So it's poised, it's on the cusp of a breakout. But this is a weekly picture and we are on the first day of the week. So I would take a little bit more time, but looks good. I would be more stock specific, frankly speaking, and especially PSU banks, Harsh.
Okay. So give us your specific names, Himen, therefore.
Okay, I mean, something like a UCO Bank looks good in the PSU. Sorry, Union Bank, not UCO Bank. Union Bank looks good, but my recommendations are Hindalco. Sorry, I forgot to mention this. Metals as a sector looks very interesting. Many of these stocks have corrected for 13 months, and they've given deep retracements and they are at supports and forming bases. So metals as a sector is looking good, firstly. Hindalco is looking slightly better. One can buy Hindalco at 655, stop loss 640, target 685. Higher bottom on the weekly charts, is in an intermediate uptrend. Second stock, which looks quite interesting, is Ambuja Cements. Hasn't done that much, but 710 to 450 has made a base. Oscillators turning positive. Everything seems to indicate that above 586 we are going to gather even more momentum. But yeah, I have a target of 585, but above 586 we'll see more space. So buy at 555, stop loss 540, target 585.
Okay, so those are picks coming for you, and we'll quickly move through stocks. Things moving thick and fast. The Apex Court of India has rejected the pleas of Vodafone and Bharti Airtel to waive AGR dues. My colleague Aishwarya Patel is at the court with all of the details. Aishwarya, what are you hearing?
Well, just before the bench of court number 11 in the Supreme Court could break for lunch, the counsels of Vodafone Idea and Airtel appeared and asked for the hearing to be scheduled earlier. Later during the day, Vodafone Idea's case was listed as article number 55, which would have taken some time. But as this was happening, the Supreme Court and the bench dismissed the petition outright, calling it misconceived. It acknowledged that the companies involved can explore other remedies, just not through the Supreme Court, and definitely not in this manner, is what they emphasized. The court said, don't make us a party, and essentially refusing to mediate or interfere in what is considered a matter of executive or government authorities. Now, Vodafone Idea's counsel, Mukul Rohatgi, pointed out that they've already paid about 50,000 crore in terms of AGR dues, and the government already owns about 50% of the company. The court, of course, responded that if the government wants to help, that is the last remedy possibly that they could look at. They're free to do so. The government is free to do so. And but what he emphasized and said and reiterated is that the judiciary will not indulge in this and be part of this. So that's the crux of the hearing and the arguments that happened at the Supreme Court, court number 11. A huge setback for Vodafone Idea as well as Airtel coming in as they ask for waivers of, Vodafone asks waiver for over 45,000 crore rupees in interest as well as penalties.
Thank you so much for that, Aishwarya. Now, before we take a fundamental view with regard to this one, and we've had a couple of those views coming as well, but before we do that, let's quickly take a technical check. Himen, what's the view like on a Vodafone? What's the view like on an Airtel at this point? Of course, Vodafone is up around 2% from the day's low. Would you at all look to venture?
No, Harsh, I'd stay away because over the last, 5 years, Vodafone has given multiple technical signals. Every one of them has flopped. Okay, there have been bounces from 6 to 18, 5 to 16. Nevertheless, I mean, it's like, if you're buying an out of the money put with for a call, which you know that either you lose 10,000 bucks or you'll make 20,000 bucks. If you want to do something like that, it's okay. But frankly speaking, nothing seems to warrant a buy on Vodafone at this point in time. Yeah, it's like I said, you put in 20,000 bucks and they forget it. Either I make money or it goes. On the other hand, Airtel is overbought. We've seen negative divergence come in. I believe there's a small distribution which has happened. 1460 and My bad. So I was looking at the wrong stock. Yeah, Bharti Airtel is slightly different. We've had a distribution there, a volume spike, obviously, and we are at support levels at around 1810. So I would be slightly cautious. Doesn't look very exciting. In fact, it looks a bit heavy. So I'd wait a bit, but below 1810, I think things could worsen a bit.
So that's the technical view coming on both of those names. Let's also welcome in Siddharth Khemka, Head of Research and Wealth Management at Motilal Oswal Financial Services. Now, Siddharth, give us your view. Is this the beginning of a larger pain that we might see, one, in Vodafone, and two, what does this do for pricing, especially in the telecom sector?
Yeah, hi, good afternoon, Harsh. Thanks to be on this one. I think, yes, I think what we have been seeing is that consistently Vodafone is underperforming not only on the balance sheet front, but also on the key business metrics. It has been consistently losing subscribers, and that remains a key concern. Despite the addition of network and the investments in 5G rollout, we believe that regaining subscribers will be a big task for Vodafone, especially given that some of its peers, the likes of Jio, Bharti, they have seen superior cash flow generation and have deeper pockets, and then they can keep the customer acquisition cost higher. What is also is that the balance sheet concerns on account of the debt repayment, that continues to remain a big stress on Vodafone. So we have maintained a sell rating on that. Currently, we have a target price of 6.5 rupees.
All right, we'll come back for more on Vodafone. I mean, it's truly shocking how after knock, the company still goes back and says, okay, can we have another lifeline? And that's clearly not working. The SC Supreme Court completely dismissing what Vodafone has to say. But let's talk about the stock of the day. And the stock of the day undoubtedly is Divi's Lab. It's zoomed up after a stellar quarter, nearly 6% up today on the back of strong Q4 numbers. Varsha is bringing in for more on this. Varsha, what's worked for Divi's?
Yeah, thank you for that. So yes, superb numbers. If you see, a net profit has beaten estimates, but you know, the revenue growth that you're seeing is led by the generic and custom synthesis. So custom synthesis is nothing but you make a drug or product exclusively for a customer. The EBITDA margin expansion that you're seeing is led by higher expansion when it comes to gross margin and of course lower expenses. Now, if I were to talk about the segmental contribution, custom synthesis was up 12% year on year, contributing 51% to the overall revenue, and the growth was led by existing and new commercialized projects that Divi's has done, and custom synthesis will continue to drive future growth for the company. On the generic segment, if you see, excluding nutraceuticals, grew 13% year on year, accounts for 49% to the overall revenue, and growth was led by basically volume, but stable price erosion have also driven the generic segment growth, and they expect, so management expect growth in generics to be more volume based rather price based. They are expecting double-digit growth for FY26, and the company's progress in contrast media. Contrast media is nothing but a dye which is used in your MRI. So company's progress in contrast media is steady and encouraging, and their Kakinada unit is gradually started production, and the backward integration from the Kakinada unit is expected to see benefits when it comes to in future from phase 1. Management has guided another 200 crores of capex when it comes to Kakinada project. On the brokerage side, if you see, Jeffries has maintained hold, but they've cut target price because of the near-term patent challenges and the high valuation that the Divi's has. And lastly, MS, if you see, Morgan Stanley has maintained an overweight with target price of rupees 7,185.
Okay, so Divi's is the stock in focus, also in focus because they're pinning down on innovators, unlike a lot of their peers that are looking at generics in the GLP-1 space as well. Siddharth Khemka, very good afternoon. Do you like Divi's? It's an outlier in what we've seen in the pharma space, isn't it?
Yeah, we definitely like Divi's. This is one of our preferred ideas within the overall healthcare pharma space. Why we also like is that it is more focused on the CDMO space where it is working in sync with a lot of these innovator companies and doesn't have a lot of these risks or issues with the growth in the US. What is also why we like Divi's is it has one of the best track record in terms of the regulatory approvals and the strict maintenance of its plants and the procedures that helps the company to consistently deliver on the long term. If you look at business, Q4 numbers pretty strong, much ahead of our expectation. Growth was there in both custom synthesis as well as API segment. API showed strong growth after almost 6-7 quarters. And what we believe is that Divi's is in a sweet spot to garner contracts from innovator companies for upcoming opportunities within the CDMO space, both as you rightly said, GLP-1, GLP-2, as well as the GIP molecules. There are a lot of opportunities for Divi's. It has a lot of pipelines in the generic category as well. And we are forecasting a 25% earnings growth over the next 2 years. Valuations, yes, a bit on the higher side, but given the pedigree, given the strong growth, I think the premium valuation is justified.
Yeah, so in fact, that's exactly what I was going to ask you, Siddharth. In fact, you just answered that at 81 times, how much of this is built into the price? Is there scope for further margin expansion from here, you reckon?
So yeah, I think what we are forecasting is that if you look at FY25 full year EBIT margins stood at 27.4%, and with the newer molecules coming in, we further expect this margins to improve to 30.9%, and hence almost 25% earning growth. We have seen generally that companies which are consistently delivering growth about 20%, generally market do likes to give them a premium valuation. And with a large cap like Divi's consistently delivering 25% earnings growth with the kind of management pedigree, with the kind of product pipeline, I think there could be more upside to the stock from current levels as well.
Okay, I just want to round that off with Himen's view on Divi. Since we've been talking about the stock on the charts at 6595, are you liking Divi's, Himen?
Yes, Tamanna. Was good, is good. I had a conversation with Harsh a few months back with a 1-year target of 7,000, and it's probably come in a few months. View remains positive as long as it remain above 6250. Further upside seems like a distinct possibility. Tamanna.
Any others in the pharma space? Because this is a space which saw a bit of hammering with the kind of noises coming out from the US with concerns about more localization drive by the Trump administration hurting Indian pharma companies. That seems to have reversed quite decisively today. In that up move, Himen, what would be your favorites?
Okay, I think a safe move. I like Laura's Lab. That looks nice. I just spoke to Harsh about it. I think the breakout is on the anvil. But if I take a contra view, I think something like a Zydus Life Sciences looks very interesting. Deeply oversold. It's had a very significant time price correction. Now seems set for a decent recovery. So I would say if you had a probably 6-month sort of a view, I think Zydus Life looks like a reasonably safe bet with a closer stop loss and a decent target.
Zydus Life, not doing too much today, but Zydus Life on top of Himen Kapadia's list. I mean, one stock which has completely taken a beating today, and I don't think there's anything that can be done for it on the charts, is Protean eGov. And you know what I find interesting, Harsh, and of course we'll play out what the management is saying in the con call, is that in all the previous conversations we've had with them, and I know you've had a few as well, they have been very, very confident talking about what the PAN 2.0 is going to bring for them. It was almost a given.
Yes.
A thought that came to mind that should a management be talking about something that could happen so confidently? And would that be difficult for investors to digest today? Because now there's a simple exchange filing saying, oops, we didn't get it.
not even on the short list, Tamanna. That's, I think, the larger concern.
Yeah.
So one is to not win it, but one is to not even make the cut.
No, so then we need to actually go back and examine the claims that were being made.
Correct. Yes. And a lot of the valuation build-up was as a result of that. So that's where the pessimism today is coming from. One is the fact that would you have the comfort with regard to what the management is saying and what the management is confident about, and second is just with regard to how much of an impact this will have, because a third of the company's revenue is likely even FY27 to be impacted and virtually reduced to zero as a result of this. But we'll quickly play out a small piece of the con call that the management, on which the management spoke and elaborated on what's happened. The CEO and Managing Director, Suresh Sethi, here's what he had to say.
The PAN 2.0 RFP is to do a tech revamp of that entire tech stack which ITD has. And that, in a way, is not directly linked to the entire distribution and application process for the PAN card. And therefore, we are saying that while it is a separate IT project, as of now, as we see it, it does not impact the distribution and the processing part of it. Currently, almost 3/4 of our applications are today still processed in an assisted mode, which means somebody is using the help of an agent to be able to submit the application, which is passed on to the ITD department. And that distribution is something which we today run as a multiple product distribution, PAN services being one of them.
Okay, that was Suresh Sethi today explaining why they weren't even on the shortlist. Siddharth Khemka, just to the point, and these things can happen in the life cycle of a company, that they're pinning their hopes on a deal and it doesn't happen. My only point and concern is the conviction with which it was being portrayed that this is in the bag, this is a done deal, there's nobody else who does this, we are going to do it for sure. Should there be any kind of responsibility for that?
Yeah, Tamanna, I think this is a bigger concern, especially for some of these smaller names in the ITES companies where their entire business is dependent on few customers. We have seen historically that even for some of the other private players where IT companies are dependent on one large client, and that suddenly goes off, that the entire business model goes for a toss. And here, I think the entire focus was on government-enabled services, where there was a lot of hopes pinned to the PAN 2.0, and that did not come by, and that took the investors by surprise. I think what you mentioned is right, that there had to be some indication about how and when the projects would be in place, and the way it was portrayed, it definitely did not put portray the right things, especially for the retail investors.
Okay, so I mean, no point asking for a technical call on Protean eGov. I don't know what you even say at 20% lower circuit where it is. But I'm going to get to the bulls versus bears segment. Now, this is an interesting thing that we do on the show. We take one stock which is in focus and we give you both sides of the story. So today we're talking about Hyundai Motors. Numbers were okay, pretty good actually. The stock saw a bit of a hit in Friday's trade, but today we have a whole slew of brokerages which are quite positive on Hyundai. Puneet is giving us both sides of the argument.
Well, thank you for that. So definitely a result that surprised the markets on the EBITDA side, and that's one of our first bull cases essentially in this argument. EBITDA boost led by lower discounts. Discounts were at 2% of average selling prices versus 2.6 in the previous quarter. That helped the margins. The higher average selling prices was also another key factor. That's the first bull case. In terms of the bear case, though, is the performance of the company in terms of sales. Now, last year, the sales actually fell by 2% versus industry growth of 3%. So there was a 5% divergence. They're also expecting FY26 just to be industry growth expectations, at least for the domestic market. 7 to 8% for the export market, but that's largely, just industry growth also, but the company couldn't achieve that in FY25. So that's going to be one of the other key questions. The industry growth essentially is not something very strong that could move the needle for the company going forward. So that's the first bear case. When you look at the second one, in terms of bull and bear cases, we have the new Pune plant that the company had acquired from General Motors last year. They are expected to start that in Q3 of FY26 and add roughly about 1.5 to 2 lakh units per year. And that will take their, once the whole plant is ready, it will take their overall production to more than 10 lakh cars. But on the other hand, the lower utilization as well as the startup cost will hit the margins in FY26, and any hope of recovery in margins into next year now seems a little difficult with the lower sales expectations as well as hit on the margins because of the startup costs. So that's another key negative to watch out for. The third case is, of course, the new launches. You could plan 26 new launches, what the company has said. 8 of those will be in the next 2 years. This will, of course, include refurbishments as well. So that's a key positive, at least in terms of launch pipeline going forward. But the company's market share is at a 20-year low. Back in 2002, the company's market share was 13%. It's still that number. And that hasn't been a very strong performance for a company been in India for the last 2 decades. It's now been, Mahindra is very close to knocking on its doors on terms of market share. So is Tata Motors, and now even its sister company Kia. So that's something to watch out for going forward, because we've also seen new launches from Kia that's been very accepted. Mahindra we've spoken about enough in terms of the listed space as well. And finally, in terms of valuations, at 24 times price to earnings, we've put it in a bull case that's aligned with its peers of Maruti as well as Mahindra and Mahindra. But currently what's interesting is that last year we saw 2 players, which was Maruti and Hyundai, get affected because of essentially lower sales. But for Maruti, they did not have a product ready at that time. The same can't be said for something like a Hyundai. Hyundai had a product, they also had a balanced portfolio. So what led to the fall in sales and underperformance versus the industry, that's something to talk about. Seems to be gaps in the portfolio. That's something that investors have to answer. So it's essentially, what are you paying the same valuation for? That's the key question for Hyundai going forward. But for now, this is the kind of bull and bear case that we're presenting. Do tune in tomorrow at 9:40. We have a special management conversation lined up for the results as well. But for now, that's the bull as well as the bear case for Hyundai.
Okay, so well put, Siddharth Khemka. Somehow Hyundai, as far as the street's appreciation is concerned, has not seen as much love as some of its peers. Do you think that that's about to change?
Yeah, I think the major concern has been about the growth both for Hyundai as well as for Maruti, and we have seen that what the market is pricing in is the market leadership that both these companies have. Despite all the 26 new launch pipeline and all those things, our earning estimates are only 7% volume growth for the next 2 years. So that's the kind of growth, and you are giving a valuation of 26, 27 times. There are product gaps which the company will fill over the next 2 years. And also the new plant that is coming up, the startup cost of the Pune plant, that will also impact earnings in the near term. So clearly, a lot of growth is back-ended, and I would say that don't expect the stock to react very positively in the near term. Is it a good stock to hold in the long term? Definitely, it is one of the larger private vehicles, you can say the passenger vehicles company in India. Market leadership and the new launch pipelines, especially on the EV and the SUV front, that should drive volume growth. But a lot of it would be back-ended, as I said. FY27, FY28 would be where the growth would come by, and maybe that is the time when market would start rewarding the stock as well.
Interesting. Himen, you want to weigh in with regard to your views with regard to PV plays in particular? A Hyundai, sure, but also a Maruti and an M&M. Do you have a view on any of these?
M&M is and Maruti are the slightly easy ones. Okay, Maruti has been range bound for almost a year and a half now, but there is a distinct positive tinge to the chart setup. Okay, we need to take out 13,060 and then 13,450, but one gets the feeling that the breakout chances on the upside are much higher than on the lower side. So yes, Maruti looks quite positive. And even Mahindra, frankly speaking, in this decline, when we saw it go closer to 2,400, should have gone to 2,100, keeping the quantum in mind. But it's so resilient, Harsh, that it's come back about 2650. The range is between 2650 and 30 to 22. So I think that's one of the strongest four-wheeler stocks. So that looks good. Coming back to Hyundai, I don't have that much of data to take a very longer term sort of a call, but we are walking into a virtual roadblock at around 1940. We are in a short and medium term uptrend. The bias has turned up as far as Hyundai Motor is concerned. So whether you look at Mahindra, which looks good, Maruti looks even more better, or Hyundai, they all seem to be in intermediate uptrends and indicating we want to go further if you have a 3 to 6 month point of view, Harsh.
Well, thank you for that. I mean, fully understand why the view on Hyundai may not be as clear, but just some levels, of course, for viewers to keep in mind for perspective. Charts will be too small to actually determine the exact numbers. But what we're going to do is we're going to slip into a very short break. On the other side, we'll get you top BTST picks, and we'll also talk about the brokerage note of the day. We have CLSA's very interesting view on NCC. Very strong upside. Stay tuned. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Close. Okay, welcoming Parag Thakkar into the conversation. He's, of course, head fund manager of Fort Capital. Just a quick check on the markets before we move forward. We're sort of middling along today. We're having a quiet kind of a day, a consolidation day on Monday. What's hurting, if at all, are IT stocks. The Nifty IT about 1.5% down. Broader indices not half bad. I want to pull up the advanced decline ratio just for a second to show you what's working today in terms of the broader markets. And that's at least you have an outweighing of advances versus declines. So maybe portfolios are not looking so bad today. But Parag Thakkar, before the break, we were speaking about Hyundai. I'm told you have a view as well. So let's start with that.
Yeah, so Hyundai, I would like to add one more point. Some of the people have said that, from short term, yeah, definitely there is no big trigger. But just to have another view, that as you know, that we have spoken about TVS and Mahindra in the past, and we were holding those stocks in the portfolio. Hyundai looks interesting from medium to long term perspective because the starting valuation today, if you see the market cap is around 1,50,000 crores, and they have already generated 7,500 crore cash profit in FY25. So 5% cash flow yield. Now 5% cash flow yield to start with in FY25, that is trailing, is a good starting point for a good brand. Net cash of 8,600 crore in the balance sheet. And now they are talking about aggressive launches of 26 new launches by FY30. So at least there is a roadmap, there is a intent of company to grow. And regarding this market share loss, I would say that because their current capacity is 91% utilized, by giving lesser discounts and improving ASPs, if they can improve margins, which I think adjusted for one-off also their margin in March quarter was 13.5%, which I don't feel is a problem because their capacity is already 91% utilized. So I would say that it's a good addition. And coming back to my other point that the one clear theme in the market Of course, it was defense till today morning, but I would say is a rate sensitive, right? Because we have seen CPI, WPI numbers, we are seeing oil at 65. So rate cuts are given. So there are some real estate stocks or auto components which you have to buy in the portfolio, and Hyundai represents a good opportunity in my view.
Okay, so Hyundai represents a good opportunity, says Parag Thakkar. And like I said, the mood seems to be changing for the stock. Its market share has been robust, but the street did not welcome it as was expected, perhaps because of the pricing of its IPO. Nevertheless, things are turning after their numbers. Now, another set of stocks which is in focus is HEG and Graphite India. You'll see them as some of the sharpest gainers today in trade. This is because Japan's Resonac Holdings has announced shutting of its graphite electrode plants in China and Malaysia, citing global supply constraints. Now, the move is expected to boost margins for Indian players. Varsha is joining in to explain exactly why. Varsha, how does this help a graphite and an HEG?
Yes, so thank you for that. So first is why Resonac is shutting down its graphite electrode plants is because of the margin pressure that they are seeing. Now Resonac is a major producer of graphite electrodes, scaling back to improve margins, and because of the high competition that they're seeing from the low price Chinese parts. Now coming to Graphite India's global reach, if you see, they export to 27 nations, drive 35% of their turnover. Graphite India owns a fully owned subsidiary in Germany, and export accounts to 35% of the total turnover of the entity. When it comes to HEG, HEG exports over 70% of its production to more than 30 countries worldwide, and HEG is India's leading graphite electrode manufacturer, and the graphite segment accounts for 80% of the revenue for the HEG. So, because of the good market share that both of these companies have when it comes to export business, this is the reason why both of these stocks are buzzing in trade today.
Thank you so much for that, Varsha, first off, that perspective. But let me quickly take a view as well. Parag bhai, some of these businesses are extremely commoditized. So when you're looking at such a core commodity play, would it be fair to jump on this bandwagon? Because we've seen, at least over the last 12 months, some of these stocks spike in similar fashion at least 2 to 3 times when I'm looking at the stock chart. Is this just par for the course when it comes to some of these counters?
See, as you very rightly said, these are very, very deep cyclical products, companies, right? And there's nothing wrong in the company. It is the business is cyclical. So I would say that Graphite has a very good balance sheet, but definitely I would like to, within the cyclicals, within global cyclicals, I would say, I have always preferred Tata Steel and Hindalco as the stocks to go for. And domestic cyclicals, you know my view. We have been discussing cement since long. So I would not take too much of time there. But I would say I completely agree with you. It's a very deep cyclical. You have to study. Once in my experience of 21 years, there was one particular year where this stocks actually gave 700, 800% return in a year. Otherwise, I don't remember any particular time where they have given consistent returns, because the business is such. And this, Japan company shutting down the production, and so the prices going up. I would wait for more data to come. Of course, by then time, the stock might have rallied, but unless I understand the situation completely, I would not form a view and buy.
Okay. So stay away from cyclicals, says Parag Thakkar. I'm just wondering if you're feeling like that about defense at all, in terms of the kind of boost that we've already seen and valuations that some of these stocks are sitting at. Parag bhai, I know we've been speaking about it for a while, and you said last that maybe defense stocks have become too rich right now. Do you see that continuing?
Basically, we have booked profits, actually, I would say, in this rally. And
are you regretting it at all, looking at where the trends are going and the kind of numbers that have come? We waiting to see what BEL looks like, but Zentech at least.
No, I don't regret, because we have sold on every rise, so it's okay. It's okay to. I'm happy to miss. Let somebody else earn.
Okay. Happy to miss a few, I'm sure. Himen, do you have a quick technical view with with regard to some of these? Is there scope for some bit of more upside, if at all, in the near term?
Yes, I think so. I spoke about HEG and graphite. So I think you also mentioned every year, I'd say every couple of years, there's a mad move and then it fizzles out. So,
yes.
But you're absolutely right. When I saw it closer, you were right. It happens every year also. Yes. So frankly speaking, yes, I think if you look at HEG, it's come off a bit from the day's high. I think there is some more headroom left. And as far as graphite is concerned, we have space up till 623. So yes, I believe there is some headroom left for an upside from current level. Yes.
Now the other one that's doing fairly well in trade, much more than fairly well actually, after a decent set of numbers, was Delivery. Stock is still up, perked up 9.5% as it declared its Q4 numbers. Robust focus on operational discipline, it seems, this time around. We'll go across to Mahima, who's here to break down how Delivery has fared in Q4 and the reasons for that 9.5% up move. Mahima.
Right. So I think what the street is actually enthused about is the kind of substantial margin expansion that has taken place for the counter. EBITDA was also a significant beat despite revenues revenues seeing a single-digit odd growth. And the part truckload business is something that has contributed significantly towards margins as well as the overall growth in terms of EBITDA. Express growth, however, Express Delivery growth has remained tepid. In terms of numbers, revenue growth was at 5.6%. EBITDA stood at 119 crores versus that of 45 crores. So it's almost more than doubled. For margins, they expanded to 5.4% versus that of 2.2%, and net profits stood at 72.6 crores versus that of loss of 68 crores. So the company is also turned into profitability versus loss last quarter 4 FY24. Now in terms of what has led to growth, part truck volumes were up almost 19% and it was up 24% in terms of its revenues. Express delivery margins have also improved, and this is due to mid-mile utilizations improvement. Freight handling margins have improved due to lower contractual manpower as well as line haul expenses. In terms of what brokerages are penciling in for this particular counter, Goldman Sachs has maintained neutral but hiked the target price to 325 from 290. What they're saying is that margin sustenance over the next few quarters would be a critical thing to watch out for the stock performance. Morgan Stanley has also maintained equal weight and with a target price of 320. What they're saying is that express parcel volumes and yields were lower than estimated, but the overall part truckload business revenue did beat versus estimates. And lastly, other business performance was also a miss in terms of what the street was expecting or what they were expecting. So this is the overall view as to what has worked for Delivery.
Okay, so that's the take coming in for Delivery. Thanks so much, Mahima, for breaking that down. Parag bhai, how should one look at Delivery, contextualize the valuation as well for us in your opinion?
Basically, I have seen the result. The results seem to be good, and they seem to be, as you rightly said, focusing on operational discipline. And almost all the businesses which were burning cash are now, after getting listed, investors want them to show profits, at least at a cash profit level. That means including depreciation. So I think Delivery seems to have done well on that front. And remember, this is a very high operating leverage business. So if you, as you were, Mahima was saying, that part load business has grown by 19% in volume terms, that would have helped them. But just a disclaimer, we don't have this stock in the portfolio. As I told you, I generally believe in market cap compared to the cash profit which company generates. And so up till now, it was out of the radar. But after this result, definitely I would have a look at it.
You know, we were discussing this, Parag bhai, and I just wonder if you have a take, if there's any comparative, no clear peer for Delivery like you have, say, for an Eternal, Swiggy, etc., or, the platform companies. But in terms of the performance of a platform company, high cash burn, no clarity on paths to profitability. Do you think that's where the positive surprise for Delivery lies?
Yeah, definitely. Yeah. So Delivery numbers were decent, I would say. So as I said, that it was out of my radar from the cash profit perspective. But definitely after this result, I would deep dive into it.
Delivery worth looking at. And in the sphere of platform companies, Hemen, Any view on a delivery or any of the others that we mentioned, depending on how much data you have for them internal, I'm sure has enough.
I think I was just looking at delivery, Tamanna. Setup has, I mean, it's the worst is over, at least technically speaking, from a medium-term point of view. Thing is, okay, the markets have also been pretty volatile, but 240 to 367 in just 6 weeks, I would be slightly reticent about going fresh longs. Below 340, there's a gap. I don't know whether that gap gets covered up, but till it's open, there is a fear that it just might. This is just around 330. So if it comes to that level, I think that's where I'd take a contra buy call. Currently, it's not a short, it's not a long.
Okay, not a short, not a long at this time. BEL though is something that we should talk about. Bharat Electronic is set to report its Q4 earnings. Anushi is joining in to tell us what the street is penciling off its highs. BEL started pretty robust. Anushi, what would analysts be looking for very closely when the numbers come out?
Right. So, Tamanna, if you are looking at Bharat Electronics, now they've already come out with the FY25 provisional update, in which we did see about a 16% of a growth in its revenue at the mark of 23,000 crore. So, this brings our revenue to a figure of 8,380 crore, which is a downtick of around 2.1% as compared to last year. Well, that's where, of course, the audited numbers may be slight bit different as to what the numbers are, but it's the margins which should be in focus. Now, the expectation is of a 25% odd margin as compared to 26.7%, while net profit may see about a 2.4% of a decline. Now, do note that the company already came out with its order book position where they had received orders worth about 18,175 crore. This is for FY25. This is versus the guidance of 25,000 crore. Missing their FY25 order guidance by about 26%, owing to a couple of defense delays that had taken place from Ministry of Defense. If you take the console order book into perspective, that stands at 71,650 crore. Now, the key monitorable here would be, of course, on the order pipeline. Your order inflow guidance, which is given, is in a large value pipeline that we are looking at almost a 50,000 crore of an expectation as compared to 25,000 crore that we saw in FY25. And this order pipeline is particularly interesting post Operation Sindoor, in which BEL has played a critical part. We've seen about the ISCCS system, about the Akash Tir, how that were utilized. So prospects for the business going forward from both the domestic and the export sides would be something that we should be watching out for. FY25 export revenue had seen about a 16% of a growth. So considering even the higher defense spending that's happening in Europe, how the exports are going to shape up for the business is on a watch out for. Key order expectations for FY26 remains 25 to 30,000 crore of orders related to QR SAM. That's quick reaction surface to air missile, along with next generation Corvette orders to the size of 14,000 to 15,000 crore. And even the order slippages that we saw in the final quarter of FY25, those order slippages at the tune of 6,285 crore may also reflect in the first or the second quarter of FY26. So all these points are very important for BEL, order pipeline being the biggest focus for the business going forward.
Bharat Electronic in view. Himen, would that make it to the cut for your STBT or BTST actually calls for the day?
Frankly speaking, a small cool off, so it's not my call. But yeah, if I were to do a PTST on Bharat Electronics just for today, it would be a STBT, Tamanna.
STBT. Okay. Okay. So Bharat Electronics there. What are your other candidates for calls for the day tomorrow?
Yeah. Now I actually had a sell call on Coforge and STBT, but I'll have to tweak the figures because it's changed in the last 20 minutes or so. So currently, Coforge is around 8289. I would have a sell at 8290, stop loss of 920, and target of 8230. Stop loss 30, target 60. I'll have to tweak the figures a bit. Tamanna.
Okay, interesting call on Coforge at a time when, I don't know, IT is having one up day, one down day. I don't know how that pans out at all. But Parag bhai, a view on IT stocks, has all of that joy about the US-China deal and, trade war easing seems to have evaporated fairly quickly today?
I think today IT stocks are down clearly due to the fact that the US rating has been downgraded by Moody's. So I would say that I am of the view that the IT spending, the discretionary spending, is not going to come back in a hurry for this year. But definitely once all these trade wars and trade tariffs settles down, it will come and then it will be a big comeback. So I would say that I am equal weight on the IT sector, as I said, with TCS, HCL Tech, and Emphasis as my stock picks. One another thing which I would like to add here is that HCL Tech and Emphasis, for example, or even TCS, they had a record deal wins. And HCL Tech was very clear in saying that they were very, very confident that all this deal will be actually executed and ramped up. So I would say that the companies who have done good deal wins, who are in right spaces, for example, Emphasis, 50% of revenue comes from BFSI, which seems to be doing well. So in any such large, I would say, downtick for IT, I would say that some of this, because IT is a great business, it throws so much of cash, the dividend yields are 4%. So I would say that don't ignore the big falls in the IT stocks. And these three stocks are the stocks which I like, and they are in my portfolio. So I would say that. But I think a key theme still remains rate sensitives in my view.
What is your top IT pick, Parag?
HCL Tech, I would say.
HCL Tech.
Yeah.
Okay. HCL Tech remains on top. What about you, Hemen? I mean, apart from Coforge?
I think okay, this was just a short SVT, but I think BSoft is something where I would be slightly more positive on. Hasn't done much, oversold, downside limited, the high top, high bottoms, indicators buying, weekly base. So I would look for a BSoft vis-a-vis the other stocks.
One in focus was NCC. An interesting note because CLSAs maintained their outperform, target price being 315, so very solid upside from here that CLSA sees. Q4, they believe signs of stability, but guidance being cut, possibly a negative. The pipeline though continues to be lofty. They believe the guidance seems to be conservative. Any volatility in a cyclically weak possible FY26 could be an opportunity to add, they say. And they believe that government water and urban infra programs should create years of growth visibility for something like an NCC. Parag bhai, if I can ask you, one with regard to infra in general, two with regard to NCC, are you bullish? Stock up 3.5%.
So, just a disclaimer, NCC I don't have in the portfolio.
Sure.
But I would like to say that this company has shown a good financial discipline. If you remember the days of 2007, when there were many other companies like IVRCL, Gammon, various other companies were listed, EPC construction companies. Some of the companies did big mistakes by venturing into real estate. Some companies got over-leveraged. And finally, NCC actually survived through that cycle. So I will give full credit to NCC management that they survived through this very bad cycle, and then they took a good decision that they will not own assets. They will just do a EPC construction. Then they reduced debt also. So all good things they have done. I was also very bullish at one particular price. Right now, I don't own in the portfolio. Right now, within the infra space, I own just L&T in the portfolio. And that is my stance. So I'm not very, very bullish on this sector as of now, but continue to like L&T and have equal weight in L&T.
Okay, point taken. What about PSU banks, Parag bhai?
So PSU banks are, again, I would like to share that I have SBI in my portfolio, and of course my top holding is the private sector bank, which is Federal and ICICI. But PSU banks, there are two things, right? One, valuations are always compelling in PSU banks. Asset quality is likely to remain stable, no problem. The only worry which I have in PSU bank is NIM compression, because 50-60% of, or for example, SBI say 40% of the loan book gets repriced when the repo rates are cut, right? And deposit rate, of course, SBI has cut 20 bips yesterday, which will give some cushion to their margins. But I would say that how long you can continue cutting deposit rates, right? Ultimately, at some below 6%, 6.25%, I would like to see that, how much how much growth happens in deposits. Because in India, remember once Mr. Uday Kotak also said that below 6%, nobody wants to keep money in India. So that is a limited cushion over there. So I would say that, and of course, some NIM compression will get offset because of the treasury gains, because 10-year bond yield has also fallen. So some of these PSU banks will have cushion. So I would say that it's a mixed view, but again, valuations are very, very compelling there. Especially in banks like SBI, Canara, Union.
Any of the private names, private sector names, Parag?
Private sector banks, Federal, ICICI continue to be, Federal is my top pick actually. And I always said that this is a bank which I have taken with a very long-term view. With a disclaimer, because of course, your viewers can take the advice of the financial advisors. But here the valuations are at 1.1, 1.2 times PE of 10x, with a new CEO coming from Kotak Mahindra Bank. I would think if you just go let this FY26 go through, because if the rate cut cycle, it is very difficult to improve ROA in this rate cut cycle. But once the rate cycle stabilizes, you will definitely see the ROA improvement. They are already building up bank for higher yield loans, which will improve their ROAs. For example, credit card and personal loan. Recently, the person has come from Kotak Mahindra Bank. So I would say that it's a good long-term hold for me always, in my view, because the valuations are very, very compelling. And I have full faith in management that they will improve ROAs once this rate cut cycle is over.
Okay. Thank you so much, gentlemen, for joining us this afternoon, giving us all of those views and taking out valuable time. Now, in terms of where we are closing in at on the Nifty this Monday afternoon, we're seeing about 0.33% lower on the Nifty 50, likely closing close to the day's low. Let's look at the intraday, and that'll give us that indication. 0.1% high on the Nifty Bank. So Nifty Bank holding fort. We're closing just off the day's lows. 916 being the day's lows. We're around 20 points or so above that, at least at this point. So that's how it's shaping up this Monday afternoon on close. Let's look at the heat map as well on the Nifty, and within that, we're seeing some bit of pain in IT as well as consumer names, which are right at the bottom. The heavyweight Reliance 2% or so lower. What's doing very well is two-wheeler stocks, a Bajaj Auto, a Hero doing decently well. We've closed for the day. A Power Grid has done well, so utilities, a Shriram Finance, NTPC also within that utilities basket doing fairly well. PSU Banks is the other place where you had a good amount of traction in trade today. Let's look at sectors, and we'll likely see a very similar kind of a picture. IT down 1.3. Oil and gas within the broader markets and media also underperforming. You're seeing realty do very, very well within that broader market basket. Nifty PSU Bank up 1.5%. When you're looking at the advanced decline as well, the breadth was favorable. Auto was up around 1/3%. The breadth was favorable, but declined a wee bit at the end. Those indications were evident. Let's look at the Nifty mid-cap and small-cap index, and the Nifty mid-cap closing around 1/5% higher at close, and the Nifty small-cap too off the day's highs, well off the day's highs, but gaining around 100 odd points, 0.5% plus higher. So it's another day where we've seen an outperformance from broader markets. The Nifty 50 seeing a bit of more consolidation. That's how we are seeing it. Let's last off look at what to look out for tomorrow, because some cues which will come. Nothing much on the global front, frankly. It's going to be one big telephone call from the US to Russia and Ukraine on everything that's ongoing at this point on the geopolitical side. So something to keep your eye out on. Some stocks might move on the back of that. But outside of that, it's earnings heavy. Most names within the broader markets, you'll have something like a Dixon Tech, a Fortis Health, a JK Tyre, some names, a Solar Industries as well within the defense space now with a market capitalization of 1 lakh crore plus. United Spirits also and then you'll have some of the other smaller names, and NHPC and Zydus also among that pack. But that's how the earnings will likely play out, so some stocks to look out for. But with that, we are out of time on this edition of India Market Close. From Tamanna, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. Viewers, the benchmark indices, both the Nifty and the 30-pack Sensex ended Monday's session off the day's lows, marking cuts of about 0.3% each around closing. Mid and small cap indices outperformed the benchmarks, with the Nifty small cap ending 0.6% higher. While the sectoral chart ended mixed with more bears than bulls, the Nifty Defense Index reversed last week's gains to emerge as the biggest sectoral loser. Zydus Wellness posted over a 16% rise in revenue on a year-on-year basis. The bottom line too jumped 14% to 172 crore rupees. EBITDA came in at 782 crore rupees, marking a 17% rise from the same period last year. Margin saw a slight expansion of 0.1%. The board of the company approved splitting of each share into 5 units. Data Patterns shares price hit an 8-month high as Q4 profits surged by over 60% for the fourth quarter of financial year 2025. The shares of Data Patterns rose as much as 9.54% to 3,141.7 rupees a piece, the highest since August 2nd. Kotak Institutional Equities initiated coverage on Hexaware Technologies with a buy rating and a target price of 940 rupees. The brokerage's confidence stems from Hexaware's consistent performance across revenue growth, margin delivery and free cash flow generation, which together make the company a standout in the mid-tier IT service space. Now, the Kotak forecast a 12.6% US dollar revenue on a compound annual growth rate basis. Well, viewers, that's all the time we had on this edition of Market Express, but stay tuned as we bring you special conversations with two of the big defense companies that played an important role in Operation Sindoor. Ashok Atluri, CMD, Zen Technology. It's great to speak with you once again, Mr. Atluri, and thank you for your time to us here at NDTV Profit on what has been a stellar quarter. You've beaten your guidance. In fact, you've surpassed your FY25 revenue guidance. Let me start with your margin number at 42.5%. Is this the new normal for you going ahead?
No, not at all. It would be around 35%. I think, we got some very good export orders. We had good margins there. But overall, I think 35 is an ambitious target that we have set ourselves. And we expect that, in the years to come, that would be something that we'll try to achieve.
Just give us a sense of what has happened post-Operation Sindoor. And, we've spoken earlier on this channel on the immense contribution of Indian companies like Zentech to Operation Sindoor. We've seen your work actually in action. It's gone from theory to practical. What has been the impact that you're seeing or expect to see on your order book going ahead?
So, the Indian Army has been always focused on buying from companies that have developed indigenous IP, indigenous R&D they have done and built the products. So that is where Zen comes out top in the anti-drone systems. Where again in 23 there are two tenders floated. In both the tenders, Zen was the single vendor because they needed something, very broad, better specifications than anyone had till date. So we were resultant single vendor there. Based on that, it was very gratifying to see that the products that were used and they really did very well in the recent operations. And we have got really positive feedback from those on the ground. What we also got with the interaction with the armed forces is that there's a huge requirement and there will be acceleration of the products that have been proven in the field. So that's very gratifying, Tamanna. I think we look forward to government's next action, and we really feel so good that we were right there in the thick of the action, and our products proved very useful.
Fantastic. And, congratulations to you for that, because an indigenous company right there in an operation which has been so tremendously successful. Just trying to understand, Mr. Atluri, if the kind of products that you provide and anti-drone systems that you provide, would there be a need for replacement at this point, or would you expect a bulking up of orders?
So we do think that there is a lot of requirement. There are two stages. The first stage is scaling up to the complete requirement of the armed forces. That scaling, they have just bought a part of the requirement, and the scaling up has to happen so that all the complete requirement is bought. After that, typically what happens is Zen Technologies, after a year or two, we start generating annual maintenance contracts till the life cycle of 10 years is over. And post the 10th year, they have to replenish they have to replace the equipment with fresh purchase of the same equipment. So that's the cycle way it's going to go. So they have to just scale up, first fulfill the existing requirement, and then they move to the next stage. Tamanna, I hope I answered your question.
Yep, I think you did. Mr. Atluri, good morning. Neeraj joining in the conversation as well. And firstly, thank you for making such amazing products. And it was lovely to hear your comment on Tamanna's earlier interview, wherein you said that there was a scuffle in your office for people wanting to go to the front lines to help the armed forces. It's quite the sentiment that the nation had. So kudos on that. I have a couple of questions, sir. Firstly, it's quite something to see a company guide to doing 2x what they have done in the previous year as a guidance in the corresponding 12 months. Is this, but the current order book may not show that, but I'm presuming you believe order inflows will make up for it. Is execution going to be as possible to enable you to do a sum of 2,000 crores which you're guiding for FY26?
No, FY26 we have said about what we have guided, Neeraj, is this, that for the next 3 years, on an average, the CAGR would be 50%.
Okay.
So that means to say, yeah. So what we are saying is, cumulatively over the next 3 years, we should do a little more than 6,000 crores. So it will not be really linear, kind of 50%, but overall, so that we still feel confident about. We do feel that due to the delay in orders, this year may be a bit muted. But we are very, very positive about the next 2 years.
Okay, so when you say muted, roughly relative to 925 crores that you may have done in FY25, you could probably maintain that number you are saying for FY26.
So I think we should probably may be around that figure. But till we get the order book position till till by the H1 end of H1, we will be able to more securely give the guidance on that.
Okay, fair call. So maybe we'll try and get some actual numbers on the guidance once you're in a position to be able to give it. Fair call, Mr. Atluri. The second question that one might have is that, yes, the sales, etc. have been good. Are receivables looking solid? And for a lot of you, I believe, Q4 might show bunched up receivables because a lot of execution might have happened in Q4, but the payments will come with a bit of a lag naturally so. So are receivables going to be an issue, Mr. Atluri? Or do you believe cash flow situation will ease out as the year goes by? Some color on that?
So we think the cash working capital cycle will come down to about 120 days, and the cash flow will improve significantly as we go. As you rightly guessed, the orders were received towards the executed towards the end of the year, so the receivables got bunched up towards the end.
Okay, so sorry, just the clarity before I hand it over to Tamanna again. 120 days it comes down to. What's the current receivable days, sir?
About 160.
Oh, from 160 to 120. Okay, fair call. Tamanna?
Now, just want to know about your order book for Q1. You've penciled in about 800 crores. Are you looking to meet it, surpass it, or be a little below? What is the picture looking like right now?
So, we are out of the 800, we have got 150, Tamanna, and we expect another 650 crores. I think by H1, we should be getting the whole thing and some more because of the current activity that the government is going on. They have given a deadline of 40-45 days to start placing the orders. So I think the overall order, we'll come to know maybe in another few weeks, the exact position. But given the feel on the ground, we think these guys are going to be huge.
So just that point you made, by H1 we should get the whole thing. Are you saying, what is the whole thing? Are you saying that you should hit your target for the year by H1?
Yeah, no, the order book position should be built up by the end of H1.
Okay.
And any special new orders would be added to that, and then we'll get a clarity what would be the total execution during the current financial year.
Okay, just one last point, Mr. Atluri, and that is on your inorganic growth. You've had a lot of acquisitions and very strategic acquisitions to enter into new verticals. Right? You're going from land to naval, marine, etc. From anti-drone, you're also looking at drone systems. Are you looking at building on that inorganic acquisition in this financial year?
So yes, we continue to look at acquisitions, Tamanna, and we feel that there are some very good prospects which can integrate seamlessly with the company's strategic objectives. And yes, I think there will be a couple of more acquisitions, but we are not sure about the timeline or the quantum of the money that will be spent. But probably this should happen in this financial year.
Mr. Atluri, 2 or 3 questions, sir. One, there is this emergency procurement of 40,000 crores approved on Friday by the DAC, right? Does this include orders for anti-drone, drone systems, or any other products that you might be making?
Yeah, we are very sure. We feel very certain that it includes requirement which partly then will be contributing to it.
Got it, sir. Okay. The 2 other questions, sir. You acquired AI Turing last year as well. I believe that's helped in the anti-drone simulation systems for you. A word on the technological edge that you might be having, because I don't remember it correctly or completely perfectly, but I remember you telling me that in some of the bids that you are putting in, you are probably the only bidder because of the technological specs that you own versus some of the other companies not owning. This was sometime 6 or 9 months ago. Just a bit on the stuff that you're doing around AI technology, which might help you quite well.
We have done R&D not to win tenders, Neeraj. We have always said, how would India win a war if war were to happen? And our R&D has been directed towards that. And one of the things that we did, was building anti-drone systems with wideband, basically wideband or band independence. It means that, while all the other anti-drone manufacturers were focused on neutralizing commercial DJI kind of drones at 2.4 megahertz and or 2.4 gigahertz or 5.8 gigahertz, we knew that, when the terrorist or the enemy comes, they will not follow the government guidelines on commercial frequencies. They'll come with anything. So that is what we prepared our anti-drone system to be able to do. So this is exactly what happened in the real situation, that they came in non-commercial bands and our systems were able to neutralize them. So yes, because we are spending the R&D money to solve real problems, we typically have happened to be the single vendors in many situations where others are not able to do. So, and the acquisition of AI Turing that you were talking about, they actually made remote control weapon station where human in the loop is removed and anti-drone system can be connected to hard kill systems like shooting down the drones, and so we connect with them. And so this has become a complete offering. Earlier, we were very strong in the area of soft kill. With AI Turing acquisition, hard kill has been coming within our reach. But the good part is AI Turing's equipment can be sold independently of the anti-drone systems also. We are seeing a lot of demand where unmanned, the weapon systems are required. They are being asked to come and demonstrate. So I think that was a fantastic synergistic and even otherwise a good acquisition.
One last question, Mr. Atluri, from my end. What about the export opportunity? I mean, does this, as sad as it may be, because we don't like loss of lives, but had to be done, but does this open up export opportunities meaningfully? Are you already sensing incoming interest for your products from global companies?
After this thing, we have got a lot of export inquiries after the recent operation by the Indian government. There are a lot of foreign countries. They approached us and they are very keen to discuss about procuring the system from us. Very initial stage because it happened very recently, but this looks very, very encouraging to us.
I think Tamanna, me and the entire team at NDTV Profit wishes you all the best, Mr. Atluri, for a lovely FY26 and beyond. Thank you so much for taking the time out and speaking to us today. Strong performance by Data Patterns on the revenue front. 170 in Q4, 117% uptick in revenues, EBITDA up 60% because margins came off at 37.7, I believe, versus 51%. I think Q4 margins declined on higher raw material costs, and I believe the gross margins would have gotten impacted, but they've beaten FY25 revenue guidance. They've met the FY25 margin guidance effectively. Order inflows, a bit soft. Can they improve post all that's happened? Let's ask all of this to Mr. Srinivasa Gopalan Rangarajan, Chairman and Managing Director of Data Patterns, joins us right now on the show. Mr. Rangarajan, thanks so much for taking the time out. How would you sum up your second half performance, sir? Because you've done exceptionally well on the revenue front, beaten guidance all through. The operational metrics maybe leave a bit to be desired.
We had projected 20% bottom line growth and 20-25% top line growth last year. I think we met our guidance, and also if you had been following, we had taken a couple of large contracts of complete radars year before last, and this gives us capability building. So we've taken it at a very low margin, but that is necessary because the company has to build a lot of competence and capabilities going ahead to build complete systems. So knowingly that we had taken contracts, and that is what is reflected in the last quarter. The margin which you're talking about is lower than a normal margin. But we had compensated with the rest of the contracts to ensure that our guidance is protected.
Yeah, no, okay. And as I said at the start, you met the guidance for sure on the margins front. So I hear you say, sir, that you entered into a couple of these contracts which were necessary to build capabilities as well. Tell us a bit about that and tell us how does this augur for, let's say, the next 2 or 3 years as you build out some capabilities and as maybe order inflow improves as well?
See, what we have done is, India is going through a phase of looking inwards. The government is fully supporting Make in India. But, all along, we have been importing products from abroad and relying on foreign OEMs to supply defense equipment. So it is a large opportunity for Indian world-class systems to address the gap which is there in the market. What we have done is we've invested heavily in product development in the last 1.5 years. We went for a QIP and raised about 500 crores. We are spending the money to build radars, fire control radars, EW suites, communication equipment, seekers, a whole range of systems with local IP and building world-class products. Second, we are also building the required infrastructure in the event that the contracts happen. We should be ready to deliver on the large opportunities. Third, we have now raised our engineering staff strength to nearly 1,100 people. We still continue to raise people, recruit people, and build competencies to see that we can go ahead in building Indian products as required to address the large opportunities. We're very bullish on the opportunities going ahead, and we are investing against those opportunities. This is what we're doing. So looking at the last year versus this year, we still retain the guidance of 20-25% top line and bottom line growth. The contract situation on the orders and position is a bit weak, as you said, but that has been delayed for no reason of ours. But this is all happening. We are now expecting a number of contracts to happen in the course of this year. One, on whatever we delivered products, which is getting repeated, and completed trials, we expect the contracts to happen. Two, also because of the existing skirmishes in the border, there is some amount of fast tracking of contracts is expected. So we are very bullish on the growth opportunities of data patterns.
Mr. Rangarajan, in the Q3 con call, you had spoken about how you are targeting 2,000 to 3,000 crores of new orders over the next 18 months. Maybe some spillovers from Q4 might happen in Q1 as well. So is there some color that you can give on what is the nature of the order inflows? Do you expect them to be front-ended in the current financial year or back-ended? Some numbers that we can work with?
See, there are some delivery delays. Though the products were ready, the offtake did not take place. Still, some of the contracts are not, we still have the products. The offtake is yet to take place probably this quarter or next quarter. But besides that, the number of contracts which we worked on earlier and the production orders are happening this year. I don't know whether I can give the flavor of the contracts because we don't want to talk about contracts which is expected and in an open forum. But this is largely in radars, EW, seekers. These are the areas, and avionics. These are the areas where we expect contracts to happen this year.
Got it. By the way, with the presumption out here, and I do not want you to comment on this, Mr. Rangarajan, but with the presumption that some of your products might have been used in the recent times, you and some of your peers have made the nation proud. So kudos on that, sir. One quick follow-up that I must have then to your first answer, wherein you said that you accepted some of those lower margin contracts to build out capabilities. Have those contracts been executed completely, and therefore can the margins move higher from what you've done as an average in FY25?
We've delivered on the contracts. There are various stages of acceptance and installation. But what we've done is we've built building blocks and capability. This capability can be either used to address opportunities in the same field, same products to be expanded, or it can also be used in building other systems which we are addressing. We are looking at in the coming years. So I can't say that this will happen. Whether the contracts will happen. We did plan that this will get repeated in large volumes tomorrow, but that is not in our control. But the capability building will be definitely with us, and that will will go a long way in building in addressing the large opportunity ahead of us.
Okay, so I'm presuming that when you're saying that top line and bottom line growth could both be about 20-25%, margins will be stable in FY26 relative to FY25. We'll not see a material decrease, but we'll not see a material increase either.
We don't expect material decrease. We'll be happy with material increase. Let me say that.
Okay, fair call. One question that most people have for companies like yours which are doing a lot of this work is around receivables. How is the receivable positions? I do believe there is some increase in the trade receivables this year. So how do cash flows pan out over the next 12 months to 18 months?
Okay. First thing is we're a debt-free company. We don't have any cash issues. We have nearly 400 crores in bank. So we are very well geared in the cash position to address large opportunities.
Sure.
Point number two, this year you see quarter four billing more than 50% of the annual billing. So obviously that is appearing on the debtors list, which is slightly higher. Third, we're doing a lot of development, and the development contracts during installation acceptance and integration with the customer takes a bit of time. So the debtor days becomes extended. But this will all change in the next 2-3 years. This is what we've been saying. The more and more we start getting production orders and complete system orders, the data situation will improve and the working capital cycles will also improve. But today we are not really very worried about it. One, because we have cash on hand. Second is because the nature of the business is development oriented. Moment it changes into production, we should be good to go in terms of debtor days.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Nifty ends below 25,000, dragged down by Eternal and Grasim Industries. Sensex and Nifty declined for the second straight day, with the Nifty Realty emerging as the top performer, while Nifty FMCG, Oil and Gas snapped their 3-day winning streak. The Supreme Court dismisses pleas from telecom majors like Vodafone, Idea, Bharti Airtel and Tata Teleservices to waive the adjusted gross revenue or AGR dues, calling the pleas misconceived. In a move that signals further strain in bilateral ties, sources tell NDTV Profit the government is unlikely to extend Interglobe Aviation Limited, that's Indigo Airlines, leasing agreement with Turkish Airlines. Gold prices climb, buoyed by a fresh wave of safe haven buying following Moody's decision to downgrade the US credit rating and renewed trade tensions out of Washington. Foreign Secretary Vikram Misri briefing a parliamentary committee on the India-Pakistan conflict to provide comprehensive information on Operation Sindoor and recent tensions between the two countries. Good evening, you're watching Profit 360 on NDTV Profit. I'm Sanjana, bringing you the latest updates. Over the next 30 minutes, we'll dive into the biggest market movements along with top national and international headlines. So let's get right into it. It's our top focus this evening. In a major setback for telecom companies, the Supreme Court has dismissed petitions from Bharti Airtel, Vodafone Idea and Tata Teleservices, which sought relief on their adjusted gross revenue liabilities. Now, a bench led by Justices J.B. Pardiwala and R. Mahadevan ruled the pleas as misconceived, shutting down hopes for exemptions. Earlier, the telecos had sought waivers on interest, penalties and interest on penalties, citing severe financial strain due to multiple court rulings on AGR over the years. Now, let me quickly go over to my colleague Aishwarya for what more was said in the Supreme Court today.
Well, just before the bench of court number 11 in the Supreme Court could break for lunch, the counsels of Vodafone Idea and Airtel appeared and asked for the hearing to be scheduled earlier. Later during the day, Vodafone Idea's case was listed as article number 55, which would have taken some time. But as this was happening, the Supreme Court and the bench dismissed the petition outright, calling it misconceived. It acknowledged that the companies involved can explore other remedies, just not through the Supreme Court, and definitely not in this manner is what they emphasized. The court said, don't make us a party, and essentially refusing to mediate or interfere in what is considered a matter of executive or government authorities. Now, Vodafone Idea's counsel, Mukul Rohatgi, pointed out that they've already paid about 50,000 crore in terms of AGR dues, and the government already owns about 50% of the company. The court, of course, responded that if the government wants to help, that is the last remedy possibly that they could look at. They're free to do so. The government is free to do so. And but what he emphasized and said and reiterated is that the judiciary will not indulge in this and be part of this. So that's the crux of the hearing and the arguments that happened at the Supreme Court, court number 11. A huge setback for Vodafone Idea as well as Airtel coming in as they ask for waivers of, Vodafone asks waiver for over 45,000 crore rupees in interest as well as penalties.
Thanks, Aishwarya, for that. That is, in fact, a big blow to the telecom operators, like we have been reporting. But for more on this, let me quickly turn to my colleague Himangshi now for a detailed breakdown on the key events that shaped this critical case. Himangshi, we're seeing actually this origin of this problem going back to as early as 2019, isn't it?
Absolutely. Now, Vodafone was eyeing for a third lifeline, but now the cash-strapped telco has hit another roadblock. Remember, the government has already stepped in twice to rescue Vodafone Idea. Let me just quickly rewind the timeline for my viewers. In 2019, a Supreme Court verdict redefined how telecom dues were calculated. For Vodafone Idea, that ruling was a financial earthquake. AGR now included non-core revenue, and the company suddenly owed tens of thousands of crores. By 2023, Vodafone Idea was in deep trouble. The government stepped in, converting over 6,000 crores of interest dues into equity. It wasn't just support, it was survival. The centre became a 23% stakeholder. Fast forward to March 2025, Vodafone Idea needed help again. Now this time, the government converted 36,950 crore rupees more into equity. Now 13,000 crore rupees of it, dues immediately. Now its stake nearly doubled, rising to 49%. The government had become the single largest shareholder in a private telecom company. Now, in May 2025, Vodafone Idea is back, asking for a third lifeline, a waiver of 45,000 crore rupees in AGR dues, not the principal, but penalties and interest. Despite the two equity conversions, Vodafone India still owes over 1.1 lakh crore rupees in spectrum fees and adjusted gross revenue. Now, today, the Supreme Court rejected the waiver. Requests from both Vodafone Idea and Bharti Airtel, dashing hopes of any fresh AGR relief. And for Vodafone Idea, it's back to the drawing board, it seems.
Absolutely, Himankshi. Thank you so much for that. And to bring in more perspective and insight on this in the legal recourse, I'm joined by Pawan Kumar Vijay, a corporate lawyer. Pawan, good afternoon. Good evening, actually, and thank you so much for your time. I'm going to dive right into it. From a legal perspective, what flaws did the Supreme Court likely identify in the telecoms arguments? And does this ruling reinforce the 2019 AGR judgment's inflexibility?
I will tell you the Supreme Court judgment is very clear. They are saying we can't do this because it's a contractual obligation, and Supreme Court has given various relaxation also. So now if you read the Supreme Court judgment is talking about now it is not in our court, it is in the court of government. So here the role of Supreme Court is over. All things have shifted to government. Now, what government should do and what will happen in this case? I just want to tell you some solution for this issue. Now, if you see, the legal part is, we can discuss legal part, what Supreme Court has said, why they have said, what are the reason. I think Supreme Court has closed this issue that we can't do more than this. You go to the government and government has to take call. Now, what government should do? First, this is a very, very important segment. It is not some telecom industry. This is an infrastructure industry. And if you see today, our UPI, Aadhaar, health, edu system, startup, financial gem utility, 5G, AI, all these things are depending upon the telecom and this digital era. Now, our government has to work out that what is happening, because India is the cheapest in India. India is the cheapest in telecom. Our data cost is the lowest. Our unlimited voice call is lowest. I was reading that day, Vodafone was coming 299 rupees unlimited data use. So this is the cheapest. If you go to abroad, you will find that the cost is really very tough and very costly. So all these things are happening. So my point is that if you will lose the Vodafone, then the consumer will face problem, because there will be only two competitors and then consumer will suffer. Because of three, you are fighting this issue. Now, another aspects which you have just now mentioned, that now government has 49% in Vodafone. So it means whatever happening, it will be lost to the government also.
Right.
So government should work out certain solution, and the solution is very clear. Are these companies are creating fuss that the loss is more, or there is a really loss? Government can appoint auditor.
Right. Okay. So this is something that Vodafone actually even raised on Friday. We reported this, that sources in fact did tell NDTV Profit that this is something that Vodafone raised with the government, that 200 million subscribers actually stand to be impacted if there is any kind of deterrence or any kind of disruption in the operations. But let me ask you this before I let you go, sir. Could this verdict deter future corporate petitions for regulatory relief, and how might it reshape legal strategies for telecoms navigating any legacy liabilities?
No, I think this type of decision in the legal arena will definitely impact. But I think if you read the entire Supreme Court judgment, the Supreme Court has given a leeway to government that you decide yourself. So if we can just focus on the law part, because Supreme Court has given and told the Vodafone that you have to follow the contractual liability, which you have agreed. Now you are facing again problem, then this is a systematic problem. You go to government and talk to them, and government is the highest. They are the biggest shareholder in this. So if anything is going bad to the Vodafone, it will be lost to the government itself. And if government is taking any action, then there will be question that they are supporting corporate. That's why government is not coming out very aggressively. But in my opinion, today, Airtel, Vodafone, and the Jio is not only government, they are an infrastructure company in private sector. If anything is collapsing in this, there will be a systematic failure and we will lose drastically. In the past, the government has done and bail out so many things like Air India. You have seen the Air India, they have bail out. Electricity, they have bail out. So the banking sector, they have bail out. Power sector by Uday, they have bail out. So they have bail out private sector also because of the infrastructure importance.
Absolutely. So definitely something that you're saying government and the telecom operators need to work out. But thank you so much, Pawan Kumar Vijay sir, for all of that insight. And we'll delve more into this as the developments take place. But thanks so much for your time.
Thank you very much.
Thank you. And a quick look at how the markets fared today. The Sensex and the Nifty declined for the second straight day, with the Nifty slipping below 25,000, weighed down by Eternal and Grasim Industries. While Nifty Realty emerged as the top performing sector, we saw Nifty FMCG, oil and gas take a reversal, snapping their 3-day winning streak. Harsh now joining in with a complete market wrap. Harsh, over to you.
Well, let's talk about the index itself. We were very, very range bound in trade again today. For a large part of the day, we traded in less than 100-point band, and therefore extremely tight where the range is concerned. But we slipped below the 25K mark. We clocked a low of 24,916, and thereafter we saw just a bit of an inch up at close. So that's how the Nifty played out. In terms of themes and sectors, well, you saw some pressure within IT and consumption in trade today. You also saw within broader markets the media index under some bit of pressure. Oil and gas also was under some bit of pressure. What did well though was auto was one pocket where stocks were up around a third. The Nifty auto was up around 1/3% thereabouts. Within the broader markets, realty was the other space, 2% higher on the Nifty realty index. So you saw good traction within those couple of pockets. The other piece was utilities. You saw good traction within something like a power grid, which did well today. And NTPC also sat in the green on an otherwise difficult day for the index. So those were some of the other gainers on the Nifty 50. When you're looking at the broader markets, the advanced decline was, or rather the breadth was favorable on the Nifty, on the NSE, and you saw that the advanced decline was nearly 2:1 even at close, despite some bit of weakness on the Nifty right towards the fag end. The small and mid cap space, both the indices held up fairly well for themselves, and therefore they outperformed the Nifty, and they continued to do that. So good traction getting built there. Of course, the action was all stock specific on the back of numbers, some very, very impressive numbers coming through, especially from defense counters. But nonetheless, overall, you did see some buzzers largely skewed towards news, and HEG Graphite, for example, were alive and kicking in trade today. You saw some bit of traction again around defense. So some particular pockets obviously doing well on the back of news. But broadly, that kind of sums it up.
Thanks, Harsh, for that. We'll continue tracking this through the week and let you know how markets are faring. Meanwhile, India is continuing its strong and unrelenting stance against countries that voice their support for Pakistan after Operation Sindoor. In a significant move, sources have told NDTV Profit that the government is reviewing the renewal of the pact between Indigo Airlines and Turkish Airlines very closely, and it is unlikely to be renewed. Now, just for context, Indigo currently operates over 500-seater Airbus A330s on lease from Turkish Airlines for its Istanbul flights. The partnership also includes a codeshare deal that allows Indigo to sell connections to over 40 destinations in Europe and North America via Istanbul. Now, last week, the Ministry of Home Affairs revoked the security clearance of Turkish ground handling firm Celebi. And separately, sources say Air India flagged concerns over the Indigo Turkish Airlines leasing arrangement, prompting the centre now to examine these potential security risks. And all of this coming after a slew of boycott measures last week, from travel platforms issuing advisories to passengers to traders boycotting Apple and marble imports from Turkey. Let me quickly go over to my colleague Sesa for more on this.
Right, the government is reviewing aviation ties between India and Turkey following Ankara's support for Pakistan during Operation Sindoor. Now, while the review exercise is underway, sources indicate that Indigo's leasing agreement with Turkish Airlines has been identified as one of the concerns, and it is thus being scrutinized. It is also learned that the current lease, which is set to expire on May 31st, is unlikely to be extended. Now, this comes, as the government has been actively cutting diplomatic and commercial ties with Turkey following the military standoff last Thursday. Remember, the government revoked security clearance of Turkish firm Celebi, which used to handle ground operations in 9 airports across the country. Meanwhile, there are reports, which also suggest that Air India has sought government intervention to halt Indigo's leasing pact with Turkish Airlines over security concerns. Air India, however, has denied to have engaged in any talks, involving competitors' business. Now, Yet, as tensions grow, Indigo on its part has also defended its partnership, saying that the tie-up, which also includes a code-share agreement with Turkish Airlines, allow Indigo to provide multiple benefits to Indian travelers, boosts the country's aviation growth, and also supports employment. Currently, Indigo operates direct flights to Istanbul using 2 leased aircraft, which are capable of seating over 500 passengers each. The code-share partnership with Turkish Airlines also enable Indigo to serve more than 40 countries across Europe and the United States. Now, the government is likely to hold dialogues with Indigo before taking any definitive action, considering various stakeholders are involved and competing interests at play. Indigo has not yet responded to NDTV Profit's queries on this matter. However, we expect the management to address these issues after its results on May 21st.
Thanks so much for that, Sessa. We'll continue tracking that story and bring you all of the developments. And the Reserve Bank of India is preparing to transfer a record surplus for FY25, a move that analysts say could ease fiscal deficits and strengthen bond markets. Experts from Kotak and ANZ Research expect the payout to provide liquidity support and enhance investor sentiment in the financial sector. Let me quickly go across to my colleague Pallavi for more on this.
The RBI's central board is expected to soon announce the quantum of the surplus transfer, and that's going to happen over the course of the next few days, with economists pegging the surplus transfer at a record high for this time around as well. And this is largely expected to be led by the central bank's earnings on foreign exchange transactions. Now, this surplus is expected to range anywhere between 2.5 lakh crore, which is what the government had estimated in the budget, and 3.5 lakh crore. It's expected to go up to that much, and this is compared to a previous record high of about 2.1 lakh crore rupees that we had seen in the last year. Now, the surplus transfer is going to be a function of the valuation gains on the RBI's reserves, its earnings on forex transactions, and its investment earnings, along with how much the RBI's balance sheet has expanded. Now, in fiscal 2026, the RBI balance sheet is assumed to expand at least in line with the nominal GDP growth, which the government had pegged at about 10.5%. That's according to Gaura Sengupta, chief economist at IDFC First Bank. Now, typically we have seen the balance sheet growth to be a tad higher than the pace at which nominal GDP growth is pegged at. What is the impact of this massive surplus transfer expected to be on government balance? Well, definitely positive, with the higher dividend creating fiscal space of anywhere between 0.1% to 0.2% of the GDP according to economist estimates. But there is also a chance that the government might choose to keep the fiscal deficit as is and instead use this excessive transfer to instead counter the growth slowdown risks and any potential emergency spending requirements.
Thanks so much, Pallavi, for that update. And moving on, what we're seeing currently underway. For the first time since the Pahalgam attack, a briefing is underway between the Foreign Secretary Vikram Misri and a parliamentary panel on Operation Sindoor and the current situation with Pakistan. To tell us more about the briefing, NDTV's managing editor Shiv Arur joining us live. Shiv, good evening. Thanks so much for your time. If you could take us through the key insights that we're expected to see Foreign Secretary Vikram Misri share during this panel briefing regarding the strategic outcomes of Operation Sindoor and the current state of India-Pakistan diplomatic relations.
Good evening. That briefing has begun with Vikram Misri briefing the Parliamentary House Committee on External Affairs. Hugely crucial because remember, in a democracy like ours, there are protocol briefings that must be had, whenever something big happens in the country. But not only for that reason, but also because the elements within this parliamentary panel, Dr. Shashi Tharoor, Asaduddin Owaisi, Aparajita Sarangi, and many others will actually be heading out to different countries right now to share information with those countries about Operation Sindoor, the new rules of engagement, defending India's punitive measures against Pakistan, both kinetic as well as diplomatic, the Indus Water Treaty suspension, and many other measures that India has either taken or plans to take. This is India's big diplomatic outreach. So this briefing that's taking place as we speak in the national capital is crucial to, fill the gaps, provide detailed answers and, dockets of information for many of the questions that these MPs might actually have to field once they're in those countries. Remember, there are 7 separate delegations, multi-party MPs. Many of the key ones are part of this parliamentary panel that will be, getting a full brief and absorbing many details which I imagine are not even out in public just yet, have not been shared in the series of press conferences that have been had so far by both the Foreign Secretary as well as the armed forces. So this is democracy in motion. These are, the teeth of Indian democracy, the members of parliament receiving the information necessary to build, partnerships and share with the world, the kind of history that India really has made via Operation Sindoor.
And also in terms of, a new India and a new playbook. A new India is something that the Prime Minister has constantly reiterated in all of his addresses so far. And we're seeing a united front, whether it is between, the government and the opposition, whether it is, different travel platforms coming together, or the government revoking a security clearance, or even taking action on the Indigo Turkish airline front. So really we're seeing a different facets of India coming together and kind of having this unified front when it comes to a diplomatic push. It says a lot about, India and its emerging diplomatic relations, not just with Pakistan, but even globally.
I think you're absolutely right. The ammunition and the aircraft are not flying anymore. There's no crossfire happening at the line of control. But the war is still very much on. And I would completely agree with your assessment that we're in the middle of a 360-degree campaign right now as a follow-up to Operation Sindoor, whether it is action against Turkey, whether it is, speaking in a united voice. These multi-party delegations that will be fanning out to different countries in different directions are an incredible affirmation of Indian democracy, in my view. Notwithstanding the politics that is being played by the leader of the opposition or the Trinamool Congress or certain others, that's part and parcel of democracy. We are a vibrant democracy after all. But I think overall, the unified sense of action from a diplomatic level, also the fact that things have changed completely. There has been a paradigmatic shift in terms of how India views and approaches and acts against Pakistani actions. And I think that is one of the reasons why, even though India has waged this entire campaign called Operation Sindoor, largely alone, and has been somewhat disappointed by some of the international, actions and words. These delegations going out, being briefed by Vikram Misri now, the actions that India has taken against other countries that have been unthinkable maybe just a few weeks ago, are all really a validation and an indication that India will act alone if necessary, but it is committed to its international allies, its friends, its obligations. It understands and recognizes its place in the International Committee of Nations, and therefore does not see the war against terror as an isolated act, and that's the reason why all of these actions are taking place.
Shiv Arur, thanks so much for that insight, and we'll continue tracking the story with regards to the briefing of this parliamentary panel. Thanks so much for joining us. And in a major financial development, shareholders of IDFC First Bank have declined Warburg Pincus's request for a board seat despite the firm's recent 7,500 crore investment deal alongside ADIA. Now, this decision raises questions about the governance dynamics and investor influence within the bank's leadership structure. Shabana Sheikh now joining us with further details.
Hi. So yes, this is a significant development that has happened at IDFC First Bank's shareholder meeting, where they have actually rejected the proposal to induct a non-retiring board member from Current Sea Development, which is an affiliate company of Warburg Pincus. As they have failed to secure the necessary majority vote. Now, only 64.1% of the shareholders have voted in favor of the appointment, as against the 75% threshold that was required for the approval. Now, this setback actually casts a lot of uncertainty over the planned strategic investment that Warburg Pincus and Abu Dhabi Investment Authority had planned. So, both these marquee investors had planned to invest 7,500 crore rupees in the bank. Now, the rejection of the board seat actually indicates that there is shareholder apprehension about the terms and implications of the deal, potentially delaying this fundraising into the bank. Now, why the bank is looking to raise 7,500 crores is because they want to increase their capital adequacy ratio, and they will be doing that through convertible preference shares. So this is largely the motive of the bank.
Right, Shabana, thank you so much for that update. We'll continue tracking that story and bring you all of the details. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching KYC. I'm Harsh Saita and with me is Anushi Vakharia. What we're going to do today is we're going to speak with Inox India and we're going to try and break this one down. Very interesting business. That's one reason why we've taken it up. Very low debt in terms of the relative capex that it does versus the debt that it takes up is nearly zero. And it's a business with a decent, deep kind of moat. As I was speaking with analysts, and what one analyst told me is that the number 2 player is 1/6 the size of Inox India, and therefore just the size of Inox India in terms of the business that it does, it has in a certain sense a very deep moat, a pure make in India story. Okay, but the risk of course is therefore tariffs. Anything to do with export could impact the numbers for Inox India. Any kind of headwind with regard to export, whether it's freight, whether it's tariff, all of those could well impact the business as well as the top line and margin for an Inox India. So that's point number 1. The second point is that with such a large market share, you could see market share erosion. What is the risk of that is what I'd want to ask the management as well. The third piece is the working capital outlook. The working capital requirements have gone up. Your cash flow from operations haven't kept pace with profit growth. Has this really peaked? Is there going to be an adjustment in FY26? Is another question which I'd want to ask. The kegs business. Now, this is where some good chunk of growth is going to come from. I'm going to give you some numbers. H2 of FY25, they've sold 50,000 kegs. The guidance for FY26 is so strong. 3 lakh to 4 lakh kegs is what they're planning to do in FY26. I want to understand what makes them so bullish. Does order inflow and business growth outside of kegs also add up? And what's the risk that if kegs would miss in terms of numbers, what is the downside risk to both top line as well as margins? They've guided for an 18 to 20% top line. I want to understand what the risk of that is. And the last one, what are they currently investing in? Where is the capex going? Where are they going to lever their growth outside of their conventional verticals? That's what I'm looking for when I'm looking at this company. It's a niche company in a very niche space, and that's why this one really stands out for us. Let me start off by describing what the company does. It's a manufacturer of cryogenic equipment. I'm going to double down and probably try to over explain what exactly is this equipment. It's used mainly to handle and operate material at extremely low temperatures. So just think about operating, transporting, storing material, whether it's gases or liquid, at sub minus 150 degrees. That is some seriously low temperature. You would require high quality, high precision, solid equipment to actually do that. This is where the business moat comes from, and Inox India is one of the very few which has the capability of manufacturing such equipment. Who uses it? Let me talk about that. One is it's used in storing and transporting LNG, liquid hydrogen, liquid oxygen, liquid nitrogen. So where all are they used in terms of the verticals? One is medical, something like storing blood, biological samples, cryosurgery, as well as liquid oxygen. All of those used in the medical space. These are just illustrative. The uses are maybe a few more than these, but broadly just giving you an understanding of what it does. Transport, LNG, hydrogen powered vehicles. That's where some of this will be used even going forward. Food, something like rapid freezing, preservation of food, green energy, development of hydrogen power. Those are some use cases where some of their equipment is getting used. Now let's talk about Inox India in particular. Inox India has 30 years of experience. It's a leading cryogenic tank manufacturer in the world, one of the leading ones. It has solutions across design, engineering, manufacturing, and installation of these equipment. It also does maintenance of these equipment and systems, and therefore it actually takes care of not just the one time but also the recurring thereafter. It has 3 divisions currently. One is the industrial gas division, which manufactures, supplies and installs cryogenic tanks. It enables storage, transport and distribution of industrial gases. LNG is the other piece which it does. Manufactures and supplies and installs standard and engineered equipment for LNG storage, distribution and transportation. It gets a lot of its orders with regard to LNG even from India, given the India requirement. And then you have Cairo Scientific, where it provides equipment for technology and intensive applications. Cairo Scientific is what has led the numbers in this particular quarter. So Cairo Scientific is a slightly nicher segment where you may not have as many players, and there is a far heightened amount of precision which is required. Let's talk about products now. Industrial gas. The use case is bulk storage, transport and vaporization. Again, some of this may sound repetitive, but what we've tried to do is try to break it up and present it as concisely as possible for a lucid understanding. So, bulk storage, transport, vaporization. What are the products available? Tanks, which are available for storage and transport. Vaporizers and piping is also what they sell, and oil and gas equipment. So, these are their three products in the industrial gas space. In the LNG space, they are providing products for aiding storage and transport again. LNG infra is the other space in which they operate, where they give industrial applications and LNG equipment. So some of these are use cases, some of them are products as well. Then there's Cairo Scientific. This is used for clean energy, advanced technologies and turnkey solutions. So what are the products here? Satellite and launch facilities use some of the products which are provided by an Inox India. And then there are propulsion systems where some of these products are used for the purpose of satellite launches, etc. You're talking about thereafter sustainable industrial packaging. Here it is used in containers and kegs. Kegs is the new business, or the business which they started in FY25. Industrial containers, beer kegs. Let's talk about Cairo Bio. This is used in dairy organizations, for animal husbandry, cattle breeding, infertility clinics for humans as well. Pharma companies use it even for biosamples, when you're collecting and when you're transporting biosamples. What they do in terms of products here is containers and tanks. A lot of the products that they do is containers and tanks. And this is the last piece, cylinders. Use case, they allow for storage of gases. So this is how it really stacks up in terms of product as well as in terms of use case. We hope we've tried to do the best we can to try and get you an understanding of exactly what this company does, because it's in a very niche space, right, Anushi? You want to add anything with regard to the product line?
So, you've given a very precise description about how the products are shaping up, the three main divisions. It's, the cryo division, which is important for the company. A lot of key growth expectations that we are seeing is stemming from this division. So, let's do and walk through the numbers if we can. I'll start.
Let's do that.
Yeah. So if you're talking about the revenue, now it's been a stable sort of a picture that we are looking at in terms of where the growth is concerned. So FY23-24, we saw about a 17% or a 23% of an odd growth. In FY25, while we did have a slow start to the year in terms of where the 9-month picture was concerned, it was the fourth quarter in particular wherein the revenue growth was back at 16%. The company ended with a 16% of a growth. Margins have majorly remained stable in the 21 to 22% of a range that we are looking at. And if you talk about the profit growth in the last 3 years, taking the CAGR of that roughly stacks up to 20%. So it's an overall decent sort of a picture that we are looking in terms of where the income statement is concerned. Again, order backlog is interesting for the company, as that would provide the visibility for revenues going forward. At the end of March, the order book stood at about 1,356 crores. Order inflows were up around 28% for the year. Do note that the company had marked a couple of large order wins in particular. FY26 remaining important in terms of where the cryo division is concerned. So overall picture on the order backlog side and the income statement side remains on the healthier side, right, Harsh?
Absolutely. So it's looking good. What I'd want to understand is how much of this component in terms of top line growth going forward will get added by the beer kegs business.
Right.
And how much of that are they able to deliver? Because they've spoken quite a bit about it. Q1, Q2, Q3, all the con calls mention it. Q4 also mentions it. But we've not seen that translate to numbers. So something that we need to really watch out for. Let's talk about balance sheet. Not too much here. I'm not going to go into detail because you've got very, very low amount of borrowing. It's a 10,700 crore odd market cap company with almost zero debt and a decent amount of cash balance. So definitely a thumbs up on our KYC metric here. Let's talk about cash flow as well. Anush, you want to take that up?
Yeah, so in terms of where the cash flows are concerned, around 122 crore of odd, so at the end of FY25 is what we are looking at. Majorly no changes from the previous year. What we are seeing, net cash flows almost negligible at the end of this financial year. Interesting would be to understand the working capital of the business, because if we break down the cash flow from operations, we have seen a pickup in terms of where the receivables are concerned. There's an increase over there and also on the inventory front. So management commentary on how there would be improvement in cash flows and the net working capital cycle is something that we should be focusing on, right, Harsh?
Yeah, we've seen that. We saw that kind of uptick. And see, I mean, they've maintained it at these levels when I'm looking at FY22 versus FY23 versus FY25. Actually, FY24 was a year when those numbers compressed a little bit. And that's why you're seeing a little bit of that impact coming in with regard to FY25 cash flow from operations per se. But otherwise, we've seen a decent trend with regard to cash flow from operations. But let's talk about the other metric, return ratios, and this is where it gets really impressive. The ROE and ROC metrics, very solid. You look at those numbers and you'll agree with me that it's a thumbs up. But shareholding pattern.
Shareholding pattern after now the company marked its listing in December 23. So from there onwards, we've not seen a particular change in where the promoter holding is concerned. It's remained very strong at the levels of 75%. If you talk about FIIs, now we've seen a pickup in terms of where the FII is concerned. So from what was in December 23 around the levels of 4.65% has moved upwards in the range of 6.9% is what we are seeing. DII is mainly stable around the mark of 6 to 7%. So overall, it's a good mix that we are looking at in terms of shareholding pattern as well.
Okay, so that's shareholding pattern. Let's talk about street cred. Stock's not done too much when you're looking at the last 1 year and the year-to-date numbers. But since listing, it's up around 28 odd %. So a decent kind of uptick. But would you say that they've left money on the table for investors? Doesn't look like it, right?
Right.
Especially since December 23. Stock is up just about 25 to 28 odd %. So that's how we look at it. We'll give this a neutral because we'll want to wait and watch as to how performance continues. You want to take the outlook?
Yeah, so if you talk about the outlook forward now, see, in FY25, what we saw is about a 16% of a growth. They've given us projections for the year forward, that's FY26. Revenue is expected to see about a 18 to 20% of a growth here. EBITDA margins also majorly in line with what the historic trends have been in the mark of 22% or 24% of an odd is what we are seeing. PAT margins again at the mark of 15 to 18%. Now, if we break down the segments for you, now industrial gas segment is interesting, 16 to 18% is the growth expected here. LNG now that has seen, if you take that segment into consideration, that is expected to see about a 20% of a growth. But you know, as Harsh was talking about it in the beginning, it's the beer keg division which is interesting. Now, the Inox sold about 50,000 units in FY25. They currently have a pipeline of around 3 lakh to 4 lakh. So that's almost a 6 times of a jump that we are looking at for FY26. Now, with some of those approvals, some issues which were there in FY25 now subsiding. Interesting to see what's the kind of growth that they expect from this division. So overall, even in terms of outlook forward, the guidance that the company has given is mainly on the consistent side is what we are seeing, right, Harsh?
Well, yes, it seems like. Let's quickly look at how the valuation stacks up for this, and we'll reverse engineer this a little bit. So market cap currently at 10,600 crore. The FY25 numbers versus FY26 estimates and FY27 estimates. What we've done is we've estimated a sales growth of roughly 18 odd %. 1,300 crore is what they've done in FY25. The estimate for FY26 expected to be around the 1,550 crore. and the FY27 estimate expected at around 1800 crore. What's the downside risk to that? We'll have to wait and watch, but we'll talk about valuations till then. The EBITDA margins we've expected around the 21% mark, and the PAT margin expected at around 17%. That's how your MCAP to EBITDA works out, and that's how your price to earnings ratio also works out. So 35 times FY27, certainly not looking cheap. Something to be watched will be the execution part. How well can the group continue to execute? See, they've done very well. That there's no doubt on. The last 5-year data seems to suggest that it's a strong set of numbers that they consistently post. But can that sustain will be the question. Let me bring in Mr. Siddharth Jain. And actually, let's quickly also have the KYC ratings while we are at it. But let me bring in Siddharth Jain, promoter and director at Inox Group, to talk to us about Inox India and what to expect from the numbers going forward. First off, Siddharth, good speaking with you. Thanks for coming in. I want to first talk about the beer kegs business. There was plenty of anticipation in FY25. FY26 also, in terms of expected numbers, there's plenty of anticipation. Talk to us about what's the likelihood of these orders translating. That's the first part of my question. Second part, you're building in 18 to 20% growth. How much of this comes from beer kegs? What are you anticipating in terms of numbers?
Good morning, everybody. Hi, Harsh. First of all, thank you for having me on your show. And
absolute pleasure.
I was hearing your commentary for the past 5 minutes, and I'm extremely impressed with the in-depth analysis that you've done about the company and how you've presented it to your viewers. So thank you. I think you've done a much better job than I could have.
Thank you so much, sir. An appreciation coming from the promoter himself means the most to us. Anyway, so please go ahead.
Coming to the beverage containers division, as rightly pointed out by you, sir, new investment we made in Savli over the past 2 years. And I'm very happy to inform you and all your viewers that we've received approval from the 2 largest breweries in the world, AB InBev and Heineken, and since these have to be FDA approved and therefore global supplies in the food division, they have to go through the most rigorous standards and in-person approvals. Those guys traveled all the way from Europe, and now we finally have that. So when you've got a positive outlook from the 2 largest customers in the world, we hope to see those converting into orders very soon. What happened over the past year is that it takes an awful long time with these European vendors to get them to India and approve our facility. And after they saw it, they were very happy to inform us that, in fact, it was not only world standard, potentially some of the best that they've ever seen. So coming to your question on what percentage of this would be in our growth this year, out of the 18 to 20% that you mentioned, and we certainly hope to achieve that kind of growth. It's difficult to put a number to it, but a low single digits out of that should be attributed to this, primarily because all our other 3 verticals of industrial gas, LNG, and cryoscientific, all of them are firing very well as well at the same time. So, I think we're in a good place right now.
Hi, Mr. Jain. This is Anushi joining in. Now, in FY25, there were some of these overhangs in terms of where the capacity constraints are. Now, that is lifted. For FY26, you're expecting about a 6 times of an opportunity for the beer kegs business. Just want to get your sense from FY27 onwards. What is now, while we do have a 18 to 20% of a projection for FY26, for FY27 or maybe the next 2 to 3 years, what's the kind of outlook that you see? Do you expect these margins to be better? Do you see a higher revenue growth, even if you take the other 3 main verticals in consideration? Want to get an overall sense on this.
No, Shreya, good morning. So, the way we look at growth, we look at it in batches of 5 years. We don't look growth on a quarterly basis or on a yearly basis, primarily because we are in the capital goods business. A large percentage of our orders that we're getting nowadays are in the non-standard EPC driven. You've seen our LNG order book. We had our highest order book last year of 500 crores. And I see that division continue to grow because it is a fuel that is being adopted at a very fast pace globally. It is a transition fuel before things go electric. and it is it is far cheaper than current fossil fuels, emitting far less CO2 as well. You've seen in our last quarter's order inflow, we've received some of these very unique opportunities of mini LNG terminals such as Bahamas. These are large value EPC orders which take 12 to 18 months to execute. So it's not just about shop capacity, it's about an entirely engineered solution to the customer to be delivered at site. Which is why you won't see exact 15 to 18% or 20% growth per year, but you'll certainly see that in a block of 5 years. And each of these verticals contribute a bit to it. And we're very excited about the growth possibility in each and every one of them.
You've got quite a few verticals, Siddharth. So give us an insight on the margins of each of these verticals. Does the beer kegs margin, is the beer kegs business margin accretive for you?
So the highest margin comes from a cryo-scientific division because that's by far the most complex division. I must give credit to our full team, and we're proud of it being in India, that we have, I would say, some of the finest brains in not only designing, engineering, we also do the manufacturing and execution on a lump sum turnkey basis for these cryogenic projects, which our competitors frankly don't have, and which gives us, a real edge in the market. So the highest margins we would have are in the cryo-scientific division, followed by LNG, which would be these more complex systems being executed, such as mini LNG terminals all over the world, followed by industrial gas and our beverage containers division, which would be similar margins. So I think they'll all be range bound. It's not about being accretive. We promise to keep the margins in the early 20s itself. Our focus is not to expand margins too much because in the capital goods industry, it is unnatural to have extremely high margins. Our goal is to capture a larger percentage of the global market share, not to expand margins to a very large amount.
Okay, so that's the margin outlook that you have, but I also want to understand on the order inflows. Now, FY25, about 28% of an odd growth that we've seen in inflows, a lot of portion of it also attributable to the export side of it. For FY26, is this kind of growth sustainable going forward? What's the key expectation here?
Anushri, first of all, our focus on exports is part of our strategy that we had spoken about during the IPO time, and which is primarily the reason we went for the IPO, is that we believe that the global market for cryogenic equipment is far greater than what is available in India itself. Not to say that India isn't growing, but our aspirations are truly global. We did achieve fantastic growth last year in terms of order inflow, and that was also driven by some great orders on the mini LNG terminal side. We hope to see that continuing. I wouldn't want to say that we are going to reduce. There is very, very aggressive bidding going on, for very large number of projects, and we certainly hope to see them converted. I can't promise that we're going to beat last year's number or last year's growth number, but we certainly hope to achieve it.
And Mr. Jain, considering all of the global uncertainties that are taking place, are there any risk-offs in terms of where some of these orders are concerned in the global market?
Anushri, we deal, as you mentioned at the beginning, in a niche product which requires tremendous amount of engineering knowledge and skill. It isn't a product that can be easily replaced. We aren't a company that can be easily replaced. So in spite of the global uncertainties, since we are a very critical, high-value CapEx item, it's unlikely that global uncertainties will have any impact on our business.
Is the ROE, ROC sustainable? Because 25% plus on a consistent basis is hard to do.
Well, I certainly hope so. I don't see any reason why not. When we look at our balance sheet, we look at the amount of CapEx that we need to invest. We aren't a very CapEx heavy company. We're mostly an IP driven company. The knowledge base that we have, the skill sets that we have in the design and engineering, which leads to getting orders, high value orders. It all comes from the margin, frankly, Harsh. It's not as much about CapEx It's about how to maintain margin. And that's what's going to give you the higher ROEs and ROC.
Mr. Jain, sorry, just 30 seconds is what I have. How is competition domestically as well as globally?
Competition will always be there, but I think we stand out, greatly because of the solution that we provide. And our knowledge across industries. Most of our competitors, specialize in one vertical. We specialize across verticals. And that learning across the verticals, combines, into a fantastic product that we provide to our customers.
Thank you so much, Mr. Jain. It's been a pleasure speaking, and love to keep track of this as well as speak to you every quarter to try and get better insight on how this is playing out. So thanks for coming in. But with that, we're out of time. I want to quickly just highlight all the KYC parameters that we've highlighted today for you. The income statement, the balance sheet, the cash flows are neutral, return ratios thumbs up. Seeing shareholding, street cred, outlook, as well as valuations. We've covered all of those, and that gives us a 6.5 on 8 on our KYC rating. Very solid rating that Inox India has. We'll have to wait and watch how that plays out. But out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We speak about simple personal finance concepts that hold you in good stead. And today, I'd like to talk about loans that you might have and sometimes the multiple EMIs that you tend to juggle. How do you manage them if they're getting out of hand? And what are the strategies that you employ? If you have a mortgage, does that mean that you need to have life insurance, and what type of life insurance is appropriate? Some of those questions I've listed out right now. I'm sure that a lot more will emerge over the course of this conversation. I have with me in studio today Rohit Shah, who is the founder and chief executive officer at GYR Financial Planners. Thank you so much, Rohit, as always, for taking the time.
Thanks, Alex. So glad you're taking up this important subject. Let's deep dive.
Absolutely. Let's talk about it. Let's start talking about it, because the mentality and the approach to taking a loan has changed very dramatically from when my parents were young, where there was an aversion to debt. There is a lot more comfort today when it comes to young people taking loans for things that they can't afford at the moment. Is that something that you witnessed?
Yeah, that's right. And you know what we are seeing is that, for example, the gadgets, the smartphone, a lot of this electronics, they've found a nice way to sort of penetrate it much deeper, sell it, breaking this into a monthly EMI. And you know, technology has also made it a lot more easier. And you know, the young people have long years to go, so it's easier to take a credit risk on them.
Wait. So the argument against that is a lot of people say, hey, wait, buy now, pay later, that's not a loan, is it?
We have to see the math, you know, because essentially if somebody is going to give you a period to pay, there has to be some interest cost baked in somewhere.
So can you explain that?
I think the trick is the upfront cost, the processing charges, what do you pay today and versus what do you pay over a bit of time. Sometimes the product manufacturer is funding these kind of expenses, so it's not directly visible. But you know, any financing which comes either from a loan company or from the product manufacturer bakes into the cost of the funding.
It is a loan.
It is, we can call it whichever way, whichever word we want to use, Alex. It is.
Okay, but you were making a point. These products are available that did not exist maybe 20, 25 years back. But what else is there with regard to the mentality of taking loans?
I think consumerism, one-way lifestyle aspiration is a one-way traffic. Everybody wants to have iPhone. Everybody wants to have nice gadgets. Everybody wants to go abroad, take a holiday, and pay over a period of time with EMIs. And I think technology has made it easier. The credit profiling, all the data aggregation, and I think the ease of convenience. If 15 years ago, Alex, we would need to visit a bank or go to a Bajaj Finance, and now everything happens online. So it's so much more easier to sort of, take the loan.
So talking about consumerism and talking about the idea of taking multiple loans, there is this perception that this credit score, which is now easily accessible to practically everybody, with a few swipes of your phone, you can take a look at what your credit score is out of 900, and there are several credit bureaus that do that for you. The tendency and the inclination for a lot of people is, I want my score up. And so the perception is that by taking loans, even if I can afford it up front, I'm creating a credit history, and thereby if I'm paying back on time, which is the intention always, I'm creating a record of having paid on time, so that in the future, when I do need to take a larger loan, that credit history is made. Is that the right approach?
Can I have a joke?
Yes, of course.
If there's a new hospital opening up in my area and giving discount,
do you want to get admitted?
So if you don't need a loan, why do you need a credit history? I mean, it can be of use, and there are better ways to manage that. For example, responsible credit card usage is a good way to look at. And I think most of the upper middle class families in India find no other way to buy a house but have a home loan.
Yes.
So, you're going to get credit history anyway, whether you want or not. Just take a loan.
But the point is that when you do go out to buy that house, in order to get the best possible rate, you are creating a credit history so that you get the best rate. Is that the right approach?
Not necessary, but probably it's a good idea to check if there are any wrong entries, if your credit score is negatively impacted because of something in the past. There you may have to take some actions. But just to proactively build a credit history because you're going to need it in future and take a loan, that may not be a good idea in isolation.
Okay, so let's talk about a few thumb rules to follow, right? And of course, personal finance is personal, and everybody has their own set of expectations and things that they need to do. But there are certain rules that hold for everybody. when it comes to multiple EMIs or even the total quantum of an EMI as a percentage of your take home on an ongoing basis, what are the rules to follow, Rohit?
Sure, usually the EMI should not exceed about 30 to 40% of your take home. Above 40% is a serious red flag. And you know, one of the thumb rules that we are recommending to manage your money budget is 30-30-30-10, the rule of 30-10, which is 30-30-30-10, which means if you have 100 rupees of take home, you know, at least 30 rupees or more should be saved. Up to 30 rupees can be your EMI. Up to 30 rupees is all your normal spends, groceries, travels, education for kids, etc. 10 rupees is your emergency, buffer and planned expenses. So, you know, up to 30% and the max 40%, because beyond 40% the banks can also reject it, and it can, with multiple loans, that can be a problem.
Oh, that's interesting. So I would think that somebody living on rent, for example, that 30%, and if they don't have loans, that 30% that they would normally spend on EMIs becomes available to them. Is that the way that you would look at it?
That's right. So, you know, if you don't have a home loan, then that, you know, that means including rent, you could go up to 50-60% of your take home. The other way to look at this, Alex, is that if you're at least saving 30 to 40% of your take home, that's taking care of your goal. Then the rest 60%,
you can do whatever you want with it. And that's the approach that I have as well.
Absolutely.
I try to save 30% and I transfer it out from my salary as soon as I get it. And everything else, my wife has no problem with me spending.
Wonderful. That's a win-win.
I learned that from you.
Thank you.
Okay, let's talk about credit card debt. And if you have multiple EMIs, why is this a big problem? Because you're talking about 3% per month in certain cases when you roll things over, right?
You know, Alex, they say that when you have money to solve a problem, you don't have a problem. So, you know, when you have a multiple EMIs and you understand what you're doing and, you know, you cash flow to take care of that loan, then that's fine. But, you know, if you realize that paying 36% a year is just too much, then I think it might be a good idea to relook at and restructure your liability profile. So I think if the general borrowing costs are around, you know, if your fixed deposits and your liquid funds give you 6-7%, and the personal loans will be 12-14%, car loans is 8-10%, then why should I pay 36%? Right? So it's a huge red flag that, you know, we are just too much overpaying for the convenience of credit card swipes.
So, okay, and this happens, and for the lay public, for a lot of people who might be experiencing this for the first time, rolling over your credit, that is paying the minimum balance, still attracts a charge?
Yeah, that's right. That's right. So the moment you get into paying anything less than the full amount, the moment you say that I'm just going to pay the minimum, then you pay the overdue interest on the whole amount. And have you ever heard of any credit card company anywhere in the world going bankrupt?
No, I haven't.
That means this is one of the most profitable business in the world.
Which is why a lot of banks want to get into it.
That's right.
And
That's
so
right.
It's aggressively sold. A lot of people call you asking, do you want another credit card?
That's
what are the rules? Should you have multiple credit cards in your opinion?
The idea is that to keep things simple. So, you know, based on the needs that one has, you know, like I like to have, you know, American Express Travel, Platinum Travel credit card, which gives me Taj, you know, vouchers that my family loves it, right? And that's enough for me. But you might want to build a credit card with, let's say, Indian Oil, with petrol, which gives you a lot of petrol, you know, liters, compatibility. Some of the Axis Bank credit card might be good for, let's say, a lounge access, right? So based upon the need, but the fewer the better.
Or something that gives you frequent flyer miles, etc.
That's right. That's right.
So if you're traveling a lot, or if you're doing one travel in a year and you want to fund that using your credit card points.
That's right. That's right. So basically, you know, what's the need? Why do I need to have a credit card? The fewer the better, because one of the first rule of financial independence is not to have a loan. And you know, similarly, when you go further down the line, keeping things simple is one of the very, very important ingredient of you know, being on your own and being financially free.
Okay, so let's talk about scenarios where people may have over leveraged, and by that basically I mean if somebody's taken on too much debt. This can happen very easily, especially in the scenarios, Rohit, that we've spoken about. If somebody is already got a pending loan, they've gone out and maybe spent on a white good that they could not afford because
it was just a little too expensive, and they've taken a monthly payback option. They've only paid the minimum due for 3 months. And this is a scenario where very quickly you have a domino effect play out, and the debt burden increases very dramatically. What is the order in which you would start reducing this debt?
So, see, when you have multiple EMIs, the first criteria usually is the cost of the borrowing. And, we should probably make a matrix and look at the different EMIs and what's it costing, what is the outstanding amount, what is the tenor, what is the EMI. So usually, the more costlier loan should be addressed on a FIFO basis. So, we take it
first in, first out, yeah.
First in, first out. So the most costliest, is first out is what we should try. But sometimes what happens is that if the most costliest loan, needs you to prepare more to repay, it is going to take longer. Sometimes you need a psychological relief. You need to free up yourself, and, you need to have those small quick wins to say, yeah, I'm on the way. Right. I'm on the way, I'm doing it. So even, then if you have a smaller loan, something which can make you feel better, that's always a good idea.
Okay. When it comes to getting rid of these, certain times what you have to do, unfortunately, is, and you're between a rock and a hard place in certain situations, right? So the options available are to take on more debt, to pay off a credit card due, for example. And that's not always easy, because a bank is going to say that you have a certain amount of overdue loans. You've been paying the minimum due, and you've been rehashing that debt or pushing it further down the road. And so it may not give you the best possible rates. You're going to pay 14-15% on a personal loan, but that's better than 36%.
That's right, always better.
So is that how you do it? Do you approach friends and family? At what point do you do that? At what point do you say you might have to sell assets to say that you need to get rid of this debt because it can become a problem down the road?
Yeah, I think it's a lesser devil. So that, in isolation, we will never recommend personal loan, but compared to credit card, as you rightly said, the math will hugely favor personal loan. And I think also this needs for a family review. People sit together, husband, wife, maybe, grown-up children, and brainstorm. For example, if you minutely review the balance sheet, you might have some hidden assets. For example, what about those assets which are long-term, but they may be underperforming? So, for example, if you have, if you're having a financial assets portfolio, and if you've got defensive assets which are running you 6, 7%, 8%, 9%, it might be a good idea to review them. If you have an older insurance policies, traditional policies, they don't give you like more than 6,
surrender value is there to consider, right?
So, can you relook at that? Is there a value that you can generate? And something might be, for example, if your portfolio is for retirement, then, ideally you don't want to touch it.
Yeah.
But given a 36% scenario, it might be a good idea to tactically take a retreat here and make sure that you overmanage becomes zero, and then, go back. One of the joke that I had heard, Alex, and I think is very true, that the creditors have a better memory than debtors.
I wonder why. And unfortunately, unlike ancient times when you had a jubilee, as they used to call it, right, where every certain number of years, all debts would be wiped clean.
Right.
That was what a jubilee was called. That doesn't exist in our day and age, and so debts need to be paid back.
Right.
But having said that, and I interact with a lot of people in a certain I don't want to call it strata, but their earning potential is relatively lower, and they tend to use gold. They tend to, girvi rakhna is the word that they use, right? So you keep gold with a lender. Now, with gold having gone up the way that it has, and most Indian households have gold, would you say that that's an asset that you can consider liquidate?
So leveraging gold can be a good idea. And this can help you to ease off the pressure. The gold loans are also interest; they don't have an EMI component, so it's much easier, to manage with the gold. And if you noted what has happened with Bank of England's gold holdings, if the Bank of England cannot assure you that I will return the same gold, then I don't know about these finance companies. So that's one aspect that worries me, because I'm not sure about the custody mechanism in India with the gold loan financing. But again, if we were into a situation where there are multiple loans, and we've got 36% off, and the gold is sitting idle and doing nothing, this might be a very good option to explore.
Okay, so many options we've already discussed. Now, when it comes to taking a large loan, a mortgage is pretty much the largest that it gets usually, right? Unless you're talking about business loans, and really that's not the audience that we're catering to. We're effectively talking to people that have